Yes, welcome back. Welcome to a very small chapter. Okay, small, sweet, and simple chapter with good weightage in the exam called as derivatives. Okay, derivatives. And this chapter is conceptually very strong. Derivatives analysis and valuation. So we have to understand what is derivatives first of all. What is derivatives? One paper I'm going to give you. This paper is actually derivatives. This paper is actually derivatives. I'm like, oh, this paper, oh, it's actually 1 rupee paper. In the photocopy shop, I got it for 1 rupee. But imagine this paper I'm telling you, this paper will keep getting value whenever this thing's value increases. I kept one gold bar over here and I told as the value of this gold bar increases, the value of this paper increases. So now what happened? Paper on its own was useless. So paper's value was based on this gold bar's value. So derivative is something that always derives value from an underlying asset. From an underlying asset. Derivatives are financial instruments that derive their value from the value of an underlying asset. Clear? So now that underlying asset usually for us is stocks. Okay, stocks, commodities. Okay, it can also be other things which we will see in other chapters. See, underlying assets could be stock, currency, gold, bonds, commodities, anything. So if you see over here, this chart of derivatives, we have forwards, we have futures, we have options. These three things we are going to discuss. Clear? We also have swaps and interest rate derivatives, which we will not discuss over here. We will discuss in a chapter called as IRRM. There is one small chapter towards the end which is called as IRRM. We will discuss it over there. Clear? Otherwise, we are going to discuss all these three things over here. So what is derivatives for us? Anything, any financial instrument that derives value from an underlying asset. Now, forwards, futures, options and swaps. Swaps we will see later. We will discuss only forwards, future. Just the concept of it. Try to understand what it is. Forward contract. Forward contract. Now imagine there is one guy. Okay. He is going to get married in 6 months. He is going to get married in 6 months. Clear? Now when he is going to get married in 6 months, he knows that he wants, let's say, 20 grams of gold. He wants 20 grams of gold. Clear? So what he does, he expects that the gold price will go up. Now the gold price is sitting at 15,000. He is expecting that the gold price will go up to 18,000. Clear? This is his expectation. So now he's scared. Now he doesn't have money. Okay, he'll get money towards the end of 6 months, then he will buy gold, he'll get married. Now, what he will do? He wants someone who can give him gold at today's price. Okay, so he will go to one more guy. He will go to one more guy and he will tell him, boss, after 6 months, I'll come to you and I will buy gold. After 6 months, I'll come to you and buy gold, but let's fix the price today. Let's fix the price today. And they fix the price at 15,200 rupees. Now you are thinking, sir, this fellow, he is thinking it will go to 18,000, so he is going to this guy. This fellow mad guy is agreeing for 15,200. If everybody thinks same thing, right? There is no market itself. Stock, commodities, nothing. There is no market itself. There is no buying and selling. There is no trading. Imagine the stock market. Everybody is expecting the market to go up. And everybody is going to buy now. No one is selling. There is no stock market. It will stop. It will stop. So obviously, if this fellow is having a thinking that it will go to 18,000, then this fellow is obviously having the mindset that it will go to 15,200. I mean, it will go lower. So he feels that this will fall down. When it is falling down, good, I can sell this gold at 15,200. And this fellow feels the price will go up. So I can buy this gold at 15,200. Clear? This is a forward contract. This is a forward contract. What did they do? They went into an agreement today to buy something or sell something in the future at a predetermined price. Clear? So now is a customized contract under which one party agrees to buy and the other party agrees to sell a specified asset on a specified future date at a price agreed upon today. Are you getting this? So now imagine this fellow wanted only 15 grams of gold. He would have gone to this person and asked. He would have entered into contract and told, boss, after 6 months I will be there. I will buy the gold from you. Now imagine after 6 months, just imagine the situation. After 6 months, the gold price is 13,000 rupees. 13,000 rupees is the gold price. Now this guy has to buy the gold at what price? He has to buy the gold at 15,200. Today the gold price is 15,000, but he agreed to buy the gold price at 15,200. Usually, just telling you, usually forward rates and future rates will always be higher than today's rate, which is called as spot rate. Usually, it's not 100%. Usually, it will be higher than today's rate. Clear? Now, when the gold rate is 13,000, this fellow should still buy it at 15,200. No, he should still buy it at 15,200. So this fellow will be like, boss, which contract? What contract you are talking about? Who are you? Signed? Which sign? I don't know only about the sign and all. Now, that is why we went into futures. That is why futures are there. Now, futures, what happened? Now, futures are what? Like what you know. Now, for example, sorry, what's your name? Guru. Now, Guru, okay, and Aditya, they both want to bet. They both want to bet on one match. They want to bet on the match RCB versus Mumbai Indians. Okay, RCB versus Mumbai Indians match, they are going to bet. And they put 10,000 rupees bet. Full stipend. 1 month stipend, full they have put on their respective teams to show the support. Okay, 10,000 rupees bet they have put. What are you writing? Oh, you're writing that. Okay. 10,000 rupees bet they put. Now imagine Aditya lost. Mumbai Indians lost. So now Guru goes and asks, boss, you put bet no? Give me 10,000. Aditya asks, which bet? Who are you? Which IPL? Which Mumbai Indians? I don't know anything. This is the situation what can happen in a forward contract. This is the situation that can happen in a forward contract. And this 10,000 could have been 1,000, this could have been 500, this could have been 2,000. It is basically customized between these two people. They both could have agreed on any value and they could have bet. Now imagine, okay, imagine they said, we will not do it like this. We will call one person in between. His name is Daya. Okay, they'll call one person called as Daya and they will be like, boss, you are going to look that we are going to bet. You are the person who is going to take care of this bet. So what Daya will do, he'll be like, give your money. He'll be like, you also give your money. And he will hold that money. And after the result is out, then he will give it to the person who is supposed to get the money. So can you see what is happening over here? There is an intermediary. There is an intermediary who is going to overlook the situation. That is what is futures contract. Future contracts are usually standardized contract under which one party agrees to buy and the other party agrees to sell a specified asset, everything same thing at a specified future date at a price agreed upon today. But in other words, these are exchange traded forward contracts. Now basically forward contract, when it goes to exchange, it becomes futures. Forward contract, when it is traded in the stock exchange, it becomes futures. Why? Because when it is traded in the stock exchange, there is an intermediary. The stock exchange is going to observe and tell, oh, you are the one who is agreed to buy. You are the one who has agreed to sell. Nobody can cheat. The person who has, if at all the person who has to buy, he has to pay money. Person who is agreed to sell, he has to get the money. Clear? So when the forward contract goes in stock exchange, it becomes futures. Clear? So when the forward contract third party comes in and stands in between, that becomes futures. If only two people were having a contract, that is forwards. So basically, concept-wise, forwards and futures work the same way. Concept-wise, forward and future is same. What is forward? I'm entering into a contract today to buy or sell some specified asset at some price which is already decided today, or at a particular date which is already decided today. That is forward contract. Everything same for future contract also. But in futures, what happens? There is an intermediary. The same forward contract, when it gets regularized and it is in the stock exchange, it becomes futures. Clear? Now when it is regularized, I can't tell no. Imagine Daya is a bookie. Okay, who is a bookie who conducts bets between two people. Now this fellow, the bookie who is there, no. Now what this bookie will do? Bookie will be like, boss, bets are only in 1,000, 3,000, 6,000 and 10,000. Can you see what happened now? The prices are fixed. That means it is not customizable. Is it customizable? No. So this thing is called as standardized contract. Here it is customized contract. So basically, if you go to stock exchange and you tell, no, you want to see now Infosys, you feel after some 2 months or 3 months, you feel that the Infosys share price will go up. So you want to get into a futures contract to sell Infosys shares that time. You want to sell Infosys shares that time. Right now you will buy, later you will sell it. Clear? Now you want to sell only 10 shares. It's not possible. They might tell that you have to sell. The contract is in 20 shares, 1 lot, minimum 10 lots. This is how the stock exchange will tell. If you want to enter, minimum 10 lots you have to enter, and 1 lot, how many shares are there? 20 shares. So basically 20 into 10, 200 shares. If you are ready to sell or buy, you can enter into the contract. Is this clear till here? Now, last one is option. In this, there was one feature which was not possible. In futures, there was one feature that is not possible. That is running away from the commitment. Running away from the commitment. Telling that, hey, what are you talking? I don't know who you are. Can you do that in futures? No. Okay. In options, there is that option. It's a contract between same two parties. Again, specified asset. Again, agree to buy or sell. But on that exercise date, if you are not interested, you can tell you are not interested. So therefore, in options, what happens? In futures contract, you are just entering into the contract. There is no extra penalty or anything, money you are going to give, service charges, nothing. But in option, no, when you enter into the contract, you will pay option premium. Because if you don't come back, at least this money is taken away from you. Okay, so two parties under which buyer has an option to buy the right and not the obligation, and to buy or sell at a specified quantity for a specified underlying asset or before predetermined date at a price that is agreed upon today. Same thing. This we will discuss little later once we finish complete discussion of forwards and futures. That's obviously not going to happen today. Tomorrow we will be seeing futures. Clear with what we are going to discuss here? Simple, 3 things: forwards, futures. Both are almost same. Okay. Then we are going to see options. Done. Chapter only done. Now, let's see the difference between forwards and futures. Forwards and futures difference. Now, forwards, futures, customized, individually tailored. What is individually tailored? Both of them decided the amount what they wanted only. Okay, as per their convenience. Here it is standardized in terms of quantity and in terms of delivery dates also. Now imagine they wanted to buy gold. They said, okay, we will buy gold or sell gold on this date, random date they chose. But in stock exchange, you can't do that. It will be fixed quantities, and it will also be delivery dates will be there, 15 days, 30 days, 60 days. Fixed dates are there. Middle of that, you cannot do anything. Okay, middle of that also you can do things that we will see when we go to advanced level of this chapter. We can. Okay, hedging. Okay, that will happen little later. Now, 2 parties are involved. Here 2 parties are involved, but here 3 parties are involved, third party being the stock exchange. That is the intermediary. Credit risk. Any party can default over here, but here guarantee of performance is there. No chance of default. I'm telling you, no chance of default. Futures default can happen only if the entire country's economy crashes. Entire country's economy crashes, then maybe it is possible. Otherwise, it is not possible. It's regularized. Margin. No margin requirement and not subject to MTM margin. MTM margin is money mark to market margin. What is that? We will see. Margin is required and are subject to mark-to-market margin. That means here, just right now understand margin like this. When those two people put bet on their own, did they keep little money at least for safety? No, they didn't. On their own, they didn't. When the third person entered, that time only he took the money from both of them. So that is the situation here. And here, when the stock market is there, obviously they're going to take some money from you and they're going to keep it aside. Okay, this is the situation that you have to understand. Some chilupilu things which you have to understand now. Bid rate, ask rate. 1 unit of gold is there. Bid rate 65,000, ask rate 66,000. This will be a little more important when we go into our next chapter called as Forex. Okay, but just understand what is bid rate. Now I am the person looking at the market. I saw the chart there. Gold. They have written 65. They'll write like this: 65,000 slash 66,000. That means bid rate is 65,000. That means what? That means what? I can buy it at 65 or I can sell it at 65. I can sell it at 65. Ask rate is I can buy it at 66. Clear? So just understand, buys at 65,000, sells at 66,000. Now see, customer is the one who will sell at 65,000 and buys at 66,000. But the gold businessman buys at 65,000 from you and sells it to you at 66,000. Obviously, he has to make profit, right? Are you getting my point? So gold bid rate, ask rate is, if you see 65,000, 66,000, you have to think from which angle you are looking at it. If you are the gold shop person, you will sell gold at higher rate, obviously. So for you, ask rate is 66,000. And for you, you will buy gold at the bid rate, that is 65,000. Now, if you are the customer, you will go and buy gold at higher rate and you will sell gold at the lower rate. Is this clear? Forget selling gold. If you are thinking of even pledging gold also, you will not get the, selling rate. You will get a buying rate only. You will get, even lower than buying rate you will get, because they will also say, cover themselves for the risk. Because if gold falls, they should still be safe. No? Why customer needs to buy at 66? You want to buy one, you want to buy one gold chain, okay? You will go and pay 66, buy the gold chain. That's it. You have no loss there. That's it. You will not do. You will wear it and go home. You will wear it and go home. That's it. That's the end of the story. After some time, you want to sell that gold chain. That time when you go to the shop, you will get only 65,000. That time only loss comes. When you buy the gold, you will not get loss. Only when you go and sell it back, that time you will get the loss. That can be there. That can be there. See, it is basically like what, you also have 10 grams of gold. You have 10 grams of gold. Your friend also has 10 grams of gold. Someday you have purchased. Forget about which day you purchased. Both have 10 grams of gold. If both go into the market, you can only sell this gold at 65,000. That is the selling rate for you. That is the buying rate for that guy. 65,000. Now imagine this guy tells, I don't want to. You go and sell it at 65,000. Now if he asked you the rate, at what rate you sold? 65,000 you told. Now he's like, okay, you sold at 65,000, a good rate. I'll go and buy gold now. If he goes to buy gold, he cannot buy the gold at 65,000. He can buy the gold only at 66,000. In fact, the gold that he might be getting is the same gold which was taken from you, kept in the drawer. When he went, it was given to him. Are you getting my point? Because if the rates are same, why is the gold shop person doing business? Forget gold, man. You're buying chocolate. You'll buy the dairy milk chocolate at 10 rupees. Okay. Do you think shopkeeper bought that chocolate at 10 rupees? Shopkeeper bought the chocolate at 8 rupees. Now he'll give it to you at 10 rupees. Clear? Same logic applies over here also. So next time whenever you see the forex market, right? Okay, somewhere forex, rates will be displayed. Whenever you see displayed rates, right? It will be like $1 will be written like this, and then they will be writing 90. It will not be like this. It will be even more detailed. 90, 91. What does it mean? If you want to buy dollars, you have to pay 91. If you want to sell dollars, you will get only 90 rupees. Clear? That is the difference where the forex trader or forex broker makes the money. Okay. That is the definition of bid rate and ask rate. Let's not worry about that now. Time value of money we'll skip for now and we'll go into this types of margin. Types of margin. First margin that we are going to see is initial margin. You won't be able to write. There is a lot you will not be able to write. I'll share the material. Okay, understand it. Initial margin. What is initial margin? Let's try to understand what is initial margin. Initial margin is basically that intermediary is sitting in between. No, who is the intermediary? The stock market, the stock exchange. The stock exchange who is sitting in between, they are taking money from both sides. They're taking money from both sides just to show that both sides have credibility. They are just taking money from both sides, telling that now see, if I am entering into a transaction that I agree to buy at 10,000 after 3 months and you agree to sell at 10,000 after 3 months, does it mean stock market will take 10,000 from me? Then it doesn't make sense. No, today only I can buy. No. If I am putting 10,000, today only I can buy. No. So stock market will take a smaller amount. Okay, smaller amount as a security deposit. As a security deposit. Here, I think this is just the example. We'll discuss from here. Is required to be deposited at the time of initiation of the contract. If it is going to be required to be deposited at the time of initiation of the contract, that means both parties entering into contract will take some money. Now, understand this. Just understand this initial margin like this. Today, I'll take 2,000 rupees from you. And you have agreed to buy or sell when? After some time. Okay. Imagine something bad happens and the price has gone down. Okay. That 2,000 becomes 0. I will tell you, boss, you have to put more money. Are you getting my point? You have to put more money. So initial margin might be like security deposit. Okay, if it is like security deposit, it is kept aside. But if it is not security deposit, it will be adjusted over here itself. Now imagine Guru puts 10,000 and Aditya also puts 10,000 and both of them they give it to the intermediary. 10,000. Then every day they are betting. One day Guru lost 500. So his balance went down to 9,500. Aditya's balance went up to 10,500. Next day, Guru lost again 1,500. His balance went down to 8,000. And Aditya's balance went up to 12,000. Okay. Now this is the situation. Now imagine one day he lost 8,000. He put 8,000, full 8,000 he lost. Guru, it became 0. Now immediately what intermediary will tell? Boss, if you want bet more, keep more money over here as security. Is this clear? So initial margin is like a security deposit which the person is going to put, investor is going to put. Now for initial margin, there is a formula. The formula is mu plus 3 standard deviation. That symbol is called as mu. Mu is basically means average daily absolute change. Average daily absolute change. Mu is basically an assumption figure, but assumption figure based on data. Average daily absolute change means in a day the fluctuation is calculated, and in a day we are telling fluctuation is around 600 rupees. 600 rupees it can go upwards, 600 rupees it can go downwards also. This is mu. Okay. Standard deviation means the deviation in daily prices. Deviation in daily prices. Now standard deviation we already know. We fix the average, and on the average what can be the deviation that can be possible. Now imagine I want to safeguard myself. Then I will not safeguard myself for one deviation. They are telling safeguard yourself for 3 deviations. Standard deviation 5% means what? It can fall down by 5%. But if it falls on little more, which is not under our control, which we didn't predict. So whenever initial margin is calculated, they said keep the money for the normal movement, and for the abnormal movement, which is standard deviation, 3 times the standard deviation you take and keep the money aside. Is this clear? This is called as initial margin. Now where are you going to get all these numbers? From the question only. From the question. From how are they going to get the numbers? They are going to compute average daily absolute change. On an average, how much is the change that is happening? What is the standard deviation? That means the maximum that can happen. Maximum. Now I don't trust the maximum. I am going to safeguard by keeping 3 times the maximum. So what is the formula for initial margin? Mu plus 3 sigma. What is mu? Average daily change in the underlying asset. If you're talking about Infosys shares, average daily change in Infosys share is some number. Standard deviation of Infosys share means what? The risk of going upwards and downwards of Infosys share, the maximum upwards and downwards. Maximum deviation which we are seeing is standard deviation. 3 times of the standard deviation, take the money and keep it in the side. Plus keep the average amount also. Clear? Let's try to see this with the numbers. It's like a security deposit which we have already discussed. Now see, average daily absolute change of Infosys is 120. What does it mean? That means on an average, Infosys changes by 120 rupees every day. It can go upwards 120, it can go downwards 120, anything can happen. Standard deviation of these changes is 45. Risk is how much? 45. So now initial margin 120 rupees I have to keep, plus 45 into 3, that is 90, 135. So totally 255 rupees will be your initial margin. This 255 rupees will be your initial margin if you are going to buy one share. Remember, futures was customized. It was not, future was tailor-made. It was not customized. It was tailor-made by the stock exchange only. So you can't tell I want only one share ka future. So now see, if minimum lot size is 300 shares. Minimum lot size is 300 shares. Then 255 into 300, 76,500 will be kept aside. Can you see? That is why derivative market is not cheap. Okay, when you are entering into derivative market, you are putting a little higher amount than normal market. Normal market 2,000, 3,000 rupees also you can start with buying and selling shares. But derivative market comes in lots. So comes in lot size. So because of the lot size, the initial amount that you might have to put is little higher. Clear? Obviously risk and return is also higher. Risk is higher. Return, we know what can happen. 9 out of 10. Hey, it's not cooling. Yes. Is this clear till here? So how will you calculate initial margin? Mu will be given in the question. Okay, if at all you get initial margin question, you should be very happy. Okay, because this is like just a basic topic over here. Mu is average absolute change daily, 120 rupees. Standard deviation is 45 rupees. Risk is 45 rupees. Basically, if you think return is 120, risk is 45. But 45 one-time deviation I don't trust. I will safeguard myself 3 times and then this total will be the amount that has to be kept aside. Clear? Now this will not be in per share. It will be in it will be in lots. So lot size, when we are going to take, the total lot size will be calculated and that will be your initial margin. And this is basically like security deposit. It is like security deposit. That means it will not be touched. It will be kept aside. Now see the next margin that we are going to see. Mark to market margin. Mark to market. The name only, just feel the word. What is mark to market? If market changes, you will get money. If market goes bad, you have to pay more money. Imagine market went up, it's favorable for you, so you will get money. That means somebody else lost money, you are getting money. If market goes worse, then what will happen? You will have to pay money. Are you getting my point? Pay money what? You have entered into a contract for 120 rupees. Price went to 125. You told you'll buy at 120. Okay, price today is sitting at 125. 5 rupees they'll ask from you. Someone else is gaining 5 rupees. So that 5 rupees that will go to in that person's account. This is called as mark to market. Takes care of daily gain or losses. The party who incur losses makes payment, which is then passed on to the other party who made gains. We can't, market is the intermediary, what they will do, they will not wait till that 3 month later ka period. 3 months later, if something might happen and you might tell I don't have money. So every day they are going to adjust this amount. Every day they are going to adjust this amount. And this, now you might be asking, sir, you can do one thing, no? From that initial margin only you remove the money. You're like, why again you are asking me 5 rupees? I have paid 76,500. Remove from that 76,500. That also is possible. That also is possible. Okay. Depends on the brokers. Depends on the brokers. There are some brokers who will just keep this initial margin as a security deposit and keep it aside. And every day they'll collect or give you money on the basis of fluctuations. There are some other brokers, they'll take from this only and they'll adjust. Clear? We'll see both. Now, first mark to market margin. If it is mark to market, Okay, if it is mark to market, 100% they are not taking from the initial margin. No. If they are taking from initial margin, daily why they are coming to me and asking money? So mark to market margin, in this case, the initial margin is kept as security deposit kept aside. Clear? Now take this example. Futures contract price today. Futures contract price today. Futures contract price means what? Price of the future. Price of the future means what? You are either agreeing to buy or agreeing to sell something on a future date. Clear? Future contract to buy. I have taken the example as future contract to buy. Price of futures is 350 rupees into 20 shares per lot into 10 lots. Understand these numbers? 350 rupees per share, 20 shares in one lot and totally 10 lots. So total amount is 70,000. Total amount is 70,000. Now imagine price of futures tomorrow from 350 it became 360. You had agreed to buy at 350. Market already jumped to 360. So 360 into 20 into 10. Okay, 360 rupees. 360, yeah. So it becomes 72,000 now. 72,000 it became. Now what happens? 2,000 rupees is called as mark to market and 2,000 rupees will be received. 2,000 rupees will be received. For whom? For you or the other party? For us. Why? Because I agreed to buy at 350. I agreed to buy at 350. That means somebody else has agreed to sell at 350. So now because that guy agreed to sell at 350, when the market goes up, for him it is a loss. For him it is a loss. When market goes up, for me it is good because I am going to buy at 350 only. So therefore 2000 mark to market 2000 will be received. It will be received. We'll see the other thing also. Imagine tomorrow, price of futures tomorrow. I should have made it as 340, right? 340. Price of futures tomorrow is 340. Now what happens? 340 into 20 into 10. What is the value? 68,000. What is the value? 68,000. Now what happens? Mark to market 2000 will be paid. Okay. Now this is not a continuation situation. If it was continuation situation, this should be sitting as 4,000. Okay, this is not continuation. I am telling tomorrow if price goes to 360, what is going to happen? And tomorrow if price goes to 340, what is going to happen? If tomorrow price goes to 360 and day after tomorrow price goes to 340, no, then 72,000, you are already sitting at 72,000. Then it became 68,000. So 4,000 will be the amount that you are going to pay. Is this clear? This is what if the price goes to 360, what if the price goes to 340. Is this clear, guys? This is mark to market margin. Now tell me one thing. In this 2000, quietly they could have taken from 76,500, no, which they didn't do. Therefore, whenever there is mark to market margin, it is usually assumed that the initial margin is going to be just be a security deposit. It will just be a security deposit. Clear? Now, the next margin that we are going to discuss, maintenance margin. What is it? Maintenance margin. Now, if you take this as our margin, okay, this is our initial margin. I put this money. Whenever maintenance margin comes into question, that means mark to market is not there. Daily they are not taking anything. This only is kept as the margin money. This is the amount that I have. Okay, initial margin is there. Now you lost some money. Some loss happened. It will keep reducing. You got some money, this will keep increasing, no problem. In this only we will play. But this limit is called as maintenance margin. That means if it goes below this limit, it has to be refilled to the level. Which level? Now imagine this initial margin is 100 rupees. Maintenance margin I have kept it as 20 rupees. Okay. Now imagine because of some loss and all I have touched 90 rupees. Nothing. They are not going to talk anything to you. Nobody is going to call you or nobody is going to ask you anything. It went to 80 rupees. Nothing. No one is going to talk. It became 15 rupees. Moment it become 15 rupees. What we should do? Should I take it from 15 to 20? Should I take it from 15 to 20? Moment it breaches this level, no. Now you have to take it from this level straight to initial margin. Is this clear? So if it breaches this maintenance level, that time you are going to refill to take the total margin money to initial margin. Is this clear? Yes. Now, this concept was introduced to avoid mark-to-market payments and daily payments. Why they introduced this? Like already I'm putting money, that only you adjust. If at all you feel that it's like in stock valuation and all, no, you have something called as safety stock. Somewhere in costing, in intermediate, you would have studied something called as safety stock. That means safety stock and reorder level, there is a connection. So what we do, safety stock is basically, I'm like telling that, let me recall. Okay, safety stock is basically what? Imagine my lead time. Lead time is what? If I order today, it will take me 6 days for the delivery to come. So safety stock will be 6 days stock. Clear? So it is not exactly like safety stock, but something like that. Does that mean that all the time I'll be sitting on safety stock only? No, I'll be sitting at a higher level of stock. So therefore, if it breaches that, fill your margin to the initial margin. And this maintenance margin and mark to market cannot go hand in hand because they are two different concepts. Clear? Additional margin. I took 13,500 from you. Okay, initial margin 13,500. Just random number. Okay, this 13,500 was based on what? 13,500 I took based on what? I took 13,500 based on mu plus 3 sigma or 3 standard deviation. Based on that, I derived a number called as 13,500. And in this, there was standard deviation, risk of fluctuation, market has gone bad. Then I realized, boss, this risk of fluctuation is nothing. Some next level fluctuation is happening. I feel now I need 20,000 to safeguard. So therefore, in such cases, the broker can come to you and ask for additional margin. Due to sudden volatility, initial margin might seem insufficient. Clear? This is your concept of initial margin and all the other things. Now, let's just quickly see whatever is discussed here. Maintenance margin. As soon as you breach the maintenance level, you have to refill it back to the initial margin level. We saw that in the diagram. Additional margin. When exchange predicts higher volatility ahead, then it calls for additional margin, which is in addition to the initial margin, so as to cover the additional risk posed by major events such as election results, etc. You had some initial margin and suddenly election results are going to be declared in 10 days. Volatility will be crazy. That time that initial margin might not be sufficient. You might lose it in minutes also. So therefore, they said increase the level to this particular level. It can be due to anything. It can be because of geopolitical situations and election results, budget announcements, anything. Okay, this is your discussion on margin. Yes, I'm just keeping it on screen for some time. 30 seconds, 1 minute. If you have any doubts, please clear it. Twenty-four. I'll keep. If initial margin will be there. That won't be there. No, additional margin can be there. Mark to market is reaction to the market. Additional margin is prediction of the market. Mark to market is your reaction to the market. Market changed. Pay 500 rupees. Pay 1000 rupees. Additional margin is I am expecting market to be bad in future. So pay additional margin today. Okay, additional margin will be there. If maintenance margin is there, mark to market will not be there. And if vice versa, but additional margin will always be there. Okay, again I'm explaining, mark to market is what? Reaction to the market. And additional margin is prediction of the market. Clear? And this is very rare. Additional margin is very rare because they would have already done their math. So with that, we are done with the situation there. Now we'll come backwards. Uses of derivatives we'll see later. Before anything, we have to learn time value of money. Yeah, here it is. Time value of money. It's going to play a crazy role in our chapter, time value of money. Calculating the value of futures and all, it's going to be fully based on time value of money. First one is discrete compounding. discrete compounding. But what is going to be important or new concept for you is continuous compounding. Now, I will explain to you with this diagram. Understand discrete compounding. Just focus fully on this diagram here. Discrete compounding is basically, imagine this is my timeline. And till now what we saw till now, every time we saw that it is going to be compounding 3 months. It is going to be compounding every 6 months. So we took that time interval, we calculated. That means this money, it got compounded over here, it got compounded over here, and so on and so forth. It will keep getting compounded. If compounding frequency is given, okay, if compounding frequency is given, that time what we do, future value is equal to present value into 1 plus r to the power of n, and this r is always r per annum. This r is per annum always. But imagine when we are talking about r per annum and its compounding frequency is semi-annual, r divided by 2 you'll do. Now your period is 6 months periods, and this will be n into 2, 6 months periods. Clear? If it is per month, then you will do r divided by 12. Okay, this is time value of money which we are doing. So per annum, per month, per quarter, semi-annual, anything can happen. If it is per annum, then this n is there, no, number of years it is. If it is per month, then this n is there, no, it is the number of months. If it is per quarter, no, then this n is there, no, this is number of quarters. And if it is semi-annual, then this n is number of semi-annual periods. Clear? Now, sir, compounding frequency is not given. Very good. Then it is simple. Present value is equal to 1 plus r into n divided by 12. Compounding frequency is not there. Now you don't have to do to the power of and all. To the power you don't have to do, because there is no compounding only to do to the power. So what you will do that time, 1 plus r into n divided by 12. N divided by 12, why? You want interest of only 3 months. Basically it's your school ka PTR formula. In school you had one simple interest PTR formula, no? P into T into R. P is principal, T is time. Okay, let's say 6 by 12, and rate is 12% per annum. That is exactly what is going to be inculcated over here in this particular formula. Is this clear till here? These two we already knew. Just a revision we have done of discrete compounding. Discrete compounding is when compounding frequency can be given also, and compounding frequency is not given. If it's not given, we'll follow simple interest, otherwise we'll follow compounding interest. Clear? The main thing is what we have to learn is continuous compounding. That we have never seen only till now. Continuous compounding. Now see, continuous compounding over here is basically it is getting compounded every second. Every second the money is getting compounded. Okay, continuous compounding means compounding every second. Actually, the meaning of continuous compounding is compounding every second. But you know, institute, okay, they don't follow the literal meaning. So institute treats daily compounding also as continuous compounding. Actually, daily compounding is not continuous compounding. So in the question, if you see compounded daily, that means they are using continuous compounding technique. If they tell daily, then it is continuous compounding technique. Clear? Now, if they tell anything other than the continuous compounding, if they tell the word enough, you will be using like this. That time future value is equal to present value into e to the power of rt. E is exponential values. For that you have to see the table. The table will be given in the exam, or the values will be given in the exam. Earlier days they used to give the table itself. Logs, other things, everything on sheet they used to give. Now they don't do that. They give you the values. But when they give values, no, they'll give 3-4 extra also. You pick which one you want. Okay. Now E is equal to, E value is fixed. We are not going to derive this E value and all. E value is 2.71828. Now I want to just prove this thing to you guys. What it means. Little below in the material, I have given the E values. Little below means lot below, I think. Where is it? Here. E values. Can you see E values here? Now, here only in the material, I just want to explain to you. Okay, just understand this. Let's say I have 100 rupees today. I have 100 rupees. I want to know, and the rate of interest is 12%. Rate of interest is 12%. I want to know after 3 months, what will be my value? What will be my future value? What will be my future value? Normal situation. Per annum. What will I do? 100 into 1 plus. Okay, why I am doing 1 plus? Because I want to know the future value. 1 plus 0.12 divided by, or 0.12 into time, no, so 3 divided by 12. I just want to tell, because I saw some AFM papers where they're making this mistake. You cannot do adding this and then doing into 3 by 12. Okay, this I am not going to teach. This is called as BODMAS. Okay, students are making that mistake in AFM papers. They are taking 1.12 into 3 divided by 12 and then multiplying into 100. You will get some other number only in some other area. You will get 28 rupees. You will get 28 rupees. Are you getting my point? Your value is supposed to increase, no? So, follow BODMAS. First you do this. So, 0.12 into 3 divided by 12 plus 1. 1.03 into 100. 103 rupees. Can you see it becoming 103 rupees? Basically, what did you do? 12 rupees per annum, 3 rupees per quarter. 3 rupees you added, it became 103. This is the most simple way of calculating future value. Now imagine they have told you, okay, 12% per annum compounded 6 months, every 6 months. It is getting compounded every 6 months. Then what will you do? You will take 100 into 1 plus R. R is 0.12 divided by every 6 months means divided by 2. Divided by 2. That means we have how many half yearly periods in the year? 2 half yearly periods. Now we are in 1 half yearly period. 3 by 6 or 1 by 2. Are you getting my point? Rate is for half yearly period. We want for quarter. So in the half yearly period, the quarter is half the half yearly period. So therefore it is 3 by 6 or 1 by 2. So now how will you calculate this? 100 into 1.06 to the power of 0.5. How to do this? Only one method we have, that is square. 1.06. 1.06. Do it. Take your calculator. Are you getting 102.96? You put in a lot of effort into the calculator, but that was not required. You put in a lot of effort into the calculator, but that was not required. 1 by 2 is square. Maths, day 1. 1 by 2 is square. Didn't get it. 0.15 is square, no. 1 by 2 is square, no. 1 by 3 is cube, no. 1 by 4 is to the power of, root of 4, no. Okay, 102.96. Now please tell me, why did this reduce? Normally I was getting 103. Here, why am I getting 102.96? Because it still didn't get compounded. It will get compounded at the end of 6 months. Are you getting this? It will get compounded at the end of 6 months. Now, if I go to the next situation, what was my next situation? Continuously compound. Every second it is getting compounded. 100 into e to the power of RT. E to the power of RT. E is how much? We have to find. R is how much? 0.12. 0.12 to the power of 3 by 12. That means 100 into e to the power of 0.03. 0.03. Can you see the value that is given for 0.03 over here? So basically 103.05. I'm taking for a very small number, that's why. Can you see when it is continuously compounded, it will surely be more than the normal one. Every second if it is compounding, every second it is getting compounded. So the value, can you see, it is 103.05. Is this clear? This is what the exponential table does. Okay. Now we get 0.025 and all that we will see later. Okay. We'll not worry about that now. We'll see that later. But this was just to prove that future value under normal methodology and compounding methodology and continuous compounding methodology. When we see, when it is continuously compounding, the value will be higher only. Clear? Now we need to know all this because the value of futures is decided based on time value of money. And when you're calculating the value of future, you're always going to be seeing in the question this word called as continuous compounded, continuously compounded. Clear? Any doubts with this calculation? Now this table, no, either they'll give as an additional sheet or at the end of the question paper, one full table will be printed with the values. Otherwise, they will tell you value for 0.03, 0.04, 0.05, 0.02. 4 values are given. Now you choose and pick which you want. Is this clear? That will be given to you in the exam. So there is no requirement to by heart these numbers and go to the exam hall. And you can't also do by heart. When you go there, it will become 0.04, 081 will become 0.04, 018. Okay, you can't buy it. I mean, don't even think of by hearting. Why would you do that? Is this clear till here? And again, to explain to you, at 0, 0, can you see it was 1? At 0, 0 means what? Present value is equal to future value. No interest rate. Clear? Yes, this one we have to get it. I have given till 0.900% I have given. It will not go till there. Just for our understanding, I put everything into the material. Now, let's get back to where the time value of money was there. Discrete compounding. Compounding frequency is given. This is the formula. Compounding frequency not given. This is the formula. And continuous compounding, present value into e to the power of RT. Clear? Exponential value, just for your knowledge, what is the value of E? It is 2.71828. Let's not worry about it. Just read it and leave it. R is rate of interest compounded continuously. Obviously, R will be given in the question itself. Always use per annum rate in place of R. T means time period. N divided by 12, N divided by 365, anything. Okay. Per annum rate you are going to put in R. And then you will get it into the time period that you want. Yes. Any doubts with this one? Mergers, derivatives, just getting started. Yes, let's go further. So we've discussed the time value of money part, types of margin we have discussed. Uses of derivatives. Before we go into the technical part of derivatives, now we have to understand what is the use, what is the need for these derivatives and all. Okay, main thing or first thing is hedging. What is hedging? Now, there is one guy over here. Okay, he has, let's say, gold with him. He has gold with him and he has a fear that the price is going to go up. He has a commitment. He has a commitment after 6 months. After 6 months, he has a commitment and he had planned that he will sell this gold that time and he will fulfill that commitment. He is planning to construct a house or something like that. That time he was planning to sell this gold. Now, if there is a situation like that, he has a fear that this will go up. He'll keep quiet. He will not have fear only, he'll be happy. But if he has a fear that the gold price is going to go down, now he's scared. Now the gold price is sitting at 15,000. He feels it will go to 13,000. He feels it will go to 13,000. So he'll go and ask, boss, can you enter into a contract with me to buy my gold after 6 months at 15,000? Nobody agreed. But at 15,200, somebody agreed. Now you're like, sir, already it is going to be a bad situation for this guy. Already the situation is bad. Okay, what if it goes to 16,000? He doesn't care only. He doesn't care what will happen if it goes to 16,000, 17,000 and all. He is only protecting himself from this fall. He is protecting himself from this fall. It might go to 13,000. He is protecting himself with 15,200. Now imagine if someone is telling him, I will buy gold from you only at 14,800. Will he still enter? Will he still enter? Yes. Will he be making 200 rupees risk, 200 rupees loss already? But still he'll enter because this is called as hedging. That means he's protecting his risk. Instead of losing 2,000 rupees, he is okay with losing 200 rupees. Is it clear? So the first reason or first use of derivatives is to protect from any kind of price fluctuation. Now you can protect yourself from price fluctuation if you already have the underlying asset with you. Now, one person, when all this was happening, no, he was quietly sitting in the corner and seeing, like this and all they are doing. And he has no gold at all. He goes and enters into a contract telling that after 6 months, I will sell gold to you. After 6 months, I'll sell gold to you. Just entered into a contract. Because he feels after 6 months, the price will go down. That time he will buy gold and he will sell to this guy and make profit. So did he have any money with him? No. That is called as speculation. That is called as speculation. Clear? So you saw that some people are using it to protect themselves from risk. You don't have anything to protect yourself from risk, but you saw that there is an opportunity to make profit over here. You get into speculation. And basically what you are doing, what people are doing in the stock market with futures and with options is completely speculation. It is not that they have the underlying asset and they are planning to sell it or planning to buy it in future. It is completely speculation. So it is a one-sided transaction entered into in the hope of making gains. You are entering into a transaction telling that I want to buy or sell in the hope that in future one day you will make gains. In our view, if our view holds good, then we make gains or else we incur loss. So imagine this fellow entered into a transaction telling that I will sell gold to you. I will come after 6 months and I'll sell gold to you. This fellow will not ask him question. Do you have gold today? He's like, you will come and sell gold now after 6 months. Okay. He is expecting that the gold price will be 13,000. If it is 13,000, he'll go buy from somebody at 13,000, go and give it to this guy because he has a contract already to sell it. He'll sell it at 15,000, whatever the price is, and he'll make profit. Now imagine on that day, the price has become 16,000. What will he do? Still he has to buy at 16,000, go and give it at 15,000 and incur the loss. So if our view, our planning or our thinking is going proper, then you will incur profit, otherwise you will incur losses. Clear? This happens on a day-to-day basis. In the stock market, right, this happens on a day-to-day basis. What people will do, they saw that the Sensex has opened over here. Okay, then they feel, okay, Sensex is going to fall. They will enter into options or futures telling that we will sell. We will sell. If it falls, that time what they will do? They will sell at this price because they already entered. But imagine something doesn't go under our control. It increases. Then gone. You have to still sell at this price. So this is the thing that you will lose, or this is the thing that you will get as profit. Clear? This happens on a day-to-day basis and a lot of people lose money. A lot of people lose money, yes. Now, example. Bullish. Main why people lose money is because they play with emotion. Right? As soon as they put no, 90% of the time no, it will be profitable only. But they'll be waiting for that more profit situation. Then it will fall. If you are happy with content and if you're not greedy, right, you can actually make money. It's like, Warren Buffett. Warren Buffett told that stock market is there because of donkeys. He said stock market is there. Forget running. It is existent because of donkeys. And he said donkeys are common man. Who is donkey? Common man. He said common man is donkey. Because common man plays with emotion. He sees that silver price is going up. Oh, it's going up. Then he'll be like, oh, it will go up more and he'll buy here. He'll buy here. After many people start buying. No, after that, it will fall. It is falling. Oh, it's falling. He will sell everything that he has. Because of that, market runs. Okay, what those institutional investors or proper investors, what they do is, at this point, they will sell everything that they have. They will sell everything or they'll go short also. Okay, then when it reaches this point, now this current situation, no, the bigger investors are all buying. They're accumulating. They know one future date will go up. Okay, when COVID hit, everybody was selling. Whoever had lifetime savings, they were selling. But who had money, they were buying. Clear? They were buying. So that is the situation with market. Okay. Example, you see over here, bullish 45,000. Bullish means what? Bullish means what? Studying AFM, you have to know these terminologies, bullish and bearish. Bullish means what? The market is expected to go up. Market is expected to go up. Bearish means what? Market is expected to go down. Okay, now there is a logic why they have come up with these terminologies. Bull and bear. There is a logic why they have termed them as bull and bear. Bull and bear, why they told, if a bull is attacking, right? If a bull is attacking the front person, it always lifts that person with the horns. The horn is there, and it will take that person with the horns, it will push that person upwards. That is why when market goes up, it's called as bullish. Bear, when it attacks, it will take its paw and hit that person from top, because bear is already at your height or taller than you also sometimes. So it will stand and will hit you and put you down. That is why the terms bull and bear came into this stock market terminologies. Clear? So 45,000 bullish. Nifty as of today, it is 40,000. If you are bullish means, then you are going to buy. Bullish means you are expecting it to go up. No. So today you will buy. And that terminology also is called as, they might just use these terms in the question, go long. Go long means what? You're going to buy. Go long means you're going to buy. Okay, if you are bearish, that means you are expecting it 35,000. It is sitting at 35,000. If you are bearish, that means you're going to expect the market to fall down. That means you will sell. You will sell. And for this, also the other terminology that you can find in the questions is short. They have shorted 5,000 shares. That means what? They have agreed to sell 5,000 shares. They have longed 5,000 shares. That means what? They have agreed to buy 5,000 shares. Is this clear? It can be applicable for spot. It can be applicable for futures. It can be applicable for options also. Clear? Today, longed 5,000 shares. That means what? Today we bought 5,000 shares. Okay? 5,000 shares long on 3 months future. That means what? We agreed to buy. Are you following these terminologies? Today, shorted 5,000 shares. That means what? Today we sold 5,000 shares. Entered into a future contract for shorting 5,000 shares. That means we entered into a future contract to sell 5,000 shares. So these terminologies doesn't mean that it is for any time period. It can be used in any time period. So you just have to understand, if it is bullish, that means you're going to buy. If they tell buy, obviously you're going to buy only. And if they tell long, that means you're going to buy. If they tell bearish, that means you're going to sell. If they tell sell, obviously you'll sell only. And if they tell short, you're going to sell. We saw in 2 cases in the previous chapter, shorting situation. Remember that A plus B wala question. Okay. So you got minus there. When you got minus, that means they sold that share that day and put that money into this thing. Okay. Note, speculation in forward futures may result in either gains or loss depending upon the movement of share price. That is obviously. Next one we are going to see is arbitrage. What is, where are you going? Huh? Bidadi, which client, man? The one client who was there in Bidadi, he has left. He has made his own country now. One big client was there in Bidadi, you know. You know that very big client. They attacked his office itself. After that, he left the country and he started his own country, which has a passport, currency. He is always happy guy. Always happy. His name only is that. Nityananda. Yes. But watch, okay, before you come to tomorrow's class. Arbitrage. What is arbitrage now? What is arbitrage? I sat over here and I saw this guy is selling gold at 50,000 rupees. And I just looked this side. This guy is selling gold at 51,000 rupees. Bought from him, sold there, made profit without doing anything. So, arbitrage opportunities exist. Okay, when the price in the market is not fairly priced. When it is not fairly priced, no, according to what should have been the value, if it is not that much, then it is arbitrage opportunity. So, imagine, for example, even you saw that you wanted to buy 1 kg of onion. 1 kg of onion when you wanted to buy, you did some crazy calculation. You said the value of onion tomorrow should be 9 rupees per kg. Value of onion for tomorrow should be 9 rupees per kg. You went and checked what is the value of onion. They were selling it at 8.5 rupees per kg. Bought it, kept it. Tomorrow it became 9, sold it. This is arbitrage. Bought it, kept it, tomorrow it became 9, you sold it, that is completely arbitrage. Clear? Arbitrage is a two-sided transaction entered into at the same time to earn risk-free arbitrage gains. So when one person is selling at 50, one more person is selling at 51, you enter into contract with this guy telling that I will buy from you at 50, I will sell it to you at 51 without doing anything. When this set off with each other, 1 rupee profit sitting you will make. Clear? Now, the process of buying a security in one market and simultaneously selling an equal product in another market to profit from pricing difference, hence a two-step process is followed. Okay, how arbitrage will happen, we will see. They are telling first step to do arbitrage is calculate the fair future price. For today, we'll be doing only that much. For today, no, we'll be only calculating fair future price. I don't think we'll finish. We'll go even beyond this today. Okay. So first we'll try to understand what is arbitrage. Arbitrage is what? It happens in Forex market also. Forex market, what you know? $1 you are getting in London market at 95 rupees. $1 you are able to get in let's say Singapore market at 96 rupees. So what will you do? You see this opportunity, buy it at 95 in this market, sell it at 96 in that market. That is in Forex. Here what you are seeing in arbitrage, you enter into buying and selling. You enter into contract to buy and sell. But because of the price difference, you make profit. And going to our original example of Guru and Aditya putting that bet, there also arbitrage is there. There also arbitrage is there. You know what? Bookies. Okay. There are one bookie will be there who is having a rate. RCB versus Delhi. Okay, let's say like 1.5. 1.5 means if RCB wins, you will get 1.5 rupees. If Delhi wins, you will get 3 rupees. This is how it works. Now, some other bookie might be there. RCB versus Delhi, 1.6. Can you see that price difference there? So, someone sitting, no, they can make profit even in that. But don't go to do. Okay, don't go to do. People lose money, right? And otherwise, police might raid your place also. If you're sitting and doing this arbitrage in betting, right? Then you will be in the newspaper and all. Holding all the laptops and the cash and 2 car keys. I don't know why. The car key will always be there in the seized photo. All laptops will be there. Mobiles will be there. And 2 car keys will be kept with the cash. That is like motivation for the person, no, who is seeing. If I would see it, I would get motivated to do that crime, right? Because I'm like, oh, so much cash, and again 2 cars also he has made. That means how much cash he has made. They should actually not display all that, no. They should just tell this fellow got caught, and they should hit 5, and then they should show that fellow with the, like, what do you say, broken leg or something. Then people will be like, oh, we should not do this. Yes. Now calculate fair price. Now try to understand what is arbitrage. I need to calculate the fair price. Once I get the fair price is the true value. True value is also called as equilibrium values. When I get the true value, then I'll compare with the market. Oh, it's not matching. That time I have opportunity for getting profits. Today we will not even bother about getting profit. We will bother only about calculating the fair price. Now forget about arbitrage. ICAI might just ask a question. Compute the value of future. First chapter, mergers and acquisition. Compute the value of company. Security valuation. Compute the value of equity share. Compute the value of bond. Compute the value of business. Then, if you're talking about portfolio, compute the value of the portfolio. Return was computing the value of the portfolio. So basically, first, if you're talking about futures, we need to compute the value of the future. Today's discussion is only this much, and we might not even finish that much. Now, determination of fair future price. Remaining points, whatever is discussed, no. Whatever is written over here, we'll come back to that once we have learned how to calculate fair future price. Determination of fair future price using cost to carry model. Very, very simple. Okay, this to calculate this now, it is very, very simple. It is given by one formula. I'll tell you what is the formula. Spot price. Spot price. If I am telling I want to enter into a future contract, at least today's price I should be willing to pay. So that is the bare minimum, spot price. Plus, there is a time delay. When there is a time delay, there is a time value coming into picture. So interest. There is interest. Now imagine I am telling that gold. Okay, I'll give you the example of gold, then I'll apply it on shares later. Okay, I'm telling that gold, I want to buy gold from you after 3 months. And today's gold price is, let's say, 15,000. Now this 15,000, after 3 months, the price will go up, no? So the price going up is based on interest rate only, interest factor only. So you'll add interest to that. You'll add interest to that. Now you're like, boss, you told me you will come and buy gold from me after 3 months. Now 3 months, I have to safeguard this gold and I have to store this gold somewhere. For storing, there is a storage cost. Just giving me the time value is not enough. Just giving me the interest factor for 3 months, it's not enough. I have to store this. So the next thing that is going to get added is storage cost. Next thing that is going to get added is storage cost. Is this clear? Now we're like, okay. When he told all this, you agreed. But then you told, boss, 3 months gold is going to be under your custody. Now 3 months, you can just give this gold on rent it for some wedding. Imagine ornaments we are talking. You're like 3 months, you can just give this gold on rent for weddings and you can earn income from that. So that is unfair now. All the costs related to the gold you're taking from me, but the income related to the gold, you're keeping it in your pocket. So minus the income when we do, this is the base formula to calculate future value. This is the base formula to calculate future value. And obviously, if I'm calculating the future value, okay, for us it is called as futures. If I'm calculating the value of future of a share, this is not there. Of a share, what storage cost you will have? Now, storage cost is there actually for share also. It is stored in a demat account. There is some demat charges which are there, but they are very minimal. They are very minimal and it doesn't depend on whether you are holding 1,000 shares in your demat or you are holding 1 crore shares in your demat. It doesn't depend on that. That is why the valuation technique when we are applying, no, the storage cost is ignored for shares. Clear? So if you ask me in reality, is there a storage cost? 100% it is there. But it doesn't depend on the amount you are storing. No. Therefore, the storage cost is ignored when you are talking about shares. Clear? What is this minus income? Dividend. Minus income for shares will be dividend. Is this clear? So we'll see this example and we'll see many more examples. Specified asset, let's say Infosys, delivery after 3 months. Okay. Agree to buy, agree to sell. Either you are agreeing to buy or agreeing to sell. If you are agreeing to buy, you should go and buy. That's called as delivery. If you are agreeing to sell, you should go and sell. That is also called as delivery. Delivery means execution of the contract. Delivery doesn't mean you are going to deliver the goods or you are going to buy the goods. It doesn't mean that over here. Delivery means execution of the contract. Now, what should be the agreed future price? This is our question. Correct? Now, one more example. Let's say we wish to calculate 6 months future price on gold, which is currently in spot at 60,000. Okay, gold is sitting today at 60,000. 6 months future price. So what you will do, spot price you will take, add 6 months ka interest, 10% per annum for 6 months. No need to calculate, just understanding of the terminologies. Plus storage cost, let's say 100 per month was the storage cost. So 600 rupees you added storage cost. This fellow was renting the gold to others and making money every month. So minus income, say 50 rupees per month, 300 rupees income you are going to minus. This whatever you got, this is your fair future price. This is your fair future price. If you saw that the future is actually 62,000. You saw actually they are trading the future at 62,000. Now you saw that it is undervalued. Now you saw that it is undervalued. Okay, that we will see later. First we will learn to fix the fair future price. What the arbitrage opportunity and what actions you will take, we will learn it later. Sorry. Is this clear till here? Now, determination of fair future price. Various situations we have to see. To the commodities, I'll go later because 90% of the questions are on stock. 10% of the question only is on commodities. Commodities are gold, wheat, anything it can be. Okay, 10% only on that. So first we will focus on the stock. Now, when we are talking about stock, no, there are multiple situations which we have to understand. In stock, case number 1 is non-dividend paying stock. There is a stock which you are planning to enter into future and it is not going to pay any dividend. Second one is dividend paying stock. Dividend paying stock, there are two things. One, dividend value is given in absolute terms or dividend value is given in percentage. Percentage is not on face value, dividend yield is given. Dividend info is given in absolute terms. Case 2, There we have to see how to calculate fair future price. And third one is dividend info is given in dividend yield percentage. There we have to see how to calculate fair future price. So three cases we saw. When we are calculating for shares or stock, there is no dividend. That is one case. There is dividend, but dividend is given in rupees. That is second case. Dividend is there and dividend is given in dividend yield percentage. That is the third case. Clear? Commodities, when we are seeing investment commodity is case 4 and consumption commodity is case 5. What is investment commodity? Gold, silver and all. What is consumption commodity? Wheat, rice, all those is consumption commodity. Clear? Yes. Now we'll go into case 1. Underlying stock providing no income. See the formula. Future price always. This formula only is the base. If you have understood this formula right, then you don't have to see these cases itself. Okay, if you have understood this formula, you don't have to see the cases at all. So what we are going to do over here, spot price, you have to get this properly, spot price plus interest plus storage cost minus income. Here there is no storage cost because we are talking about stock. Okay, therefore there is no storage cost in case of shares since underlying provides no income. Okay, first case was what? Underlying is not going to provide income, so this also is gone. So only spot price plus interest is what we are going to discuss. Did you understand this? Our case 1 was what? The company is not going to pay dividend. If company is not going to pay dividend, income is gone. And if company is not going to pay dividend or pay dividend, storage cost is not there for shares. So if I do spot price plus interest, I'll get the future price. Now there is discrete compounding that can happen, continuous compounding that can happen, done. Then we go into case 2. Just with formula, we can't understand anything. Now, full focus, fair future price. This is something that we already saw. Spot price plus interest plus storage minus income. Clear? Fair future price can be for stock or for commodities. When it is for stock, there can be a non-dividend paying stock. There can be a dividend paying stock. If there is a dividend paying stock, there is dividend value given in absolute terms. Directly they told you 2 rupees per share is dividend. Or dividend value is given in dividend yield percentage, not dividend percentage, dividend yield percentage. Dividend yield percentage, directly they said 2%. Directly they said 2%. That means on the market price, 2%. If they tell dividend percentage, it is on the face value 2%. Clear? That time we are not going to worry about this one. Then commodities, we have investment commodity and consumption commodity. Is this clear till here? Now first case, no dividend is received. First case is what? No dividend is received. Now you have to keep your calculator ready and learn how to do this. Okay. There is one company called as Bamboo Limited. Spot price is 100 rupees. Spot price is 100 rupees. Interest rate is 12% per annum. Compute the value of 3 months future. If they tell only this much. Compute the value of 3 months future. Compute the value of 3 months future. This is the most basic. I'll tell you how the language will be. Compute the value of 3 months future. Compute the value of 3 months future when the interest is compounded semi-annually, compounded quarterly, compounded monthly. That can be the second situation. Third situation, when will you use that E values when they tell it is compounded continuously compounded or daily compounded also. ICAI considers it as continuously only. Now, when I'm in this situation, what is the formula? F is equal to 1 plus R into N divided by 12. Clear? This is basically your simple interest formula. How much is the spot price? Spot price is 100 into how much is the rate of interest? 1 to 12% into 3 divided by 12. When you do that, you'll get 103. When you do that, you'll get 103. Clear? Any doubt with this? Next, what can happen? 3 things can happen in every situation. 1, without any mention of compounding. Second one, with the mention of compounding. Third one, continuously compounded. So second situation is if it is compounded semi-annually. I think this is the number which we took for our example also that time. If it is compounded semi-annually. So don't go to calculate. This is square root. 1.06 take square root into 100. 1.06 square. If you take into 100, if you do, you will get 102.96. Clear? That in this chapter, right, that calculator technique of root 12 times is going to save your life many times. Okay, it's going to come a lot of times. You will get so adjusted to that when you complete this chapter. So clear till here. What is the third situation? First of all, where am I? You have to understand where are you, what are we calculating? Fair future price. We are calculating fair future price. Under that, situation number 1. First of all, we are calculating for shares. Situation number 1, no dividend. Because there is no dividend, our calculation is ending over here only, peacefully. Because our entire formula is spot price plus interest plus storage cost minus income. Correct? Because there is no dividend, income is gone. Because there is shares, storage cost is gone. So our formula is only this much. That's why for the spot price, I'm directly adding interest and I'm getting the answer. Is this clear? The third situation there, if we want 2 months future, I didn't even go to the discretion over there. Okay. We directly jumped into a situation. If we want 2 months future, initially what was my future? Future was for how many months? 3 months. Okay. Now if it is 2 months, see over here. How did I make it 0.06? It was 0.12 divided by 2, semi-annual compounding. So now you'll do 2 by 6. 2 by 6 will become 1 by 3. 1 by 3 is basically cube. 1 by 3 is basically cube. Cube root, sorry, not cube, cube root. How will you do this? Take your calculator. 1.06. Took 1.06. 12 times square root. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1. Correct? Into 1 divided by 3. Then plus 1, add the plus 1. Then 12 times into is equal to. Are you getting 1.0196? Multiply this into 100, 101.96. Multiply this into 100, 101.96. This is the value. This is the value. Is this clear till here? So this is if you have 2 months future. When it was 3 months future, can you see it was 102.96? Why it was more here? Because you have added interest for 3 months. Here you are adding interest for 2 months. Are you getting this? This is how you are going to calculate the value of future. Okay. In this formula, no. Future value is equal to present value into 1 plus r to the power of n. If it is per annum, you'll just do it like this. If whenever there is a compounding within the year, no. Imagine compounding is happening monthly. Then what happens? This r, no, we want per month. This n, no, we want months. This n, we want number of months. So if it is this r, if it is quarterly, then this r we want per quarter. And this n we want number of quarters. And if it is half yearly, this r we want half yearly interest rate. And this n we want number of semi-annual periods. Is this clear? That will give us the future rate. Yeah. We are calculating future value. You know. Basically, the futures contract the formula which is there, that is using time value of money formula. Okay. So never get confused with when you are doing rate, no. If you have rate, divide by the compounding effect, not the future. Future is 2 months future. Don't divide by 2. Divide by the compounding effect. Compounding effect is 2 because it is semi-annual. Not because it is 2 months future. Because compounding effect was 2. Here also, when it was 3 months future also, it was divided by 2 only. Clear? Because it was semi-annual. Then what you are doing? You got semi-annual period rate 1.06. Now you want what? In the semi-annual, imagine you are asking for a 6 months future. Straight away, 100 into 1.06. Answer is done. If you are asking for a 6 months future, 100 into 1.06 because the rate is for 6 months. But in that 6 months also, you want for how much months? 2 months. So 2 out of 6. So 2 divided by 6. That means actually, if it is for 6 months, this should have been 1, no? 1 6 months period. Correct? Now, in that 6 months, if you want for lesser time period, this should not be 1, no. It should be less than 1. When you do 2 by 6, what you're getting? You're getting 33.33. 33.33 you're getting. Can you see? That means you are not having the full 6 months period. That is the value. Clear till here?
So, this 102.96, we are calculating the future value. So, on the basis of this amount, we are entering into the agreement of this.
No. We saw this amount 101.96 is the correct value of a 2 months future. I went and checked in the market. It is showing 103. that means there is an opportunity for arbitrage. Okay, that means there is an opportunity for arbitrage. Sitting, I can make profit. Okay, that is the situation. So to do arbitrage or to do hedging or just to do speculation, you always need to know what is the real value. If you are doing hedging, no, you usually don't check this real value and all. You have to save yourself. If someone is telling he will give it for 103, you'll go and buy it at 103. Clear? So usually, see, from examination point of view, if you are asking me, if ICAI can ask you a question, compute the value of futures. Compute the value of futures. They can also ask you a question, compute the value of future and determine whether any arbitrage opportunity exists. So you'll compute, you'll compare, then you'll do the arbitrage. No. To compare, you have to see today for a 2 months future, what is the price? Today for 2 months future in the market, if I want to buy Infosys shares after 2 months, that future is trading at what price? I calculated for that the correct price should be 101.96, but it is trading at something else. That means there is a chance for making profit. There is a chance for making arbitrage gains. Clear? Without incurring anything. You will not incur loss at all. If it is arbitrage, there is no way you will incur loss. You will always be profitable. Okay, but right now, we are only going to compute the value of futures. Okay, basically, if they forget about arbitrage and all, if they tell valuation, determine the value of future, then you are going to compute just the value and leave it over there. Okay, now, next, if we want 8 months future, this will solve your doubts of time value of money. If you want 8 months future, what will happen now? I will still be having 0.06 only. By for me, the compounding period is what? Semi-annual. So my semi-annual interest rate is 0.06. Add 1 to that. So it will become 1.06. Why we are adding 1? Because we want to compound the value. So 1.06. Now, N is what here? N is semi-annual periods. Semi-annual periods. We want it for little more than one semi-annual period. We want for 8 months, but the semi-annual period is 6 months. So therefore, 8 by 6, I think you will get 1.33. So basically, your exponent over here will be 1.33. Clear? Same calculator technique. What will you do this time for calculator technique? 1.06 12 times square, then minus 1 into 8 by 6 plus 1. Okay, then you will do into is equal to 12 times. You should get 108.08. Try. You should get 108.08. Yes. Clear? Didn't get okay, you forgot to add 1. If you don't add 1, you will get a very, very small number. Yeah, it will go to 0 when you put is equal to into is equal to 12 times. Yes. Online is. Oh, suddenly online crowd has increased. Starting when we started, it was less. For? No, that is basically 1 plus R by M, that is the frequencies, into R into M. But don't need. It's basically to divide, basically. Let's not put, there are enough formulas here. Okay, there are enough formulas here. You'll see, when we go further, you'll see. When you go to options and all, there are some extra formulas that will come. One person is there, Black-Scholes, he will come and trouble us. Okay. We'll see that. The Black-Scholes is exactly like Sharpe's optimum portfolio. Black-Scholes, whenever we go to Black-Scholes, just remember it. There also there are some irritating formulas that is exactly like Sharpe's optimum portfolio. Hasn't been asked for a very long time. That means it is due. Yes. So this is the situation if you want a 8 months future. Got? Yes. Now next, what if it is continuously compounded at 12%? If it is continuously compounded at 12%. Now what will you do? F is equal to S into e to the power of RT, right? E to the power of RT. 100 into e to the power of, now you don't have, see, now you don't think, sir, that 6 months is still there, 6 months gone. That 6 months compounding is gone. This is daily compounding. In fact, every second compounding. So now it will be 0.12 into, how many months future you want? 3 months. 3 divided by 12, e to the power of 0.03. E to the power of 0.03. You can keep that e table open in your notes. Okay, e to the power of 0.03. And for that, the value is 1.03045. Multiply, you will get the answer. In the exam, this number will be given in the question itself. Clear? First part only we finished. What is the first part? When there is no dividend. That is why it was fast. You know why it was fast? Because spot plus interest only I did. Plus storage cost is never going to be there. Minus income I never did because there was no dividend. Now the second part is what? When there is dividend. When there is dividend. Clear? So dividend is received in absolute terms. Case 2, see, case 2, underlying asset providing income, dividend income in absolute terms. That means they are giving you the dividend income in absolute terms. Let's not read what is written over there. We'll discuss with the example itself. The formulas and all remain same thing. Then we'll go and read that. It will make more sense to us that time. Okay, it will make more sense to us that time. Now, focus. Full focus. Listen. Dividend is received in absolute terms. This is the second situation which we are going to, under which we will have to calculate, or we might have to calculate the fair future price. Now, Bamboo Limited, spot price is 100 rupees. Okay. Spot price is what? Today's price in the market is 100 rupees. Interest rate is how much? 12%. Future we want for how much? 3 months. Dividend of rupees 5 per share is declared in these 3 months. Whenever the ICAI gives no, that dividend is declared in these 3 months, dividend is to be received within 3 months. Now you should actually have one confusion. Should be like within 3 months means, is it the first month, second month or third month? But ICAI natural assumption is whenever they tell it is within 3 months, it is at the end of third month. This is the natural assumption that you are going to take, that is, it is at the end of third month. But otherwise, whenever they use that language within 3 months, it should be anytime. No, within 3 months means even tomorrow it might be. Are you getting this? So when they tell 5 rupees per share dividend is declared in these 3 months, that means third month end. In these 3 months means what? Third month end. Clear? Now, what I have to calculate? Don't even look at this side. Don't even look at this side. Okay, just focus on this side. Today's rate is 100 rupees. Now, when I wrote the formula, it looked very simple and beautiful. Spot plus interest minus dividend. But this minus dividend is happening where? There. Where is the dividend? There, at the end of 3 months. We have to bring that dividend here. That means we have to calculate the present value of the dividend. So, dividend present value you see over here, 5 rupees dividend. I have taken 5 into 0.9709. How did I get 5 into 0.9709? 12 rupees is the interest rate for 1 year. So you want interest rate for 3 months. 1 divided by 1.03, because we don't have continuous compounding and all that. When that comes, it will change. Okay, you get 0.9709. Did you get this? So therefore, 5 rupees dividend which you are going to get at the end of 3 months, it's only 4.85 today. So remove the income. Income has to be removed, no? Remove the income, you got 95.15. What is 95.15? What is 95.15? 95.15 is the present value of spot rate minus dividend. This one I have to take it to the future now. So 95.15 into 1 plus 0.12 into 3 divided by 12. Simple interest, you got 98. You got 98. Do not even look at this side. Do not even look at this side. Just focus on the left side. What did we do on the left side? On the left side, we took the spot rate. Our entire formula, we don't have to go in order. Okay, interest has to be added, yes. So what I did, I took that 100 rupees, that dividend which was there, I brought it to today. I brought the dividend to today by taking the present value of the dividend, because dividend is at the end of 3 months. So that time I got the present value of the net amount. That net amount, I have to take it to future. I took that 95.15 into future and I got 98 rupees as a future value. Is this clear? No? How can it be your fair future price when you have not even added interest? What is the entire formula for fair future price? Spot rate plus interest, forget storage cost, minus income. Now here you have done only minus income. Where did you add the interest? Interest you have not added. So when you add the interest only, you will get the fair future price, which is 98. Yeah, here we are adding the interest. Interest adding, you will see three types. All the scenarios, you will see three types. That is, if they don't tell you when it is compounded, then normal methodology. If they tell you when it is compounded, then you will use the future value, present value formula. When they tell you it is continuously compounded, you will follow the E values. Clear? Did you understand the left hand side? Now, can you think of something else? Sir, simply the dividend which was sitting at the end of 3 months, I brought that dividend to today. Then I subtracted it. Then the remaining amount, I took it to future. Instead of that, let the dividend sit there only. Let the dividend sit there only. I'll take this 100 rupees to the future. Now both are sitting in future. There I'll subtract it. Possible? You'll get 98 that time also. This is alternative 2. This is alternative 2. Why I am teaching you all alternatives is, in exam, sometimes we don't know which one we can use. Okay, so therefore alternative 2. Now, if at all the question is like this, whichever you're comfortable, you do this. Here, what did we do? Spot rate is 100. Forget about that income. Income is at the end of 3 months. I want price at the end of 3 months. So I took this 100 rupees only to future and I got the price as 103. But remember, in my formula, I have not removed the income yet. Remove 5 rupees, you'll get 98 rupees. Is this clear? Is it clear till here? Now, what we saw in this, we saw when dividend is there, but it was simple interest. We saw when dividend is there, but simple interest. Clear? So till now, what and all case, see, case 1, case 2, case 3, case 4, yeah, but inside that case, there are sub cases. So first situation was, I am trying to find the fair future price of the stock. When finding the fair future price of the stock, my formula is same. Spot price plus interest plus storage cost minus income. Storage cost is not there only for shares. Now, there I saw a company which is not going to give dividend in the next 3 months. So therefore, income also not there. There I saw 3 situations. When the interest rate given to me is normal, simple interest. The interest rate is given compounding. So you have to see how much, what period it is compounding for. Then the third one we saw when it is continuously compounded. Clear? These 3 interest calculation techniques will be there in every methodology. Okay, now here what we saw that one thing I can do is I have to subtract income for sure. But where is income sitting? 3 months later. Where is spot sitting? Here. So what I can do? Bring that income to today. Now both income and spot are sitting over here. Subtract, do the subtraction part. Then take the net amount to future. You will get the future value. Taking the net amount to future means adding interest. Clear? Other than that, what I can do? I want the future price on third month only. And dividend is already sitting at the end of 3rd month only. Take this spot price to the future. Then subtract it over there. You will get the same answer. You should get the same answer. Okay, you might get 0.01 difference in some places or 0.02 difference because of rounding off. Otherwise, there is no excuse for not getting the same answer. Clear? Clear with this, everyone? Yes. Now, we'll take the next example. Spot rate 100. Interest 12%. 6 months future. Now, first you should focus on this interest is given in what terms? Normal terms. Not compounded 6 months, not continuously compounded, normal terms. Then you want future price for how many months? 6 months. Dividend of 5 rupees to be received after 4 months. Ayo. Dividend of 5 rupees is to be received where? After 4 months. Now just now we saw if it is after 6 months, I got one shortcut. Take this 100 rupees there only, subtract, over, done. Now 3 situations can happen over here. 100, you take it to 6 months future. Take the dividend also to the 6 months. There you subtract it. Or bring the dividend to today. Subtract it and take everything to 6 months future. Now understand this. I want the price over here of the future. my spot is sitting over here. My dividend is sitting over here. My dividend is sitting over here. My option, 3 alternatives I have over here. My alternative 1 is bring the dividend to spot. Bring the dividend to spot, minus it. Then take everything to future. Okay, that is one option. Another option is take the spot to 6 months. Take the dividend to 6 months and subtract it over there. Third option is take the spot to 4 months. Subtract the dividend over there. Then take the remaining amount to 6 months. Did you get this? 3 alternatives are there. Okay, understand this. Now, what you can get confused in the exam is always one thing, that is this 6 months is not compounding effect. This 6 months is the value of the future after 6 months. This interest rate, if they don't tell anything attached to this, that means it is simple interest only. I mean, simple interest which you are going to take. No compounding information only is given to you. Basically, simple interest means what? It is compounded annually. Simple interest means basically it is compounded annually. Every year it gets compounded. Okay. If it is within the year, then they have to tell you information. Now, alternative number 1. Just look at the left hand side. Don't even look at the right hand side. Don't bother about the right hand side. What did I do in alternative number 1? Spot rate is 100. 100 rupees is sitting where? Today. Here. What will I do? I'll bring that dividend to today. Where is the dividend sitting? At the end of 4 months. So 5 rupees dividend at 4%. How did I get this 4%? 12% per annum. 4 by 12. So 4% for 4 months. 12% per annum. 4% for 4 months. So what did I do? 5 into 1 divided by 1.04. You will get 0.9615. So now did your dividend come to the present value? Dividend came to the present value. And dividend is an income. Income has to be subtracted. Remove it, you got the net effect. Now this net effect is as of today. You want the future value. Future value is after how many months? How many months? 6 months. So take it to 6 months. Basically you did 95.19 into 1.06. Why 1.06? 12 months interest rate is 12%. 6 months interest rate is 6%. So when you do that, you'll get 100.9. Clear till here? Anyone has any doubts? Is this clear? So what did you do? Computed the present value of dividend. So can you see? Actually, entire thing is time value of money here. Entire thing is a game of time value of money. So this is your period. You are here. You want to reach here. But dividend is sitting here. So what did you do? Dividend you have to subtract. But when you are subtracting dividend, no, both of you have to meet at the same point. So bring the dividend back. Now both are at the same point. Subtract. Take everything to the future. Here what we are going to do, see, next one. Spot rate is how much? 100. Okay, 100 into 0.12 into 6 by 12. What did I do? I took the spot rate to the future. How much did I get? 106. Now what happened? Spot which is there, it came and sat at 6 month period. But there is a dividend which has to be subtracted. Where is the dividend? At the 4 month period. Now you have to take the dividend forward. You are not going to discount it. You are going to compound it. You are going to take the dividend forward. So dividend 5 rupees. Okay, 5 rupees into 2 months. No, only 2 months. From 4 months to 6 months you have to take it. So into 1.02 actually. How 1.02? 12% into 2 by 12. Okay, now you got the dividend which has become 5.1 when it went forward. When you subtract it, you will get 100.9 only. When you subtract it, you will get 100.9 only. Is this clear? Your homework for the day is, I will share this obviously. Okay, whatever we have solved, right? You have to just see the question, solve it with, let it be, if you have to press 12 times root also, no problem. Solve it and see, compare the answer if you are getting under all alternatives. Clear? Now, third alternative we had, what was that? Take the spot to 4 months, subtract the dividend, take the remaining amount to 6 months. Here what we did, alternative 1, what did we do over here? Bring the dividend to present value, minus it. Now both are spot and dividend are sitting together. So what you did, minus it, take everything to future. Here what did we do? Took the 100 rupees spot to 4 months. So sorry, took it to 6 months. Dividend was not at 6 months. Dividend was at 4 months. Took that dividend to 6 months. There we subtracted it. Clear? Alternative 3. Alternative 3. spot rate is 100. Take the spot only to 4 months. So 0.12 into 4 divided by 12, that means 1.04. So 100 into 1.04, your value became 104. Your value is 104. Now this is sitting at 104. Dividend, what will you do with this dividend? Dividend, is it sitting at 4-month period only? So dividend need not move here because we only came where dividend is there. So minus the dividend, you got 99. But 99 is a 4-month future period. We want 6 months future period. So take this 99, 2 more months ahead. That means 1.02 you do to this 99, you will get 100.98. You are getting 100.90 over here. Okay, you are getting, I think, 100.98. If I am not wrong, 99 into 1.02. Yeah, that is fine. Okay, small difference is fine, no issues. Did you understand what is happening over here? Yes. This is the situation when dividend is given. When dividend is given and the dividend is there in different time periods. And we have only seen the simple interest. What we have seen? Only the simple interest. Clear? Let's go to the next example. Any doubts till here? Anybody? Yes. Let's go to the next example. Spot rate is 100. How much is the spot rate? 100. Interest is 12% per annum, compounded semi-annually. Interest is 12% per annum, compounded semi-annually. Interest is semi-annual. Future need not be 6 months. Future, 4 months. Can you see? Future ka period and interest ka compounding has no connection with each other. This is the mistake. Why I am repeating is, this is the mistake that students make in the exam. They get confused that, oh, interest rate also should be taken as 4 months. No. Interest rate based on the interest rate percentage compounding effect which is given. Here it is semi-annual. Clear till here? Now, spot rate 100, will keep constant spot rate of 100 only. Okay, interest rate 12%, compounded semi-annually. That means for me, the rate will be always 1.06. 6 months. 6 months interest I want and 6 months period I have to see. Okay, dividend is 5 rupees. Compute the value of 4 months future. Now, did they tell you anywhere in this question, when are you going to get dividend or where are you going to get dividend? No. So your natural assumption is that you will get the dividend at the end of 4 months. Dividend is already sitting there. Now you have to reach there. That's all. Or you have to bring dividend here, subtract, and you have to reach there. Clear? 2 options only we have. Only when dividend is in between, no, then you will have the third alternative also. Did you understand this? This is the situation. This is the situation. This is the current value, that is spot, and this is the future value. If dividend is already sitting there, you have only 2 options. Bring the dividend here, minus it, and then take everything to future. Or let the dividend be there, you take the value to future and then minus it over there. Only if dividend comes in between, then you have the third alternative which can be there. Clear? Now, compute the value of 4 months future. Alternative number 1. Okay, alternative number 1. So ignore the right hand side. Ignore right hand side fully. Focus only on the left hand side. Focus only on what? Left hand side. Spot rate is 100. Spot rate is 100. Now I cannot take 1 divided by anything in the calculator. Okay, I cannot take 1 divided by anything in the calculator because, tell me one thing, how many months interest is this? 6 months interest. So 6%. 6% I want for how much? 1.06 into, sorry, 6% for 4 months, right? 4 months. So 6%, so 1.06 into 4 divided by 12. So it is actually 3.53333%. 3.5333% you need. So if you do 1 divided by 1.03533, okay, you'll get some number into 5. If you do, you'll get close enough answer, 4.82. Okay, otherwise if you want more accurate answer, you know always discounting means present value, future value divided by 1 plus r. This is the discounting formula. That's why we do 1 divided by 1.1 always to get the number and then multiply it. Okay, so here let's try to understand. 0.12 is the rate divided by 2. Why did I divide by 2? Because it is semi-annual. Now you have the semi-annual rate. In semi-annual, you want for how many months? 4 months. So that's why it becomes 4 by 6. It becomes 4 by 6. Is it clear? That time you will get the present value of dividend as 4.81. You get the present value of dividend as 4.81. Now there are 2 ways to calculate this. two ways to calculate is basically directly take 6%. 6 into 4 by 6 you do. 6 into 4 by 6 you do. You'll get how many months? Wait, 1 divided by 0.04 into 5. Yes, you'll get 4.81 directly. That is one way to do it. Other way to do it is what? Now you have to do in the calculator, you have to do square root 12 times. Okay, don't do that. You can directly take, you need 1.04, no. So take in your calculator 1 divided by 1.04 and press is equal to, you'll get some number, multiply that fully multiply that. Don't go to take 3 decimals or 4 decimals. Fully multiply that into 5, you'll get 4.81 because in this example, I have taken full decimals. Because I have not taken one more step, no, of writing the number. When I write the number only, I'll take 3 decimals, no. When I get it in the calculator, what I'll do, I'll directly multiply full thing. That is why if you take full numbers, you'll get the accuracy of 4.81. What did you do now? You brought the dividend to present value. So remove the dividend. Now you have 95.19. What should you do now? Take this 95.19 to future. How many months future? 4. Don't get fooled by the 6. How many months future? 4. 6 is the interest rate. Clear? So 95.19 into 1 plus R. R is 0.06 over here. So it will become 1.06 to the power of what? 4 by 6. To the power of 4 by 6. Now you don't have a calculator technique. To go to future, you don't have calculator technique. You have to use the root symbol 12 times and calculate. Clear? So basically it is 1.06. What? End of 4 months. That is what I told. This is like what? You are behaving like that guy. You are behaving like that guy. There one guy was there. Okay, very nice guy. Okay, he was extremely nice guy. Okay, very nice person. Okay, so he got settled in life. After getting settled in life, no, he thought now I have to get married. So he went to see one girl. He saw one beautiful girl. There many people came for competition. In that he won. He won the competition and he decided to marry that girl. Now he's like, okay, life is set. I don't have to worry about anything. But his stupid father, no, he gave promise to his wife. Because of that promise, this fellow had to go to forest for 14 years. They thought, okay, at least their privacy, I'll have my own life I can lead. But no, brother also came along. Then, okay, fine, brother, okay, you stay in another room. We'll have our own privacy. But no, brother didn't listen. Brother went and chopped one foreigner's nose. One foreigner lady was there. He went and chopped that foreigner's nose itself. Now that that lady, she had a brother. She will come to take revenge. He will come to take revenge. No, he came to take revenge, kidnapped this fellow's wife and went to foreign country. Now this fellow, even though he was smart, he was not rich. So he didn't know where they went. Then one bird told him they went this side. So they followed that direction. Then they reached sea. Now he doesn't know how to cross the sea. Luckily, bird helped. Now monkeys helped him. Okay, they constructed one bridge. Lot of effort they went there, constructed bridge. Then there again one more war. Then he got his wife back. After all that, if someone asks, what is the relationship between these two people? How will that person feel? Like that only I felt now. Okay. Now, clearly I told you, 4 months when they don't tell you anything about dividend. With the dividend, they don't tell any added information. That means dividend is assumed to be received at the end of the future ka period. Not 6 months now. 6 months is only for interest rate. Clear? Who was the better person? The Indian or the foreigner? Who was the better person? Think. Okay, this is homework for you guys. I am not going to teach that now. Different people have different perspectives. Okay, when you see from one person's angle, that is, they feel the Indian is the better person. There is another book only written on entire Ramayana, written from Ravana's angle. If you read that book, you feel that fellow is right actually. And there is one point which I felt that, because of that point, he is actually a good person. See, when this fellow Rama reaches over there, no? Yeah, that is one thing. But when Rama reaches there, there is a war. Now there is a war. For war, no, they wanted one muhurta. Okay, one time. For that time, no, there is only one Brahmin in that country who is so scholar. That is Ravana. So they called him only. Now imagine I am going to a war with you. And if I give you a good time, then you will win that war. When I come there, I will obviously give you wrong time. Rahu Kala I'll give you. You take that Rahu Kala time and you conduct the war. Now, obviously, I'll give you wrong timing, no. But he gave correct timing only. He's like, in ethics and in this position, I have to do this work. When I go into war, that position, I will fight the war. So that fellow, when he entered war only, he knows he's going to lose the war. So like that, actually, when I was in Chennai, no, one student actually gifted me one book. In that book, that they told the entire Ramayana from Ravana's angle. So if you read that, right, it's some Asura or something, the name of the book. Okay, if you read that book, you will feel, oh. Basically, the moral of the story is, in every story, there is a bad person and good person. Now, in your story, you are the bad person. I mean, you are the good person. But from the other person's angle, if you see, you are the bad person. So you cannot come to a conclusion there. But did you understand where dividend is received? But yes, at the end of 4 months, clear? So now what did we do over here? We brought the dividend backwards, 4 months backwards we brought it, and then we subtracted it. Now just remember this one concept, okay? It will help you in all alternatives. Dividend has to be subtracted from spot rate when both are at the same timeline. So here spot rate was in time 0, this was in month 4. So we brought it back to time 0 and we subtracted it. Then we will take the value to time 4 because we want what? The futures are 4 months. So here what we are doing, 0.12 divided by 2, you will get 1.06. 1.06 to the power fraction can never be done. 1.06 to the power fraction cannot be done at all. So you have to use the root symbol 12 times. Okay. 4 by 6 is basically 0.66 period. 0.6667 period. You have to do it. Use the calculator. Use the 12 times root symbol. You will get 98.96. What is our only other alternative? Sir, how without square root we got 4.81? Without square root. This one. Okay, this is what you know. You have to calculate present value factor. No, this is 12%. 12% divided by 2, what happened? 6%. Okay. Sorry, my bad. No. What I did is, over here, directly I did 12 into 4 by 6. 4 by 12. 12 into 4 by 12. You will get a close enough answer. But actually, the correct thing to do is taking the 12 times root only. Okay. You will get, what I did is, compounding I ignored because compounding has not happened. You will get the same answer here because compounding has not happened. Compounding will happen 6 months. I am inside that 6 months period. So till now compounding has not happened. So I'll get 4 months only. No, I don't want to teach this shortcut. No, these shortcuts don't exist. Okay, this is when you're lazy, you will get these ideas. Don't do that. Okay. Don't do, you use the root symbol 12 times only and calculate. Okay, you should get 4.81. Now, yes. Now, see over here, what is the other alternative? Take the 100 forward. Take the 100 forward. 100 is there. Take it forward for how many months? 4 months. 4 by 6. Okay, that time you will get 103.96. Root symbol 12 times, you will get 103.96. Now, what will you do? Dividend is already sitting at 4 months only. Minus 5, you will get 98.96 here also, 98.96 here also. Is this clear? Are you following this? Now, can we finish one more? 6 minutes are there. I think we should finish one more. Okay, because if I finish one more, then only thing that will be remaining is continuous compounding. Now here what we did? We did normal interest, dividend at the end, dividend in middle. Okay, now we did compounding interest, dividend at the end. So dividend in the middle also if you complete, then we'll have only continuous compounding, their dividend at the end, dividend in the middle. Clear? So imagine in the same example, dividend is receivable at the end of 3 months. Whenever dividend is receivable within the timeline, we will not have 2 alternatives, we'll have 3 alternatives. What are the 3 alternatives? First, spot is 100. Bring the dividend to spot. Bring the dividend to spot. You have to bring the dividend back by how many months? Here I bought the dividend back by 4 months. Now I have to bring the dividend back by 3 months. Yes, 4.86. No shortcuts. 12 times root I used. Okay, 4.86. Clear? So what did I do? I took the present value of the dividend. Whenever the dividend and spot price are sitting at the same timeline, what we will do? Subtract. Subtract it, you got this value. Now what will you do? You take this for how many months forward? 4 months. This we have done in the previous also. But the value is different. 95.14 into, you got 98.91. There you are getting how much? 98.96. Okay, 98.91. Is this clear? Why that time difference you are getting? Why here you are getting more? Because dividend was already sitting at the end of 4 months only. Here it is at the end of 3 months. Is this clear? First alternative. What is the second alternative? Second alternative is dividend, you keep it there only. Okay. Take the 100 rupees directly to 3 months. Okay. Directly to 3 months. Okay. I've switched the alternatives. Okay. Directly to 3 months. Now you got the present value. I mean, you got the future value at the end of 3 months. Dividend is already sitting at the end of 3 months. Minus the dividend, you got the value at the end of 3 months. But you are not looking for a 3 months future. You are looking for a 4 months future. So take this forward by 1 more month. That time you will get 98.91. Take this forward by 1 more month. You will get 98.91. Is this clear? What is the only balanced alternative that I have? Take the spot to 4 months directly. Take the dividend to 4 months and then you subtract it over there. That is the one alternative that is remaining. That is over here. You take this 4 months forward. You take this 1 month forward. You should still get 98.91 only. Clear? This was the alternative. Now after this, I think, see, continuously compounded example we have to discuss. That should be it. Okay, that should be it. Now we'll go and see the concepts that we have discussed there. See, where is it? Underlying asset. Dividend income is given in absolute terms. Spot price plus interest plus storage cost. Storage cost goes away. Income. So step 1, calculate present value of dividend discounted. Step 2, calculate net test. Net test is what? Spot rate minus present value of dividend. Add up interest for 6 months gives the future fair price. 6 months is taken as example. Note, only those dividends that fall due before the future contract expiry dates are considered. Obviously, no, I'm calculating future for 4 months and dividend is receivable at the end of 8 months. Does it matter to me? No. So in this 4 months, if I get any income, I have to subtract that income. Next, discrete compounding, just the formula. You know how to do the all that. Continuous compounding also, only the formula. Dividend and all, we will see later. The formula, forget about it. Okay, we will see how to apply that formula for continuous compounding tomorrow. Is this clear? So you have to revise till here everything. Till here everything you have to revise. There is no other option. And you have to come to tomorrow's class. Okay, after revising, come to tomorrow's class. Imagine after revising just sitting at home. Okay, come to tomorrow's class and we'll go forward with our concepts. Yes, that should be it, guys. See you tomorrow. Bye-bye. If you have any doubts, please let me know. Yes, welcome back. Let's continue with derivatives. And let's quickly revise whatever we have done yesterday. First of all, what is derivatives? It's a financial instrument which actually has no value if there is no underlying asset. It derives its value from an underlying asset, and an underlying asset can be stocks, currency, gold, bonds, commodities, etc. Majorly, we are going to talk about stocks and also a little about commodities. Now, forwards, futures, options, and swaps. What is a forward contract? It's a contract between two parties decided today, and it is going to be executed in future. It is going to be bought or sold, and at a predetermined price also which is decided today. It is a customized contract. Now, when it is little more regularized, okay, that time there is futures contract, the standardized contract, where not two parties are there. There will be a third party. The third party is the intermediary, okay, who is going to overlook. And here it is standardized. It is not going to be customized, because lot size, number of shares, everything will be decided by the party, intermediary. Okay, otherwise futures and forwards, same thing it is. Only difference is here there is an intermediary, there is no intermediary. Options. What is an option? It is a contract between two parties where they can buy or sell at a future date. And if they want to buy, they can buy. If they don't want to buy, they can not buy also. So there is an option to take or not take. Forwards and futures, we have seen the difference. Okay, forwards is customized, individually tailored, and the futures, it is as per the stock market, and 2 parties are involved in forward and 3 parties are involved in futures. Credit risk, any party can default in forward, but in futures you can't default because always there is a guarantee of performance because there is stock market in between. Then margin, no margin and all concept only in forwards, but in futures we have a concept of margin. That means the stock market takes some money from you beforehand. Bid rate, ask rate, we know. Bid rate means what? The rate at which I can sell as a customer, and ask rate is the rate at which I can buy as a customer. Okay, from the gold shop point of view, bid rate is the rate at which he is going to purchase, and ask rate is the rate at which he is going to sell. We'll see bid rate, ask rate more in forex. Clear? Time value of money, we saw discrete compounding. So if just that, it's going to be a huge role again today also, the time value of money factor. If they don't tell anything and only tell you interest rate 12%, then you're just going to take future value or the forward rate. Okay, forward rate is equal to present value. For us it is spot into 1 plus R into N divided by 12. Not audible. Online guys, am I audible? Can you hear me? You sure? Yes, audible. Only one person is having issue. Just log out and log in. I think it's network issue for you. It's audible for others. So just check your network. Yes. So if they don't tell anything, it's going to be forward rate is equal to spot into 1 plus R into N divided by 12 directly. It's like simple interest formula. If they tell compounded every 6 months, compounded every 3 months, then what will you do? Forward rate is equal to S into, it is basically present value, future value formula, S into 1 plus R to the power of N. If it is going to be, now for example, if it is 12 months, if it is compounded 6 months, then this will be divided by 6. This will be divided by 2. And what you're seeing, N is there, no, it is every 6 month period. N what you're seeing is 6 month period. So if it is 3 months, then it is going to be divided by 4, and whatever N you are going to see, that is going to be every quarter, number of quarters. Clear? And if it is told continuously compounded, what we will do? We will take future value is equal to spot into e to the power of RT. R is always per annum rate. In that T you give the effect of T. Now T is what? T is the time period for which you want the forward contract or the futures contract. Now E values will be given in the question. Okay, E actually is equal to 2.71828, but E values will be given in the question either as a table or specific values will be given. Now types of margin. I think from there we have margin. Yes, first, what is initial margin? It's like a security deposit. Average daily absolute change of Infosys is given. So how much initial margin they will take? Mu plus 3 sigma or 3 standard deviations. Clear? Mu is what? Average annual daily change. That they will give in the question itself. Standard deviation risk also they will give. Just multiply it into 3 and that will be your initial margin. And initial margin will not be for one share and all. Okay, it works in lots. In the market, it works in lots. So if they tell there is a lot size, minimum lot size of 300 shares, that means you have to buy at least one lot, and that one lot contains 300 shares. So 255 into 300 shares, 76,500 will be your margin. Clear? Now, mark to market margin. What is mark to market margin? Mark to market margin will be there when there is no maintenance margin. If there is maintenance margin, there is no mark to market because it will get adjusted with your initial margin itself. Mark to market margin is every day you will see the price went down, you have to pay or you have to receive. Clear? For example, here the futures contract, we had purchased it at 70,000 and it was a contract to buy. We had entered into a futures contract to buy at a particular price, that is 350. When it became 360, what? I am going to still buy at 350. So therefore the 2000 mark to market I will receive. If at all the price would have been 340, the mark to market I have to pay. Clear? Maintenance margin will be there when there is no mark to market. Instead of every day taking money and giving money, that becomes a huge transaction. So they said, let's set the bar. The bar is initial margin and let's set a smaller limit. That limit is maintenance margin. If at all it reduces inside this, no problem. But the moment it touches the maintenance margin, it breaches the maintenance margin, that time you have to refill till the initial margin. Clear? Additional margin has no connection with either of this. It will always be there if required. Additional margin is if there is some new kind of volatility we have seen in the market, then the broker or the stock exchange can ask you to fill in more money, okay, to cover for that volatility. You decided no, 3 standard deviations. Now the standard deviation only changed in the market, so obviously you need to put more money. Then we saw time value of money, discrete compounding. Okay, it gets compounded at a particular time every year. Usually if they don't tell you anything and just tell 12%, that means it is compounded annually. Now, continuous compounding, that means every second it is going to compound. But what we have to understand, ICAI, if they tell compounded daily, that means it is continuous compounded. Otherwise, it is not actually. If they tell compounded daily in real life, it is not. You are going to use the same formula over here. Not this one. Where is that? This one. You are going to use this formula only. Only thing is n will be 365. Actually, but for exams, you are going to take this as e to the power of RT. Fair future price. After that, we went forward and we discussed all these margins and all. Then uses of derivatives. What are the uses of derivatives we have seen? One, there is hedging. Hedging means what? Protecting yourself from the risk. Other one is what? Speculation. Speculation is what? You don't have any risk. You just play in the market. Buy and sell. You make profit from there. Okay. Then we go into arbitrage. What is arbitrage? What is arbitrage? You see that it is not properly priced. You find the value of the future and you see that it is not properly priced. When it is not properly priced, you have an opportunity to make profit without even taking any risk. Clear? And when we started with arbitrage, first thing is I need to know what is the fair future price. I need to know what is the correct value. I can see something is traded there. I need to know the correct value. So we started learning about calculation of fair future price. Clear? Then we will see this other part of arbitrage later. We'll not worry about that now. Now, determination of fair future price. What is the basic formula for fair future price? We have to discuss spot price plus interest plus the storage cost, which is not there for stock, minus income. Income will be dividend for stock. Clear? Then determination in various situations. We went into stock. In stock, we have one case. What is the first case in stock? We have when there is a no dividend paying stock and there is a dividend paying stock. In dividend paying stock, dividend value is given in absolute terms, or in dividend paying stock, dividend value is given in dividend yield percentage. Then we went into commodities. There is investment commodity as well as consumption commodity. Then we are in the first situation when no dividend is received. When no dividend is received, what happens when no dividend is received? You take your formula gets shortened. It is going to be spot price plus interest. That's it. There is no adding of storage cost. There is no minusing of income. Now, we saw first situation, that is compounded annually. Then we saw another situation, compounded semi-annually. And then also we saw compounded 2 months. Sorry. We also saw when it is continuously compounded. Now, dividend received. I think we finished this also in absolute terms. Okay, dividend value was given in absolute terms. What do we have to understand? We have to see the placement of dividend. Where is that dividend sitting? If the dividend is sitting at the end of the term which we want, nothing. You take the value to the future and subtract the dividend. Or you bring the dividend to the present and then subtract the dividend and take the entire net value to the future. If dividend is sitting somewhere in between, then what you do? Either you take the spot to the dividend, you then net it off over there and take everything future. Otherwise, bring the dividend backwards, take everything to the future. Or take the spot to the future, take dividend also to the future, and then you set it off. Okay, this is what we had discussed. I think we have finished till here, right? Dividend, I think continuous compounded we have not seen, if I'm not wrong. Yeah. Was it till this 100.98 we had seen? Yes, continuously compounded we had not seen. So we had seen in dividend received in absolute terms, we saw two situations. One is when dividend is received at the end, otherwise when dividend is received during the time. And we saw when the interest rate is compounded annually and interest rate is compounded within the year. Yes, now we'll go into the third example. Spot rate is 100. Interest rate is 12% per annum. What if they tell you continuously compounded? That means we have to use E values. Clear? And here we are talking about dividend. How much is dividend? 5 rupees. Absolute terms, compute the value of 4 months future. Compute the value of what? 4 months future. So what we can do, we have two options in front of us. What are the two options? Dividend, they said only dividend. That means this dividend is at the end of 4 months. So either bring this dividend to today or take this present value to future and then subtract the dividend. Is this clear? Now, how will you bring this dividend to today? 5 rupees you are going to get. Correct? You have to get the present value. You can't do that in the calculator, no, directly, because you have to use e values. So what you will do, 5 divided by now 1 plus, I think we have finished this, right? Component semi-annually we finished, didn't we? Till 98.91 we have finished. No, we have to, from here, continuously compounded we have to see. This is done, yes. So spot rate is 100, dividend is 5, and continuously compounded, compute the value of 4 months future. So this dividend, we are assuming that it is at the end of 4 months. It is at the end of what? 4 months. Now, spot rate 100. How will I bring this dividend to the present value? Dividend divided by e to the power of RT. Correct? 1 plus e to the power of RT, but in e, no, already 1 is added. Usually, if it was continuously compounded, I would have written 1 plus r to the power of n. If it was continuously compounded at the end of the year, I would have written 1 plus r into n by 12. Correct? In e to the power of RT, you don't have to worry because e values are after adding that 1 only. Okay, after adding that 1 only, the e values are there. It's a compounded value only that is given of rupee 1. Of rupee 1, the compounded value. So what I am doing, e to the power of 0.12 into 4 by 12. E to the power of 0.12 into 4 by 12. So what you are going to do today, you are going to keep those e values always open. Where is that e values? Yes, you will need this e values. Keep this always ready. Let me keep it separate so that so we'll need these e values today. Clear? So e to the power of 0.04. What is the value that is sitting over here? 1.04081. So directly you will go and you will write 1 divided by 1.04081. So therefore you take your calculator, 5 divided by 1.04081, you will get 4.5 divided by 1.04081, you are getting 4.80. What scroll down? Oh, we are still in that, stuck in that same part. Okay, so you are getting 4.80. Yes, 4.80. Remove it, you got the value. Is this the final value 95.2? No, 95.2 is just net of dividend. Now you have to take this 95.2 to the future. How many months future they are asking? 4 months future. So 95.2 into e to the power of RT, that is 0.12 into 4 by 12. We already know 1.04081. Take it, you will get the answer. Other option that we have in front of us, what is the other option? Bring that dividend, okay, keep that dividend there only, just take 100 to the future. That time you will get 104.081. Remove the 5 over there, still you will get the same answer. Close enough, 0.01 decimal, that's fine. Leave it. Is this clear? Okay, so if actually it is continuously compounded, you have less work. You directly take the number, put it over here, done. Now, what if dividend is receivable at the end of 3 months? If dividend is receivable at the end of 3 months, now you have a problem. Actually, in the exam, you don't have a problem. In understanding, you have a problem. In exam, what you can do? You can take any of the 3 alternatives. Okay, any of the 3 alternatives. Sometimes the data might not be there to bring it 1 month forward and all that. Okay, so you have to see which one is available. You can take that, but just try to understand every single alternative. We have 100 over here. Okay, dividend is receivable at the end of 3 months. So 0.12 into 3 divided by 12. That means it is e to the power of 0.03. E to the power of 0.03 in your table. What is the value for e to the power of 0.03? 1.03045. So what you will do, you will take 5 divided by 1.03045, you will get 4.85. Subtract it, you got your net value. Take this net value forward. How many years, how many months forward will you take it? 4 months. 1.04081, that time you will get 99.03. This is the value of your future. First option. Second option, just take the 100 rupees, multiply it into 1.04081, you will get 104.08. Dividend is sitting at the end of 3 months. So take the dividend 1 month forward. Dividend you take 1 month forward. So for 1 month, the rate is 1.01005. So take that and it will become 5.05, subtract, you will get the same answer. What is the third option that we have right now? Take 100 rupees 3 months forward. That means e to the power of 0.03. Okay, 0.12 into 3 by 12, 0.03. So 100 into 3 months, what was the rate? 1.03045. So that becomes 103.05. Here only subtract the 5 rupees. That time you will get 98.045. Take this 98.045 1 month forward, and that time you will get the 4 month future value. 98.045, 98.05. Take it 1 month forward, you will get 99.03. Is this clear till here? Yes. Now, open your notes. Okay. From all the things that we discussed yesterday and from all the things that we discussed today, you have to solve this on your own. Now, let's say current spot rate. Current spot rate is rupees 250. Current spot rate is rupees 250, and the interest, from here question starts. Find future contract fair value. Find future contract fair value if interest rate 15%, 4 months. Okay, second one, interest rate 13%, compounded monthly. Whatever I am writing as T is, I want a 4 months future ka value. Third, interest rate 12%, compounded continuously, 4 months futures. Next, interest rate 16%, compounded quarterly, T is 4 months, dividend received today 3 rupees. This is the fifth one. Sixth one, Wait 1 second. Make all these dividend amounts 10 rupees. 3 will be very small. Wherever you've written dividend, make it 10 rupees. Last one you keep it as 8 rupees. Yes, try it yourself. Otherwise you are seeing directly solutions. You feel it is easy. If anywhere, any this thing you get stuck, go to the next one. I don't think you should get stuck anywhere where there is no continuous compounding. Continuous compounding 1 or 2 you might get stuck. Just leave it and go to the next one. Just confirming, spot price is 50, no 250. See here, spot price for all the questions is 250. Please try it on your own. First four, just check if you got these answers. First one, 262.5. Second one, 261.01. Third one, 260.20. And fourth one, 252.89. 4 divided by compounded monthly or what? Quarterly, right? Compounded quarterly. So number of quarters are 4. So you'll divide the rate of interest by 4. 4 divided by 12 by number of quarters are how many? It'll be 4 quarters, no, in the year. Now 3 months, it's little more than 1 quarter. So 4 divided by 3. Why 4 divided by 12? If you do 4 divided by 12, you're telling that it is monthly compounding, no? Are you getting it? See, for example, if it is compounded monthly, let's say compounded monthly, then you will take 0.12 divided by 12 or 0.16 divided by 12. You will get per month rate. Then in the end value, imagine you want for 4 quarters, 4 months. Then you will just do 4 into 1 every month. Okay. Now here what you will do, you want something little more than 1 quarter. 1 quarter is how many months? 3 months. If it was, let's say if it was 5 months, what you would have done that time? You would have done 5 divided by 6. What's the confusion? Root thing, ah. Anybody has doubt about this 4 by 3? To the power we have to do 4 by 12. No. 4 into 1 you have to do if you want. 4 months. Number of months are 4. So directly to the power 4. Second one. If you got first 4, then I'm going into the next 4. Yes. Fifth one. Compounded quarterly, time period 4 months, dividend received rupees 10. When they just tell dividend received, it's at the end of 4 months only. So 250 into 1 plus 0.16 divided by 4. Now how many months? 4 months. So again same logic, it will be 4 divided by 3. 0.16 divided by 4 plus 1, 1.04, 1.04. To 63.42. Fifth one. 263.42. Dividend we have to minus. Yes. How much was the dividend? 10 rupees, right? So 10 rupees. So it becomes 253.42. 6. Yes, dividend is there. Interest is 16% per annum. Compounded quarterly. Time period 4 months. Dividend received 10 after 1 month. You can take any of your approaches. 253.02. Sixth one. Check if you're getting that. You can take any alternative, taking the dividend forward, bringing the dividend backward, taking the value forward, anything. Someone asked the same doubt, I think. I want to take dividend 3 months forward, then should I do 3 by 3? You can do 3 by 3, otherwise 1 quarter. You can do 3 by 3, otherwise it's just going to be 1 quarter. Okay, I'll show you that alternative as well. Spot is 250. Now I'll take the spot to the future. F is equal to 250 into 1 plus 0.16 divided by 4 into 4 by 3. $263.42. 263.42. Now remove the dividend. Dividend is sitting at the end of 1 month. So 10. Okay, this also will go forward. 1 plus 0.16. No, this is 0.16 divided by 4 into 3 by 3 or 1 quarter. 1 quarter you're going to take it forward. So 10 into 1.04, directly 10.4. So 263.42 minus 10.4, 253.02. There is one more alternative that I am not doing. We have already discussed in the concept part. Choose any one, you should get the same answer. Seventh one, I don't think anyone finished. Did you finish seventh one? How? Huh? No. You have to take the fourth, other two decimals also. You just did 03 and finish it off. No. You have to take the other 4 also, other 2 also which are there. 0.0325. Now, wait, stop writing, listen. This one I don't think you'd have done, no. Now, it's basically common logic. What we used to do in other places also. In IRR and all, we used to do that. 0.03 is this. 0.04 is this. But I want e to the power of 0.0325. That means surely it is somewhere in between this. It is in between this. So, for 0.01 jump, there is a jump so much. 0.01, that is from 0.03 to 0.04 when it went 0.01 upwards. That time there is an increase in this value increase we have to see. Now we want, if it is for 0.01, this much has increased. For 0.0025, how much has increased? Now, do you agree? Don't write, listen. Wait, here. Now, let's say e to the power of 0.0325 is equal to, for sure, okay, for sure, it is more than 1.03045. So you will write 1.03045 plus the extra value. How to calculate that extra value? When e went from 0.03 to 0.04, that means for 0.01 increase, there was an increase of 1.04081 plus 1.03045. Sorry, 1.04081 minus 1.03045. There is an increase of 0.01036. This much was the increase. Now, in this, for 0.03 we know already. We want for 0.0025 we want. So for 0.0025, how much is this? Cross multiplication. 0.0025 into 0.01036 divided by 0.01. You will get 0.00259. So E value will be e to the power of 0.0325 will be 1.03045 plus 0.00259. You will get 1.03304. Therefore, the future value will be 250 into 1.03304. That will be 258.26. How much did you get originally? 250? It's okay. We are calculating for one. No. Imagine lot size is 500. It will make a difference. And in what ICAI expects is this only. And listen to the best part. In the question, they will give you different E values for this sake only. If it falls in between, you need to know how to calculate. Otherwise, some of the extra values might not be relevant only. Yes, that was 7. The last. Eighth. Interest rate 15%, compounded continuously, time period is 3 months, dividend received after 2 months is 8 rupees. Time period is 3 months, no? I'm taking the spot forward, then I'll take the dividend forward and then I'll subtract it over there. If you're getting last one, 251.46. Which number you didn't get? Huh? Interpolation. The first one or second one? First one, it is 0.0375, right? So it's going to be 1.03045 plus, take your calculator, 1.04081 minus 1.03045 divided by 0.01 into 0.0075 plus 1.03045, 1.03822. You're getting, no? Huh? But you didn't get the number. Try it again. You'll have to do that again for dividend also. Yes, everyone got this? Got it? Huh? Calculation mistake. Couple of times that interpolation, you better write it and do it. After that, you'll get an idea of which one will be where. Directly you can do it in the calculator. Which alternate you want? Bringing dividend to present value, subtracting it and taking everything forward. Forward is spot rate is equal to 250 minus present value of dividend. Dividend is 8 rupees. Where is dividend sitting? At the end of 2 months, right? At the end of 2 months. So divided by e to the power of 0.15 into 2 divided by 12. That will be basically 8 divided by 0.15 into 2 divided by 12 is 0.025. Go to the calculation. What is the value for 02? 1.0202. Then difference between 1.03045 minus 1.0202 divided by 0.1 into 0.005, and plus you will get 1.02533. What? Then what you did? Why? 250 minus 7.8, 242.2. Then you calculate 242.2 into e to the power of RT. E to the power of RT will be 0.15 into 3 divided by 12. So that I think we have the value over here. So 242.2 into 1.03822, 251.46. Yes. How many decimal accuracy is better in these cases? When you're doing interpolation and all, you take what is there in your calculator itself. What? Because anyways you're going to use m plus function and all. If you have to take decimal accuracy, you'll have to write it again. So take what is there in your calculator. Usually 6 decimals is what they consider. 6 decimals, because already 0.00 will be there, no? Then after that 4 decimals. So just take the one in your calculator, you will get the accurate one that time. It can be tested in MCQ. Now when it is tested in MCQ, the close enough answer. You will get, there won't be an option, for example, here, there won't be an option 251.42, 251.50, 251.46. There won't be options like this. So the close enough answer, you can get it. Let's go back into the concepts. So we have finished right now. If dividend, there is no dividend. If there is dividend, but it is given in absolute terms. Okay. And all the cases we have seen, when there is continuous compounding, when there is compounding quarterly, monthly and all, and when there is compounding annually, all the three situations we have seen. Now we are going to see what if it is dividend yield is given. Dividend yield is given. Let me get this very clear. Dividend percentage is not dividend yield. If they give dividend percentage, you can't follow what we are going to do from here. If they give dividend percentage, you find the dividend and then you get the dividend in absolute terms and do it as per the previous methodology only. Are you getting this logic? Dividend yield. Now, what is the interest rate? 0.11 on the spot rate, that is on the spot rate. Dividend yield is also on the market price. So there we can set off these two together. We can set off these two here only in the percentage only we can remove the income and then go forward. If it is dividend percentage is not on the spot value. It is not on the market price. It's on the face value. Are you getting what I'm trying to tell you? See, if at all I tell you 250 is the spot price and interest rate is 12%. Interest rate is applicable on what? The spot price. And if I tell you dividend yield is 3%. Dividend is income. Dividend yield is applicable on what? Spot price, current market price. So directly here only you can do 12 minus 3%, directly apply 9% interest and go forward. If they tell dividend rate is different. Dividend rate is applicable on face value. Now something that is applicable on market price, something that is applicable on face value, how can you set off those two things at the rate of interest itself? You can't do that. Is it clear? So if they tell you dividend rate, this option is ruled out for you. You have to find the dividend in absolute terms. Go and solve it under the previous option. Clear? Yes. Spot value 120. Okay, let's say there is a spot value of 120. Dividend yield is how much? 3%. And rate of interest is 11%. Compute the value of 2 months future under 3 cases. Interest is compounded. That means what? Annually. Interest is compounded quarterly. We want for 2 months future. So when we are taking quarterly, you know what to do. It will be 2 divided by 3. Interest is continuously compounded. First, if I am doing like this, what is going to happen? 1 plus rate of interest is 11%. So 0.11 minus 0.03. Straight away 8% for you anymore. Into time 2 divided by 12. You will get the answer 121.6. That is 0.08. 0.08 into 2 divided by 12 plus 1 into 120, 121.60. Clear? Now, if you are doing continuously compounded, if it is compounded quarterly, first of all. So, quarterly, the rate will get subtracted, yield will get subtracted directly from the interest. It will get divided by 4 because there are 4 quarters. It is divided by 4 because there are 4 quarters. Now, you want for what time period? You want for the time period of 2 months. That means 2 months is inside 1 quarter. Inside 1 quarter, how many months are there? 3 months. So 2 divided by 3. Are you getting it? When it was 4 months, we were doing 4 divided by 3. Why? Because we wanted something little more than 1 quarter. I hope you are getting this. Okay, then after that what you are doing over here, multiplication, you will get the answer. Here you see 0.11 minus 0.03 into 2 divided by 12. Straightforward. Because we want 2 months future contract value. Just have a look at this. Here I have shown the interpolation also. How the interpolation is done. Just check if you're getting these numbers. I was actually thinking of giving holiday today. in the middle of the night. I got some crazy stomach upset. I don't know what I ate, but I was like feeling very uneasy. Then I like forced myself to puke. Everything I puked out, and then I thought, should I give a holiday? But then I'm like, no, let's do it. Something that I ate was not proper, I guess. What? Yeah, but healthy things only I ate. I didn't eat any junk. But you never know. First one is, yeah, compounded when annually. When they just tell compounded, it is compounded. Everything is compounded. Okay. When it is compounded annually. When they don't tell you for what period, it is always annual. So simple interest it becomes. Yes, this I don't have to explain because we just discussed it in the problem. So let's go back into the material and see if we can relate to things what we have already finished. This we have already seen. If dividend income is given in absolute terms, see the note. Instead of calculating present value of dividend, an alternative way is to calculate future value of dividend income, then calculate future value of S0, then subtract future value of dividend from future value of S0. We have seen all the possible situations over there. You will get same solution for fair value, fair future price. Three alternatives are there that we have seen all three. Case 3, you see, underlying asset providing income in yield percentage terms. Underlying asset is providing income in what? Yield percentage terms. So now, if it is discrete compounding, we have seen this also. Discrete compounding, first what we are going to do? 1 plus r minus y. Remove the yield and then you do it into n. If it is compounding frequency is not given, then you are going to do 1 plus r minus 1 into n divided by 12. We have done it already in this question. And continuous compounding, f is equal to s0 into e to the power of r minus y into t directly. Here y means dividend yield percentage. Now note this. These formulas are applicable only when compounding frequency of r and y is same. Compounding frequency of r and y is same, else you have to use case 2 formula. What is this compounding frequency of r and y is same? Here compounding of r, let's say it was quarterly. And if they tell the yield compounding rate is monthly, then you can't do direct minus and do the calculation. Then you bring the dividend into absolute terms. Then you use your previous methodology and calculate. Clear? So what you will do, if it is given monthly, you will take directly whatever yield, dividend yield is there, 250 if it is a spot rate. On that you will apply the percentage. You will get the value in absolute terms. Once you get the value in absolute terms, then you follow method 2 or step 2 and calculate. These formulas are applicable only when dividend yield percentage word is given. However, if only dividend amount is given, then simply apply dividend amount on face value and use case 2 formula. If they tell dividend amount or dividend rate or dividend percentage, just they tell dividend percentage. Dividend percentage is never yield percentage. Dividend percentage, normal language, whenever they tell dividend percentage, it is always on face value. So you will calculate on face value the dividend amount and you will take it backwards, okay, into step 2 and you will make the calculation. Now, general points to remember. If actual future price. Now till now what we were doing? We were trying to find the fair future price. No. We were trying to find what? Fair future price. Now why we were trying to do fair future price? Because we are trying to do arbitration. We are still in that point where arbitration we were finding. Now if difference between fair future price and actual future price, then arbitrage opportunity exists. So now if they tell you that fair future price you got 255.5 and you are seeing over there the future is actually at 260, then what you will do? Then earn profit simply divide into following actions. Buy overvalued instrument, okay, buy undervalued instrument and sell the overvalued instrument and then hold till the difference converges. So you will buy and you will still keep waiting and one day you will make the profit. Okay, so basically this is the rule you are going to follow. If actual future price is greater than theoretical future price, market it is greater, that means it is overpriced. If it is overpriced, action should be short the future. What does it mean? Sell the future. That means enter into a future agreement to sell at a future date. Long the spot and borrow. This full thing we have to discuss. Okay. Yeah, we'll discuss that. Actually, I've written proper examples for that. Now see, one thing, no, always in AFM or in financial management, basically, it is assumed that you are Bikari only. Okay, it is assumed that you have no money. So whenever you're telling buy and all that, no, it is automatically assumed that you're going to borrow and you're going to buy. So this part we have to remember. And before that, there is one more concept that we have to check. ICAI sometimes tests you on this. Okay, ICAI tests you on this. They give you these two terminologies called as contango or backwardation market. Contango or backwardation market. Now see, spot price minus future price. Okay, spot price minus future price. Now tell me one thing. Spot price minus future price, when you do, you should actually get a positive number or you should get a negative number. You should get negative number because usually the future price is priced higher than the spot price. So if you get a negative number, that is normal. That is called as contango market. That is called as contango market. That means prices are higher than the spot. But based on economy, sometimes it might not be higher. Clear? Now if, see, already, for example, I'm giving you an example. Let's say there is one stock. Let's say HDFC Bank. HDFC Bank. And HDFC Bank, last few months, okay, it was somewhere around 1100 or something, let's say. It fell, and it is right now sitting at 770 or something like that. Now you want 3 months future price on this. Is it a possibility that you might get a price in the market at 880? If market is expecting it to fall further, then the future price might be actually sitting at 700. Now you are getting confused, thinking that, sir, wait, for spot, when I add the interest, it should increase. No, I am not talking about fair future price. I am talking about what is there in the market situation. Market situation, it can be at a lower value or it can be at a higher value. Clear? So whenever it is at higher value, that is normal. That is called as a contango market. That means the basis is negative. The basis points. What is basis? The spot minus future. If at all we tell it is positive, that means it is not a normal market. It is backward. So it is called as backwardation market. This terminology directly they can give in the example and tell spot price is 50.04. Okay, and ICAI can just tell basis points for 3 months future in a backwardation market 0.5. They can just tell 3 months future in a backwardation market 0.5. Now using this you have to find the future price and then do other calculations. So now backwardation market means what? Future price is lower. So from 50.04 you'll remove 0.5. You'll get the future price. If they would tell a contango market, then you would add 0.5 to that and you'll get the future price. Is this clear? This is not fair future price. This is the future price in the market. Is this clear? Why we are calculating fair future price? So to see whether we have an arbitrage opportunity over there. Any doubt with this till here? Now, let's go into the fourth point of discussion, that is arbitrage. Now, when we are talking about arbitrage, Bamboo Limited is there. Okay, let's say the spot is 1500. 2 months future, actual price is 1550. What is this actual price? What is this actual price? Is it the fair future price? Is it the fair future price? Actual price is always what is there in the market. It is not the fair future price. Clear? Actual price means if you want a 2 months future, it is available right now at 1550. If you want a 2 months future, it is available at 1550. Now, for example sake, and even ICAI, what they do is they just tell fair future price. I mean, they tell actual future price and then they will tell you're planning to buy or you're planning to sell. You're planning to go long or you're planning to go short. But actually in reality, the future price when you want to go long and future price when you want to go short, they might not be same price. For future buying value, it might be 1550, but the future selling price might be 1450. You don't know. Okay, it can be anything, but you can get the price in the market. You have to see because everything is predetermined. We are talking about futures, right? Now, RF is 8%. RF is 8%. Now, RF is 8% means what? We are assuming that we are able to borrow and invest at 8%. Clear? Actually, they should give you rate of interest. Most of the times they'll give you RF and tell you, do your calculations based on RF. If you're telling based on RF, that means I am going to invest in FD if I have extra money, and I'm going to borrow at RF, which might not be possible. Clear? Now, fair future price. Fair future price, we already know. I have not taken any continuously compounded and all, because we are trying to find only arbitrage here. 1500 into 8%, so 0.08 into 2 by 12. So you'll get 1520. When you got 1520, why did we calculate fair future price? To see whether it is having same, equal. Imagine the market price was 1520. Then no arbitrage opportunity exists. Clear? But market price is 1550. So now fair future price is not equal to actual price in the market. Therefore, arbitrage opportunity exists. Therefore, what? Arbitrage opportunity exists. There is a chance that you can make money. Now how? Therefore, futures are overvalued. How did we come to a conclusion that it is overvalued? Fair future price is 1520, but it is trading in the market at 1550. Okay, remember what we saw over there? Here only, no? Yes. If actual price is greater than theoretical price, then future is overpriced. Actual price is not what you are calculating. You are calculating theoretical future price. So it is overpriced. Now, let's not read what is there over there. It will be too confusing just if you read that. Now, this is the situation. Futures are overpriced. Clear? Now, if futures are overpriced, what should be the action you are going to take? If futures are overpriced, that means it is overpriced. That means, you know, that is not the true value. So if I enter into agreement with someone telling that I will sell at this value, I'll make good money. Correct? So sell futures at 1550. Actually, according to you, what should have been the 2 months future ka value? 1520, but they are telling 1550. So what I'll do, I'll sell future at 1550. Sell future means what? Enter into futures agreement to sell Bamboo Limited share at 1550 after 2 months. What does sell future mean? Sell future doesn't mean that you go and sell something today. Sell future means whenever we tell sell future or buy future, future is not our general English terminology. Future is an instrument. Sell share means what? Will I tell sell share and think something else? No, because there is no share value, share name in general English language for us to get confused. But when I'm telling sell future, future is an instrument over here. Sell future, how much period ka instrument it is? 2 months future it is. So when I'm telling sell future, that means enter into the future agreement to sell Bamboo Limited share at a predetermined price. What is a predetermined price? 1520 is what was the true value, but we are getting it at 1550. Enter to sell it at 1550. Clear till here? Now, if you do only that much, what will happen? How you'll make a profit of? How? No, you don't have the share. If you do only this much, you will not make any profit. If you do only this much, you will not make any profit. You will just sit like this for 3 months. Okay, you will wait for 3 months thinking that you will make profit. When 3 months gets over, no, that fellow will ask, give me the share. Okay, you wanted to sell, I'll buy it. Give me the share. Now to sell that share, where is the share? That time you'll be like, oh, I have to buy the share now. I'll go and buy it at 1550 in the market and sell it at 1550 to that guy, and I'll make zero profit. Are you getting my point? Did you get this? So it is not possible to make arbitrage with one-sided action. It is always a two-sided action. What is the two-sided action? See, when you enter into future contract, institute assumes that there is no cash flow. When you enter into future contract, ICAI assumes that there is no cash flow, but there is cash flow. What is the cash flow? Initial margin. Are you getting my point? For problem solving purpose and for understanding concept easily purpose, they assume that there is no cash flow there. In real life, margin money exists. Clear with this? So don't get confused with margin money over here. Margin money question, when it comes as margin money only, we will solve that. Otherwise, we will not bother about that margin money. Or if they inculcate margin into this question, which they have not done. Okay, if they inculcate margin into the question, then you can calculate on that basis. Clear? So when I enter into this action, actually there is no cash flow. Why no cash flow? I have only told boss, I will come after 2 months. You keep waiting for 2 months. and after 2 months I'll come with shares and I'll give it to you. You have to give me 1,550. Clear? One-sided happened. I told you again, if you don't do anything, you're not going to make profit, because after 2 months when you go, okay, you should be, see, one more assumption over here. After 2 months, no, market price can be 1560 also. It can be 1560 also. Now we are assuming that if they are telling 1550, okay, after 2 months when I go, it will be 1550 in the market as well. So I have to buy at 1550 and sell at 1550. I'll be making no profit. 1520 is book value.
So after 2 months, this price 1550, how do you know today?
That they have quoted, no? This is the market price, no?
Market price of
Market price of not share, market price of the future. The future agreement for 2 months buying selling is being traded right now at 1550. Future agreement. Okay, future agreement means what? An agreement between the person and one more person, but the intermediary is stock exchange. Stock exchange is quoting 1550. If you want to buy, if you want to enter into an agreement to buy the share or sell the share after 2 months, and that is at what price? 1550. We sat and calculated theory. Based on theory, we calculated storage cost, we added interest, we added dividend, we minused, and spot price we took. That time we got the correct price is 1520. When I saw that the price what I calculated theoretically and the price that is there in the market is not matching, it should have actually matched, no? Because what did you do to this spot? You added the interest and took it forward. So it should have been 1550 if they had properly priced it. So now when you saw this 1520, you understood that there is an arbitrage opportunity. It is not matching. It is more than what should have been the price. If it is more than what it should have been, that means it is overvalued. If it is overvalued, enter into an agreement to sell it at 1550. Enter into an agreement to sell it at 1550. But my point is, if you just enter into a one-sided agreement, you will not make any profit. For you to make profit, okay, you should have the share. And for you to have the share and make profit, you have to have the share today. Otherwise, you will not make profit. Are you getting this? So now understand this. This part, cash flow part, we understood. Now, today what you will do? Buy spot. Whatever you did over there, you do the opposite action in the current market. There you agreed to sell. So here you are going to buy the share. And here you are going to buy the share at not 1550. Today what is there in the market? That one, 1500. You kept the share ready. But if AFM, no, FM only, FM assumes that you are bikari, you don't have money. Arbitrage means what? Without putting money of your own, you make profit. That is arbitrage. Okay. Speculation is what? When you put money, you invest, you buy, sell, you make trading and you'll make some profit. Correct? Arbitrage means what? You saw an opportunity, you seized that opportunity. Now you are buying 1500 ka share. If you are buying, you don't have money. You don't have money. You will get money when? After 2 months. How will you get after 2 months? When you sell the share. Now today I am buying the share. I don't have money. Here there is cash flow. Assumption in FM is always that you have no money. You have no money. So what you will do now? I want 1500. What will you do? You will go and borrow it. Okay. Borrow at 8% per annum for 2 months. Okay. 8% per annum for 2 months you will borrow it. Once you borrow, after 2 months, what will happen? Now the plan of action you see. What will happen? After 2 months, forget about values. Forget about values, you forget. After 2 months, action you tell. What and all I have to do? I have to sell the share as per the future contract. Then I have to repay the loan. I have to sell the share as per the future contract. And selling the share, I will sell it at 1550. Loan I have borrowed is 1500. On that, the interest will be 20 rupees. Now you will get 30 rupees. Now you will get 30 rupees profit. Clear? See over here. Share purchased at 1500 will be sold at 1550. Delivery of future contract. This is called as delivery of future contract. In real life, it will not happen. In real life, only the price fluctuation will be taken. Okay. Delivery of future contract. Amount received is 1550. Now what will you do? Loan to be repaid. 1520. How did I get to know that loan amount is 1520? We already calculated, no. Spot price plus interest we calculated and kept. So the loan amount is 1520. Now you have an arbitrage gain of 30 rupees. Is this clear till here? Now, derivative is actually easy, okay? The problem is what, students miss the terminologies. They miss the terminologies. Go long on futures. Go long on futures means what? Enter into an agreement to buy the share on a future date. Go short on future means what? Enter into an agreement to sell the share on a future date. Now, go long on stock. Buy the share today. Go long on stock means buy the share today. Go short on stock. That means what? Sell the share today. Is this clear? Yes. Sir, how did we purchase at 1500 when the market price today was 1550? I expected this question. That's why when I told we are not selling at, we are not buying at 1550. Market price today 1550. Where are you? Yes. Is for 2 months future. Spot price today is 1500. Spot price means today it is traded at 1500 in the market. And today a 2 months future is trading at 1550. Now, if I was taking this derivatives class to like some investment bankers or something, no, then I would have told them, boss, just open Demat account, okay, and do this on a day-to-day basis. You will get to know a better idea you'll get. But now I don't want to tell you that because then you lose your stipend money. Okay, hard-earned 8 to 8 ka stipend, no, will just go in derivatives market. So I won't suggest that. So you have to understand it theoretically. So spot rate is what? Yes. Did you understand this? Yes. Okay. Spot rate is what? Today's share price in the market. Actual price of 2 months future means what? If you want to buy share after 2 months, if you want to sell share after 2 months, this is the price where you can enter into an agreement today. Is this clear? Yes. I'm keeping this entire thing open. I want you to read this example. I'll go in order. I want you to read and absorb. Let me know if you have any doubt. What? There will be. That's what these traders are doing. No? This much difference won't be there. It might be 1520.50 or 1521 can be there. Because there it's also on demand and supply, no? The market reacts to even demand and supply, no? And other factors are also there. Usually more of arbitrage is there in forex market. You see London market, you see US market, then there will be some small decimal curve difference. In that people will play and they will make money. They'll put crores to earn lakhs. They'll put crores so that imagine there are people who play with like 10 crores and all every day in the stock market. 10 crores. They will never take risk. They will never take risk. They will play with small values. Okay, small fluctuation. And then they will earn like 1 lakh in a day. That's good enough, right? 1 lakh in a day is 365 lakhs in the year. 365 lakhs on your 10 crores. 10 crores is what? 100 lakhs. 100 lakhs. Good enough, no? 365 by 100, 365%. But I wouldn't do that if I had 10 crores. If you get 10 crores, no, you should be content in life. Put FD. Okay, if you get 10 crores, put FD. Okay, how much FD gives you? 8%, 7%. I will not put there. I will put in our Uru. There are some cooperative societies which give 10%, 11% and all interest. No, 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 no. There are some which are there from years. Okay, some are there which will shut down, but I know few which are there from like my parents' childhood. What? Yeah, it will compensate only the inflation part. So what you should do is 10 crores, and if you have 5 crores, you should divide and put it in FD and lead your life. Other 5 crores, you should put it in mutual funds. Forget it. Forget it. You know, there are these concepts, actually, it's not covered in our syllabus, but there are these concepts, okay, where you invest some amount in mutual funds, right? Then after that, every month, if you remove some money also, right, you will still have more money at the end of 20 years. You'll still have more money at the end of 20 years. Now imagine you put some 10 crores in mutual fund and you're removing every month 1 lakh. Telling that 1 lakh is enough for my normal life. I remove 1 lakh every month. Okay. At the end of 20 years, no. You will think it's less than 10 crores. No, it would have become 50 crores or something. It would have grown, or 30 crores something it would have become. Yes. Let's not go there. We'll focus on clearing exams. Once you start, yeah, SWP it's called. Once you start making money in stock market, right, then you'll not study. You'll not study. You'll feel happy. Easy money is coming. Morning I'm just sitting doing two, 3 clicks. I don't know if I told you. One of my students like this wasted 2 years. Starting they got nice money. Then they put their own money. Then they took from uncle and other people and all and put into the market. Played in F&Os. Lost everything. Like 20, 30 lakhs they lost. Now only way he thought I can repay that money is by clearing CA. Came back and now he's sitting and studying for finals. When that money was coming, they were making money, okay, they were making good money every day. When the profit was coming, no, they were spending it by partying and traveling, going on trips and all. They spent. Then when the money went, right, it went. Now you got adjusted to that lifestyle, right? Now it's tough for you to adjust to the normal lifestyle again. Now he's sitting in some PG and studying 8 hours, 10 hours a day. There's no other way. Luckily his uncle is rich. Okay, so for him 20 lakhs is not a big deal. So he's not asking him. Okay, obviously, no, if uncle had only 20 lakhs, you think you would have given to this guy. Uncle must be having crores. Okay, so he gave 20 lakhs. Okay, kid, play. Yes, so I'm scrolling down. Please read the next part as well. You have to get clarity of this. Future price? Huh. Tell. Yes. Multiplying. Buying it. Okay. Huh. Okay.
Okay, 1,550. But I'm going to sell it. Would have anyway spent 1,000.
What makes you feel that 1,500 plus interest will not be 1,550 at the end of 3 months? 1,500 you don't have, you're borrowing, no? Yes.
So I know that I'm going to get a gain of
30.
So why am I predicting?
This 1,520 when you got only, you decided to go for this, no?
Using the fair future price and fixing my future price.
No. We are finding the fair future price and glancing at the market. Oh, 1550. That means there is a difference. This difference should not be there. It should be actually 1520 plus is equal to 1520. I finished telling. What's your doubt?
Finally, your price is fixed at 1,550. That day. Today I'm in this 1,500.
Yes.
I'm not in this paying the interest also. My total cost is 1,550.
Yeah, and that total cost of 1,520 only is the fair future price. That only is the fair future price because you got to know that time only you got to know that you can make a profit. No. If I don't do 1,500 plus interest, how will I know I can make profit? You're actually adding interest and telling I have to pay 1,520. But you have to pay 1,520. That only is the fair future price. No. Now tell me, can you make profit? Huh?
You cancel it.
Yeah. Now tell me, can you make profit? Is there arbitrage? You're telling 50 rupees. That is normal thing, you know that is not we are not in AFM. If you're telling 50 rupees is profit, that is like someone telling I bought share at 100 rupees 10 years back. I sold today at 1,000 rupees, so I made 900 rupees profit. Where is the interest factor? Entire subject is relying on interest factor or present value, future value part. So when you're comparing, you're telling that 100 rupees you bought the share 10 years back. Now that 100 rupees cup future value when you calculate, it will come to today. Now if there is a difference, there is a profit. You expected the share to grow at 8% every year. So 8% is your interest rate or your cost.
So much future price is 1,550, then I want to go down.
You'll still go, but in the other way around. You'll still go, but in the other way around. That we will see next. If at all the 2 months future price is 1,520 and your interest rate is 8%, now you will calculate 1,500 plus 8% for 2 months. That time you will get 1,520 and you saw the market also 1,520. You have no scope for arbitrage that time. Because that time if you borrow loan today, that loan amount will become 1520 and later you will be selling the share also at 1520. You are not going to get any profit or loss. Fair future price is the base to decide whether there is arbitrage or not. Otherwise you can't. Now, if you don't have fair future price, you don't know this interest rate also. And you cannot tell that 50 rupees is profit. Okay, you cannot tell that because there you are ignoring time value factor altogether. Will 1,550 fair price info readily available for us in market? 1,550 is not fair price. 1,550, okay, FPU wrote 1,550 is future price, is readily available in the market. Also, we have to derive from somewhere. No. That is available in the market. I want to buy Infosys share. Today I can't check because today is Sunday. But whenever market is running, you can go and check. We'll show you. HDFC Bank. Okay. Can you see HDFC Bank on the screen? 799.9. What is it? Spot. What is it? Yesterday's rate. Okay, not yesterday, day before yesterday's rate. But still, spot. Correct? Now. I don't know if it will be visible on the screen. Can you see this? It's taking time to like. Can you see HDFC Bank futures? Can you see HDFC Bank futures quoted over there? Okay. Now I'll read it out to you. HDFC Bank future, 28th April. That means if you want a 28th April ka futures, it is quoted at 801.6. That is the future price. Now you do calculation. Fair future price. HDFC Bank future for 26th May. Okay, expiring on 26th May. 803.2. Why there is so small difference? Because right now it is sitting at 799.9. When you calculate your fair future price, if you feel there is a difference, that time arbitrage opportunity is there. That time there is arbitrage opportunity. Is this clear? Yes.
In futures, when both buyer and seller make profit. Means actually, after 3 months future, so it was quoted at 1,550. But the actual market price is 1,600.
On that day. That time both will make profit. But if they have valued it properly, after that, on that day, the price might be 1,552 or something like that. They'll buy at 1,550 and you will sell it at 1,552, and you will also like square it off. That's a different thing. But yeah, 1,550, both can make profit. But we are assuming that at the end of 2 months, it will be 1,550 only in the market also. It will be at 1,550 only in the market. Market will be, affected by a lot of other factors. Now I showed you that price, no. So tomorrow if there is some war, no, suddenly that price will fall. That price will change. It will keep fluctuating every day. Because it is keeping fluctuating every day, that's why we have mark to market margin. I entered at 1,550. Tomorrow, no, the price for that same future is 1,555. Mark to market will happen, or it will get cut from your initial margin. Are you getting this? But what ICAI is doing is they are not integrating the margin concept into arbitrage concept, because it becomes too complicated then. How it becomes too complicated? Every day there will be a plus minus happening. Then after 2 months you will check what is the profit or loss. Are you getting this? Yeah, this is readily available. Which app? That we don't want. So many apps are there, man. It's available on any app. Like what I use is Grow. There is an app called as Grow. You can try that. Yes. Is this clear till here? Now, see the other side also, like what you said. What if after 2 months, the share purchased at 1,500, after 2 months will be, this already we finished. No, what if the actual future price is 1,450? Now you are thinking there is no arbitrage. Here also there is arbitrage. When it is 1,450, it is undervalued. If it is undervalued, based on the same concept what we learned, if it is undervalued, what will you do? If it is undervalued, what will you do? You will sell what? See, it was overvalued. That time when it was overvalued, you sold the future. Selling the future will have no cash flow for you. Selling the future will have no cash flow. First, always determine what is happening with future. What is happening with future? You sold the future. Why did you sell the future? Because it was overvalued. Now it is undervalued. Because it is undervalued, okay, now you have to go long. That means you have to buy the future. Buying the future means enter into the future agreement to sell. Did I write wrong language here? Oh yeah, it's just copy pasted, I think that's why. Enter into the future agreement to buy Bamboo Limited share at 1,550 after 2 months. Oh, the numbers should change. 1,450 after 2 months. Not 1,550, 1,450 after 2 months. So what has happened over here? Last time I saw the theoretical price or the fair price is 1520. I saw 1520. Okay. That means I should be able to buy and sell at 1520 after 2 months. I saw in the market 1550. Oh, good. If I buy today and sell later, 30 rupees profit I can make. Now what I am seeing the price is at 1450. If it is at 1450, now what I should think that if I am able, now from 1520, It should 1520 should be the price now on that day, but you are seeing you are able to get it at 1450. You enter into a future agreement to buy at this lower price. You enter into future agreement to buy at this lower price. Now understand one thing. Always, whatever action you take in the future, you have to take the opposite action in the spot. So if you are going to buy future today, that means you will sell the share today. Why you will sell the share today? Because share is priced higher. Share is priced higher. You will sell it at higher value and then later you will buy it at lower value and compensate. Clear? Everything is clear. Now sell the share in the spot at 1500. Now my question is, to sell the share at 1500, do you have the share? Do you have the share? You can sell the share without having the share for a day or for 2 days max. In the market, you can go short for 1 or 2 days. For 2 months in India, they don't allow. In US market and all, you can go short for 2-3 months also, you can keep going short. Okay, that means sell the share, keep selling. You don't have one share also, keep selling with the hope that it is going to fall in the future. And when it falls, you'll buy and compensate. This is exactly what someone did in 2008. You know, 2008, there was a global recession. 2 American banks, they almost went into bankruptcy. So there is a movie also made on this. Okay, a documentary is also there on this. There was one guy who was working in an investment banking company or he was running an investment banking firm. Okay, so from 2006 onwards, 2006 end, he predicted, seeing the charts, that banks are actually overpriced, overvalued. These guys actually don't derive this value itself, because US banks, what they used to do was, they went on giving loans on real estate. It is basically, I buy one land, was it not because of SPV? It was. But main thing was, it was because of NPA. It was not SPV. It was mainly because of NPA. Non-performing assets of the banks, American banks. What American banks were doing was, imagine, I buy this land over here for 1 crore. I don't have 1 rupee also. I go to bank and take loan and buy the land. Okay, after 2 months, 3 months, real estate is booming. After 2 months, 3 months, what I did? I have to sell this land. Okay, I put a board telling that I want to sell it for 2 crores. You come and buy it from me for 2 crores. You also don't have money. You will take loan from bank. Underlying asset for the bank or security for the bank is what? The land. Okay, now you took 2 crores loan. You gave me 2 crores. I paid 1 crore back to bank. Bank is happy. Clear? Then you, after some time, real estate is booming. You, after some time, you sold that land for 4 crores. Where do you have money? Nowhere. Now finally what you will do? You will also take loan from the bank. Bank gives you 4 crores. You pay me 2 crores. I repay the loan back to bank. Now you have 4 crores of loan. It kept compounding like this. It didn't make sense only. It kept happening from 2000. It didn't make sense at all. Now people don't have money. Ultimately, when real estate crashes, the guy has to pay 4 crores. No. His income is $2,000 per month. Are you getting my point? So that time NPA started. So this guy in 2006, he noticed that actually the payment power of people is not there compared to the loan. The payment power, the earning power to the loan repayment power is not there. That is the story with their entire country. That's a different thing. Okay, that is the story with US itself. They don't have the money to repay the loans. Okay, so they just print more dollars. That's all. Okay, so now what happened over here? Someone went short. It's not possible in India. India doesn't allow going short for so long. It was there when Arshad Mehta and all was there. Okay, the same Rakesh Jhunjhunwala who died recently, he did that only. And when Arshad Mehta got arrested, market crashed. And that time he made crazy amount of money. And then he kept investing it forever. So this guy from 2006 end or 2005 end, I don't remember, he saw that there is no possibility that this market is real. This market is an inflated market. So he kept going short. Kept going short means kept selling shares. He doesn't have shares. He kept selling shares. Now when you are selling shares in US market, you have to keep paying the interest on that or the margin on that. You have to keep paying. Next month again the price has gone up. He's still selling shares. Again it went up. He's selling shares with the hope that someday it will fall down. They kept pumping and they were paying huge amount of interest every single day. Every single month they were paying interest. In 2008 when the recession happened, it crashed. Market crashed. They squared off everything in one day. One day they became billionaires. In one day they became billionaires. They waited for 1.5 years for that day. So that is the situation over here. But in India, it is not possible. Why I started telling you this was because we came to a conclusion that you have to buy future. You have to buy future means what? Enter into a future agreement to buy the share on a future date at a predetermined price, and that is 1450. So now for you to get arbitrage, you have to do a two-way contract. You have to get into a two-way contract. Otherwise, what happens? You will wait to buy at 1450. On that day, you will see market is 1450 only. You will buy in the market. Sorry, you will buy from this guy and you will sell in the market. You have no profit or anything. No profit, no loss. Clear? So now, if you are going to buy the future, you have to long the spot. You have to go long on the spot. That means what? You have to sell the share today. Sell the share today and then you will buy the share back in future. How can you sell the share? It's not allowed in India, right? How can you sell the share? I don't have share. If I'm assuming in the previous assumption that I don't have money only, how can I assume now that I have share suddenly? Previous situation, when I wanted to buy share, I didn't have money itself. I borrowed loan and I bought share. So now I am assuming that I don't have money itself. I don't have share also. That time what happens is there is this scheme called as SLB scheme. Stock lending and borrowing scheme. Stock lending and borrowing scheme. So you will borrow the share from somebody and you will sell it in the market. You will sell it in the market. Then after that, you will buy the share because you have entered into future. You will buy the share at the future price and then you will return the share. You will return the share. Clear? See, sell the share in spot at 1500. Assume to be shares borrowed under SLB scheme. Little later, once we finish our arbitrage discussion, we have the discussion of SLB also. There can be an independent question just on this. I think in one of our previous chapters, we have left two questions telling that it is stock lending and borrowing. It was there. We wrote its derivatives and skipped it. Correct? Now, if you are going to sell the share today, you don't have the share. You don't have the share. To sell the share today, you have to actually take the share from somebody. There are these long-term investors. Imagine you're a long-term investor. You have invested for 10 years, you're not going to touch. Now what you will do? Your share is simply sitting there. So you will give it to somebody else under this stock lending and borrowing scheme. So you'll borrow the share from that guy, sell it in the market at 1500. Sell it in the market at 1500. When you sell it in the market at 1500, what will you do? Immediately what will you do? You got money? No. What will you do? Invest the amount received at 8% per annum. Invest the amount. Clear? After 2 months. Tell me the plan of action after 2 months. The share which you just sold in the market. Okay, you just sold the share in the market. You have 1500 plus interest. Plus interest is basically 1520 rupees. You have 1520 rupees. Now you will use this money. Okay, you will go and buy the share at 1450 and you will get 70 rupees arbitrage gain. Here, ICAI, just like how they ignore margin money, they are ignoring the charges that are relevant on that stock lending and borrowing. There is a charge that is relevant over there, that is ignored over here. Clear? See, after 2 months, buy the share under future contract at 1450, return the share borrowed, sell the investments and receive 1520. Why 1520? 1500 plus interest was 1520. Arbitrage gain is 70 rupees. Is this clear? So unless it is equal, if it is either way around, you can always make profit by doing arbitrage. Okay. Comparison between actual future price and theoretical future price. You can have a look at this chart. Actual future price greater than theoretical future price. Actual is greater. Actual is greater. That means it is overvalued. It is overvalued. If it is overvalued, what will you do? You have to sell the future. That means short the future or sell the future. When you short the future or sell the future, you have to do the opposite action. The opposite action is what? Long the spot or buy the spot. Long the share or buy the share. That means both meaning same. I just kept both terminologies for you to remember. Okay, and you don't have money, so you'll borrow. This is called as cash and carry arbitrage. Clear? Now, actual is less than theoretical. That means it is undervalued. Actual is less than theoretical. That means it is undervalued. So long the future. Undervalued means what you have to buy? Buy the future or long the future. If you buy the future, you have to do the opposite action. So what will you do? You will short the spot. Short the spot. That means what? You will sell the share today. How? By taking money, by taking the share on lending and borrowing scheme, and then that money you will invest. This is called as reverse cash and carry arbitrage. Clear? This is the situation. Okay. Normal is, how did we get interest, sir? 8%. In our entire example, the interest was 8%. Okay, now this can be RF in the question, or they can just tell you like this: borrowing rate is 8%. They can give you like this: borrowing rate is 8%. That can be 8%, 12%, anything. Okay. Yes. So interest we got because of 1,500 plus 0.08 for 2 months. Not plus 1.08 for 2 months. Is this clear? Then we have a question which was actually May 2007. Recently they put into RTP May 2024. May 2007 question they took and put it into RTP May 2024, which we have to see. What? Mumbai Indians fan, can you catch? Sorry, my throw was bad. I'm going to support Mumbai Indians as my second team. Because simply they are criticizing Bumrah. What criticism is getting for not getting wicket in 5 matches? But he didn't get wicket. But in that 3 matches, no, he was very economical. Other side, if there are some bowlers who are giving runs, right, then they will just play Bumrah's over and hit properly in that other overs. What about paying interest for the person from whom we borrowed shares? Array, we won't pay interest. There are some charges. That is what I told. When we are having a situation, when I'm entering into future contract, there is actually initial margin money. But ICAI in arbitrage questions, they are assuming that when you enter into futures, there is no cash flow. When you enter into futures, there is no cash flow. So the same way, when you borrow the share under lending and borrowing scheme, we are assuming that the charges are negligible or ignored. Clear? That is also there. We have a discussion on that, but they ask separate questions on that. So they don't merge. Actually, if they want to really make it complicated, they can merge the margin concept with arbitrage and also the stock lending and borrowing scheme, which they are not doing. Is this clear? Now imagine you enter into the margin, that time margin cash flow is there. On that you have to calculate interest for future months. So all that they are not doing as of now. Okay. So finish finals before they start doing all that. I mean, they will not do. ChatGPT will start doing it. Yes, is this clear till here? So now to revise once again. If your actual future price means market price of the future is more theoretical future price. How did I get this theoretical future price? By doing all that what we did before this. Okay, by doing all that what we did before this. So my actual future price is more. That means it is overvalued. If it is overvalued, it is good for me to sell at this price. So therefore, I'll enter into a future contract to sell at this price. So if I have to sell at this price, I have to go opposite. So today I will buy the share. To buy the share, I don't have money. So what will I do? I'll borrow the money and I'll buy the share. Then on the future date, I'll sell at this price and I'll repay the loan. I'll get arbitrage gain. Clear? If actual future price is less than the theoretical future price, that means it is undervalued. If it is undervalued, it is good for me to buy at this. So I'll buy at this price. That means I'll enter into a future to buy at this price. So now I don't, what will I do? I don't have shares. I'll take the share under borrowing scheme, get the share, sell the share today in spot. Sell the share, got the money, invest it. Later what you will do, you will sell the investment and use that money to buy the share. Difference is your arbitrage gain. Is this clear? Yes, that should be it with that one. Then we have to see that May 2007 question. Take a small break for some time. Okay, let's continue. So now we learned how arbitrage works. Okay, and to brief it up, if the actual is greater than theoretical, what will you do? It is overvalued. If it is overvalued, sell the future and then buy the spot. And then when you have to buy the spot, there is cash flow, so borrow money. Then if actual is less than theoretical, that means it is undervalued. If it's undervalued, long the future, that means buy the future and sell the spot. Sell the share today. Sell the share today, you don't have shares, so you'll take it under stock lending and borrowing scheme. Okay, then whatever money you get, invest it, sell the investment on a future date and then buy the shares, you'll get arbitrage gain. Clear? Now we'll go into this question. May 2024 RTP, will find it. So when we solve that RTP, we'll ignore it there. And it was actually there in May 2007 exam. Once upon a time. Okay, spot price of XYZ Limited on 31st of December 2020 was 220. What is it? Spot price today. Clear? And the future price on the same stock for 31st March 2021 was 230. That means for 3 months, it was 230. You cannot decide anything based on that. Okay, whether arbitrage is possible or not. Addition info. Days to expiry 3 months, which we already know. Borrowing rate is 15% per annum. So, annual dividend 25% payable before 31st of March 2021. Before can be today also, tomorrow also. But ICAI assumption is that it is on 31st of March 2021. 25%. Oh, sir, there is a problem. From 15% when I remove 25%. No, sir, I am getting minus 10%. This is dividend percentage, not dividend yield. It is dividend percentage, it is not dividend yield. So what you will do, face value is 10 into 25%. That means 2.5 rupees is the dividend. That means we are in that second situation where dividend is given in absolute terms. Dividend is given in what? Absolute terms. Clear? Now, what we have to do? Here, what we have to do? First, we have to calculate the future value, theoretical future value. Now tell me one thing. Did they tell you it is continuously compounded? No. Did they tell you it is compounded every 3 months or anything? No. So what will you do? 220 is the price today into 1 plus, what is the rate of interest? 0.15. 0.15 into, what is the number of months you want it for? 3 by 12. So 0.15 divided by 4 plus 1 into 220. What are you getting? 228.25. If it is 228.25, what is the price today of that future? 230. What is the price of the future? 230. Oh, dividend is there, sorry. 228.25 minus 2.5. Minus 2.5, so 225.75. What is the price of the future? 230. That means arbitrage opportunity exists. If it is at 230, that means it is overvalued. If it is overvalued, sell the future. Buy the stock today by borrowing money. Clear? This should be the action. Clear till here? Now, see this. Fair value of the future, 225.75. Okay. Future is overvalued. Enter into future contract to sell and buy stock in spot at 220 by borrowing at 15% per annum. So now what will happen on settlement date? Sell the stock at 230, repay the loan at 225.75. 4.25 is your arbitrage gain. Is this clear? Any doubt? Now this much only is the question. Examination question is only this much. I just added one sub question. What if the future price was 222? 225.75, but the price is 222. That means it is undervalued. If it is undervalued, what you will do? Buy the future, sell the spot. Buy the future and sell at the spot rate. So therefore, futures are undervalued. Enter into future contract to buy and sell the stock in the spot market at 220 by entering into stock lending and borrowing scheme. Now, when you sell it at 220, when you get the money, you go and invest it. Receive 220, invest it at 15% for 3 months. Clear? Then after 3 months, what you will do? Buy the share at 222 under the future contract. Return the stock which was borrowed under stock lending scheme along with the 2.5 rupees dividend. Are you getting this? You are going to return the stock along with what? 2.5 rupees dividend, because dividend is not yours. You borrowed the share. Okay, you borrowed the share and you sold the share. You borrowed the share today and you sold the share. Now, don't you think when you're returning the share to that guy, he deserves to get the 2.5 rupees dividend? 2.5 rupees dividend has been declared by the company in these 3 months. That actual money should go to whom? That guy who gave you the shares. So when you're returning the share, you will give the 2.5 rupees dividend also to that person. So inflow on sale of shares is 220. How much did you get when you sold the shares today in spot? You got 220. Interest on the investment is how much? 220 into 15% into 3 by 12. You got how much interest? 8.25. You invested, you got 8.25. Then payment on purchase of the shares, how much? 222. 6.25. Payment of dividend 2.5. You get 3.75 profit. Yes, 3.75 profit. Is this clear till here? Are you getting this? Okay, so whenever you borrow the share under stock lending scheme, in the previous example which we had taken, there was no dividend itself. There was no dividend itself. So if you are borrowing the share Whatever you want to do with that share, no problem. But when you're returning the share, between your borrowing date of the share and the repayment date of the share, if at all company had given dividend, that dividend should go to whom? It should go to the pocket of that person. So when you're returning the share, you'll pay the dividend amount also to that guy. Now my question is, did you get this dividend? Now my question is, you gave 2.5 to that guy, but did you get this dividend? No. Yes. You did not get this dividend. Because you borrowed the share today, immediately you sold the share. You borrowed the share today under lending scheme and you sold the share off. You sold the share. After that, later you bought back the share in the market and you returned the share. But when you're returning the share, you can't give just the share. In these 3 months, that fellow doesn't bother about what you did. But when you're returning the share, that 2.5 rupees dividend also, you will give it to that guy. Is this clear? Are you following this? Now, you don't have to worry about it because when you got your fair future price, in that dividend was already incorporated. When you calculated fair future price, that 2.5 was already subtracted. After that only you told arbitrage opportunity existed. Clear? But if ICAI asks you, what is the cash flow in this transaction on the settlement date? You will present it like this. Inflow on sale of shares, you got 220. Interest on investment, you got 8.25. Interest will be on 220, 15%, 3 months. Then payment on purchase of shares, when you execute your future contract, you have to purchase the shares. That time you have to pay 222 because 222 was the price. Then you got 6.25, but don't be happy with the 6.25. You have to pay 2.5 dividend also. Then whatever remains is your arbitrage gain. Are you clear with this? In between what? Still, you will give dividend only. You will give that amount only. Here also you are not receiving the 2.5. Here also you have not received 2.5. That you will consider. When you are calculating the theoretical price, you are actually telling that dividend is receivable in next 2 months. That is why you are subtracting it. When you are calculating fair future price, does it mean that you know that dividend is given today itself? No, right? When I'm calculating the fair future price, I'm telling, okay, for how many months is this future contract? 3 months. Then I will go and check. In these 3 months, is the company expected to declare dividend? Yes, it's an estimate that we are making. Company is expected to declare dividend in this next 3 months. So that dividend amount also I'll take present value minus it and then I will give it off. Now your question is what? If there is one, okay, you minus it. 2.5 rupees. Here, no. Here you will give him 2.5. Here he doesn't know about present value, future value. No. Are you thinking that, oh, I received the dividend at 2.5, but I will return the money to that guy at the end of 3rd month, so I have to take this 2.5 to future value? Is that your question? When you're calculating fair future price, you already did that, no? See, for example, you have the price in the spot is 500 rupees. Price in the spot is 500 rupees and interest rate is 15%. Okay, normal interest rate 15%. And 3 months future is traded at 450 rupees. Okay, 3 months future in the market. Okay, market, it is traded at 450 rupees. Dividend of 30 rupees. Okay, receivable after 2 months. Receivable after 2 months. This is the situation. Now, arbitrage is possible or not, you have to check. Okay, now what is the fair future price? Fair future price, what will you do? 500. Okay, into 1 plus 0.15 into 3 divided by 12. So 0.15 into 3 divided by 12 plus 1 into 500, you will get 518.75. Clear? Minus dividend. You will minus the dividend. How much dividend you are going to minus? Dividend will be how much? 30 rupees. But 30 rupees is after 2 months. So what I'll take the dividend also forward. So it will become dividend 30 rupees into 1 plus 0.15 into 1 divided by 12. 0.15 divided by 12 plus 1 into 30 rupees. 30.375. So 518.75 minus 30.375, you are getting 488.375 as the fair future price. 488.375 is the fair future price. Clear? Now, what is the market price of the future? Market price of the future is 450. Therefore, it is undervalued. Therefore, it is undervalued. Now, what is the action that you are going to take to complete your arbitrage? Undervalued. So, therefore, buy futures. Buy future means enter into an agreement to buy future at what price? 450. At what price? 450. Now, and sell stock. Sell the spot at rupees. What is the price today in the spot? 500 rupees. Sell the spot at 500 rupees. Is this clear? Sold. Sold. Now what will you do? Invest at rupees 500. Obviously, this came to you from SLV only. Okay, that is an understood thing. You don't have to write it in the exam. It came to you through SLV only. Now, invest 500 rupees. Clear? For how many months? For 3 months. Clear? Now, after 3 months, you are seeing your position. After 3 months, what happens now? Amount received. After 3 months, what is the amount received? Amount received is 500 plus you will get the interest on investment. Interest on investment will be, let's calculate 500 into 15% into 3 by 12. 18 point. So total you have 518.75. Correct? 518.75. Now what will you do? Buy the stock. Buy the stock which was under future. Settle the future. That was how much? 450. 450. That means you are getting 68.75. Okay, this is not your arbitrage gain. Now, if you are thinking this is your arbitrage gain in this situation, this is not your arbitrage gain. You have to pay the dividend money also. Minus dividend amount to SLV. Okay, how much was the dividend amount? Dividend amount was 30. Now, if you're thinking 30.375, that is because you took it to future. 30 rupees is what he is expecting. 38.75. Difference between fair future price and market value of the future was actually 38.75 only. 38.375 only. Are you getting my point now? So there, when you're calculating a fair future price, you will take it to future value or you will bring it to present value. But ultimately, your arbitrage gain should be 38.375. Now, in the exam, don't stop over here and tell 68.75 is your arbitrage gain. No, because when you're returning the share, that fellow will ask for 30 rupees. So 30 rupees dividend you will give it to him. Now you are thinking, sir, that fellow will not ask interest on that dividend. No. That fellow will not ask you, hey, you got the dividend I should have received the dividend 2 months back. In 1 month now, 2 months if I invested, then I would have earned interest. That doesn't happen. Okay, so the dividend amount is returned to that person and 38.75. Yes, if you want, you can take this as an example in the notes. Done. Yes, can I scroll till here? I should try and finish till futures today. Okay. I thought of taking options also, but I don't think I can take today. So till futures we'll finish, and then tomorrow we'll start with options. So that when you go and revise, futures are properly sitting in your head. When options come, you should not get confused with futures. There also there will be hedging. There also there will be arbitrage. But it's in a different manner over there. Yes, can we go further? Done. So we have finished till here. Now I hope you understood what is payment of dividend, how it works. Okay, now settlement of futures. We'll go and check the material. So this was the entire point what we discussed till now. Reverse cash and carry arbitrage, cash and carry arbitrage. Now we are going into settlement of future contract. Now, settlement of future, try to understand. Focus on this part over here. Settlement of future means what? On the future date, if you have agreed to buy, you have to buy. On the future date, if you have agreed to sell, you have to sell. Correct? So, usually what we discussed till now is delivery. Delivery means what? You told you'll buy shares, come and buy the shares. You told you'll sell shares, come and sell the shares. That is actually buy and sell shares at originally agreed price. Clear? That is the situation. Now, if at all, now see, as you go further, you will see some other thing also. Imagine I am telling about index futures. Index futures means what? I am betting on the index only. Okay, I am putting money on the index, telling that the Sensex will go up or Sensex will go down. Now, can I go and buy the index? Index is just an imaginary point based on the market, right? So, I cannot go and buy the index. That time it will be price difference. Price difference is pay or receive difference between future price agreed and the spot price on due date. Now, you cannot do delivery, no. So, what you will do? Now, see, come out of arbitrage. Arbitrage is done. Now come out of arbitrage. Don't think that I will buy and keep, then I will sell nothing. That is only when you see an opportunity, you will do arbitrage. Otherwise, if you enter into a future contract and on that day, if delivery is not mentioned, sorry, actually in exams, what if they don't mention, we always consider it as delivery only. But if it is price difference, what will happen? The future, I was supposed to buy it at 616. On that day, the price is 620. I pay 4 rupees. Sorry, I get 4 rupees. I get 4 rupees because I am supposed to buy at 616. Market price is 620, so I'll get 4 rupees. So imagine 616, I told I'll sell. I'll sell at 616. But market price on that day 610. Market price on that day 610. So 6 rupees what? Will you get or we have to pay? You are going to sell at 616. That means you have to buy at 610. So 6 rupees you will have to pay. So here also 6 rupees you will get. You will not pay. Price difference you will get. Are you getting this? Understand this. If it was 100 rupees and you told you will buy it at 100 rupees. You told you will buy it at 100 rupees. On that day, the price was 102. Just think like this. That means you have to buy at 100 and sell it at 102. That means price difference you will get 2 rupees. Clear? If you are telling at 100 rupees, I will sell it. I have agreed to sell it at 100 rupees. But that day market price was 102. Now you think like this. You have to sell at 100, but you have to buy at 102. So 2 rupees you have to pay. 2 rupees you have to pay. Other way around, if you have agreed to sell at 100 and the market price has become 94. That means you'll sell at 100, buy at 94. Price difference you will get 6 rupees. Is this clear? Yes, this is price difference. Usually in the market, this is what happens. That future which I showed you on the screen, their physical delivery won't happen. Price difference will get adjusted. Clear? Now, long future contract. Let's say example 50 shares. Long future contract. Long future contract means what? I have agreed to buy. I have agreed to buy 50 shares. Long future contract. Expiring on 31st of March 2021. Now in exam. Futures expiring on 31st of March 2021 at 25. If they tell at 25. Spot price on that day is 25.5. So now settlement will be 50 shares at 25, 1250. Because you agreed for 25, no. So physical delivery will be 50 shares at 25, 1250. But imagine there is no information about future. They don't tell you what is the future price. They just tell you have entered into 3 months future. That time you have no other option. You will do delivery at spot price at 50 shares into 25.5. Clear? This is just from examination point of view. And in this example, all that we have discussed is only delivery. If ICAI doesn't tell anything, that means what will happen is delivery of shares. Price difference is only if they mention. Clear? Now, understand this question again. I agreed to buy, I should go and buy. No arbitrage. Forget about arbitrage. Done. Arbitrage done. I agreed to buy, I should go and buy. In the question, if they tell you 3 months future price is 25 and on 31st of expiring on 31st of March and spot price on that day is 25.5. What I should do? I should go and buy at 25. That's it. Okay. If they don't tell me this, then I have to use the spot price rate because I don't have any other values. I'll have to do that. For delivery, if it is price difference, what will happen? You have to buy at this. You have to buy at this and sell at this. So 0.5 rupees you will get profit. If it is price difference like that. If it is delivery also, you'll go and buy at 25. You'll come out and sell it in the market at 25.5. Is this clear? That is how it is going to work. This is a small concept called as settlement of futures. Now 2 modes. We'll just discuss this 2 modes. Price difference. Price difference is pay or receive the difference amount between future price agreed originally versus spot price prevailing on the due date. Future price you agreed 100 rupees, but on that day the price is how much? 102 rupees. 2 rupees will be the difference which you have to pay or receive. Index futures are allowed, always settled by price difference. I told you, you cannot go and buy the index future. No, it is not possible, or sell the index future. Price difference. Since an index cannot be delivered in spot, you cannot deliver the index. By actual delivery, that is actually buy or sell shares at originally agreed future price. If question is silent about the mode of settlement and future price on expiry date is not given in question, settle the stock future contract through delivery. Now, convergence of future price and spot price on expiry date. See, gold future price is 60,500. Gold spot price is 60,000. So, what we have to understand is, actually, on that day, the rate should become that only, no? If you have calculated, the rate should become that. If there is difference only, then arbitrage comes into picture. So, ideally, future price on expiry date should exactly equal the spot price on the last date. Actually, future price and spot price should be exactly matching. If it is not matching, no, that day only somebody can buy and sell. There are a lot of people on the expiry date, they make profit because they see small variant difference. Okay. However, practically there could be some minor differences in exam. If actual future price on due date is given, use it. Otherwise, use the spot price. Clear? This is what we saw with the example. If you see actual future price in the exam, use that. Otherwise, you use the spot rate. Clear? Yes. How to find equivalent rates. We'll not go to that now. When we go into options, we will discuss this part. We'll keep that pending. It's not required. All this natural log and all we have to see. It's not required in futures. Now, commodities. Till now, what we were doing? Arbitrage of only stock. When no dividend is there. When dividend is given in absolute terms. Dividend is given in dividend yield percentage. Now, when you're talking about commodities, we have 2 types of commodities. One is investment commodity. What is investment commodity? That is basically gold, silver, all those things which you carry as an investment. Okay, then there is case 5. That is consumption commodity. Consumption commodity is what? Non-carry type commodity. That is example wheat, rice, barley, all these things. Okay, these are also commodities. Sugar, all those things. So, if discrete compounding, same logic applies. Okay, compounding frequency not given. Or if continuous compounding, same formulas are same. There is some small modification in the formula which we'll see that, but otherwise the formula is same. Ultimate thing is what? Spot price plus interest plus storage cost minus income. Now, we will go into the example and discuss that, and then we'll come back. Commodities. See over here. Spot price plus storage cost. Now imagine if I'm telling about gold. Okay, I'm telling about gold. Now I'm telling boss, I will come after 3 months and buy gold from you. I've already entered into a commodity future with you. Till now I was entering into stock future with you. I told that after 3 months I'll come and buy gold from you at a predetermined price. Clear? Okay. Now today's spot price is something. How will you find the fair future price? Today's spot price is something. Now that guy, to keep that 3 months, no, to hold that gold for 3 months, imagine he's keeping in bank locker also. He has to pay locker rent. Okay, he has to keep that gold, hold that gold for 3 months. So you'll add the storage cost. Storage cost is added. Till now, storage cost was not there in any of the other questions because we were talking about shares. For shares, also there is storage cost. That is the demat charges which I told you, which is very negligible. So it is ignored. Now, then you are going to add interest. Interest for what? For whatever time period, 3 months. Okay, then minus income. What is this income? He has rented this gold. He has rented this gold and he has made money in these 3 months. Okay, minus. Huh? No, that is up to him. No. Storage cost, see now, for example, whether he stores or not, like it's like in wheat and all. If you take cold storage facility, whether the wheat is there or not, you have to pay the cold storage facility rent. No. Did you understand? Now, bank locker also, if you have removed from locker and you have given it on rent, locker rent will still pay. No, empty locker also will pay rent. No. Okay, now, one extra thing that got added over here is convenience yield. What is convenience yield? I entered into future telling that I'll buy gold from you after 3 months. If I had purchased gold today, that means you are going to keep my gold for 3 months. In these 3 months, no, I could have owned that gold and gone to many functions. I could have used that commodity for 3 months and I could have owned that gold and gone to many functions. So there is a convenience benefit that you are getting that I am going to minus. Are you getting what is the convenience? Obviously, exam may, if it is there in the question only, you can subtract it. You cannot calculate convenience yield. So convenience yield is what? Now, for example, gold. I am going to buy gold after 3 months. So therefore, for 3 months, you are going to enjoy this gold. And you can make ornaments out of this gold and wear it and go around. Correct? That convenience benefit, convenience of using the commodity, I don't have. So what I'm going to do? I'm going to subtract that as yield. Basically, it's like an opportunity gain. My opportunity gain, no, I am subtracting over here. Clear? Think of wheat. I told I'll come and buy wheat after 3 months. Okay, wheat after 3 months, I told I'll come and buy. In that 3 months, what you have done? You have stored the wheat, all that you have done. Okay, now you have rented this wheat also. Wheat you can't rent, just an example. Now, you're like, boss, if I had this wheat for 3 months, I could have made chapatis and eaten it. Now you made chapatis and ate this. Correct? With that, you gained some protein and other things. And also you got diabetes also. That's a different thing. Okay. So now these are the situations which are there. That is why this convenience yield comes into picture. Clear? Now, fair future price. So from our regular format, what got extra added is storage cost, which was not there in shares. Income is still there. All this has to be mentioned in the question itself. Fair future price. Now, I'm taking the example of gold futures. Example is gold future. Gold future is there for 3 months. Rate of interest is 15%. Storage cost is 5,000 rupees per month for gold. Income is 2,000 rupees per month. Then spot is 10,000. Convenience yield. Convenience yield is 2%. Out of that gold, no, the convenience yield is 2%. So what you will do, directly from this 15%, you will remove 2% and then you will do your calculations. Directly, how we did when we had dividend yield, like that only from the interest rate, you will remove the yield percentage, net interest you will use for your future value calculation. Clear? Now, solution you see. 10,000 rupees is the spot rate. Now, storage cost is there. 5,000 rupees per month. 5,000 rupees per month. So what you are going to do? You are going to add the storage cost. You are going to add the storage cost. Again, you can take alternative route. What is that? 5,000 I'll pay at the end of first month. So I'll take it to the third month. 5,000 I'm going to pay at the end of second month. I'll take it to the third month. 5,000 I'm going to pay at the end of third month. It is already in third month only. Clear? That also you can do. Or what I have done, taken, I have not given multiple alternatives here because we already discussed the alternatives. I have taken present value of that 5,000 rupees. Present value of that 5,000 rupees, take your calculator, 1 divided by, this is wrong. This is wrong. Okay, my rates are wrong here. It should not be by 15%, it should be by 13%. 1 divided by 1.13 is equal to, it will is 0.885 is equal to 0.783 is equal to 0.693. So 0.885 plus 0.783 plus 0.693 into 5,000, 11,805. 11,805. Is this clear? Why we have to take 13%? Because that convenience yield is there. So 13%. Okay, then minus income. Income also, I think I have taken 15% only. 1 divided, so it will be 0.885 plus 0.783 plus 0.693. 2.359. 2.359. Is it 359? Sorry, 2.361. Okay, now income will be what? 2000 into 2000 into 2.361. You will get 4722. Clear? Is this clear till here? We'll do one thing. Give me 1 second. You have to be lazy sometimes. Okay, commodity futures. Okay, commodity futures. So now here, this would be 0 point. This is what oh, you can't see it. Huh? Magic. Yeah, this will be 0.885. 0.885 is equal to 0.783 is equal to 0.693. Okay, so now you have 0.885 plus 0.783 plus 0.693, 2.361 into 5,000, you will get 11,805, and here 2,000 into 2.361, 4722. 4722. So 10,000 plus 11,805 minus 4722 will give you 17,083. Clear? This is the value, 17,083. So future value will be 17,083 into 1 plus 0.15 minus 0.02. That means 0.13. Okay, into how many months we want? 3 divided by 12 plus 1 into 17,083. You should get your future value as 17,638. 17,638. Is this clear? Okay. What you have to understand is the present value factors should be at the rate of 13% after removing the convenience yield. Now, if at all the 15% compounded semi-annually, if it is compounded semi-annually, now what will happen? This is 10,000. This is why I switched the tab. So that correction will happen here only. Then I can send it after class directly. Otherwise, there I have to see that and again correct it. No. That's why I told. Being lazy helps sometimes. Okay, so now, no, actually, you know what? Being lazy helps a lot of times. But not in CA exams. CA exams, it doesn't work. Like you might, survive in life because of being lazy sometimes, but in CA exams it doesn't work. Like I have a friend who survived this thing. Plane this thing, plane attack. I mean, plane crash, just because of being lazy. You won't believe, we were in school when this happened. There is one guy in our school, okay? Now, in I don't remember exactly, it was 2008, 2007, somewhere there, 2006, 2009, somewhere there, I don't remember. There was an air crash in Mangalore. Okay, there was a Air India Express plane which was coming from Dubai, it crashed. Now, when it crashed, no, our Mangalore airport is like this actually. That is the hill and this is the runway. Okay, all other airports, no, when you land, when the plane is going lower and lower, you can see the airport, like, okay, their airport is there, now it's going to land. You can see the airport. Mangalore airport, you can't see land and all. You can't see the airport itself. When it's lowering, no, you'll be seeing full greenery, forest, okay, nearby. First time you will see the runway is when the plane hits the runway. First time you are going to see the runway is it hits the runway, because the plane has to land exactly over here. Then it can stop. So there was this friend of ours, April, May we used to have holidays. So his parents were working in Dubai. So he had gone there on vacation and then he was coming back because school was about to reopen. So he was in this plane. Now when it is landing, actually how it landed, the airport is actually unsafe. Not unsafe, it's risky airport. But it was not because of airport that the plane crashed. That is because of the pilot. What pilot did? Pilot went to sleep. Pilots do sleep in the plane, that is normal, they sleep. But they got up. It was a early morning flight. I think it must have left Dubai at some 2 o'clock or something. It landed here at some 6 o'clock, 6:30 something. Okay, so now this fellow, when he was pilot, no, he just got up. You know, when you get up, you will not be fresh, no. Your reactions and reflex and all will not be accurate and fast. So they landed the plane over here in the middle. Okay, now actually they have built very, very strong walls at the edge of the airport. If you would apply complete brakes, no, it would go and hit that wall and it would stop. Plane would get damaged. Maybe pilots also might have gotten injured and all, because they'll be directly at the impact. Okay, but it would not fall down. But when it landed over here, he thought, oh, now we'll have to take off and come back again. So they applied the acceleration to take off. There was no enough place for takeoff also. So it went with full force, little above the wall, and fell into the jungle there down. So when it fell into the jungle, no, my friend was there. I mean, our friend was there in that plane. This guy was lazy. They told him that you have to wear seatbelt when landing. Okay, he was lazy. He didn't wear the seatbelt. So, and luckily he was at the right place at the right time. His seat was the 10A or 11A, where it's right on the wing only. It's on the wing, and when the plane falls, usually it is joined at the wing, no? So it broke at the wing. All that this guy had to do was get up, look out, jump and run. That's it. All that he had to do was jump and run. That's all. So and it was easy for him to jump and run because he didn't wear the seatbelt. So it was easy for him. And the guy next to him also, he wore the seatbelt, but he also saw this guy jumping and running. He also ran. These two guys just ran. Only 4 people survived this air crash. These two guys just ran. And they were telling that some 40 seconds, 50 seconds after running, no, further entire plane exploded. Fuel, no, so much, it just exploded. And many people, no, they died because they also wanted to run. But that seatbelt sometimes gets jammed on impact. So you're not able to free yourself. So many dead bodies were in sitting position only like this. So all that he did was, he was just lazy. Lazy to wear the seatbelt also. And he just jumped and ran, that's all. Now, 2 things I have to tell you. Don't try this, okay? Like how in WWE and all they tell you, do not try this at home. Like this, don't try, because air travel is there, no? Is supposed to be one of the safest modes of travel. Air travel is supposed to be one of the safest modes of travel. Okay, now, where did it go? Aeroplane. Here it is. 99.99% your plane won't crash. Now that time if you don't wear seatbelt, I'll tell you what will happen. Imagine you went to sleep and plane landed. That time you didn't wear seatbelt, no. Your face will hit the front seat and you lose your 2 teeth. That's it. Then you can't smile for the rest of your life. That is the only thing that can happen. Okay, he was just there, lucky at the right place at the right time. And the other guy, even more lucky. He saw this guy and he also reacted. Now I told 4 people were there. 2 people I told you the story. Other two, you know how they survived. The seat broke off and the seat was thrown away. When they were doing the search operation, after some 2 hours, no, they found 2 seats and people are unconscious. And they were woken up and they were like, oh, we are alive. Luck. It's just luck sometimes. But this guy was damn lazy, so he survived it. Till today also, thank God, not lazy to run. Yeah. Now see, I'll tell you, okay, it's not like, don't get into the gender war. Okay. I feel strongly that if at all it was a girl in his place, she wouldn't have run. She wouldn't have survived it. I'll tell you why. Because if it was a girl, no, she wouldn't have run. She would search for the baggage, for the luggage. Ayo, my luggage is there. In that autumnal gifts we have bought. Okay, they would search for the luggage and by that time the plane would have exploded. This guy, it seems later they asked, what about your luggage? Oh, I forgot the luggage itself. he didn't know that about the luggage. That thought didn't come to his head also. So, obviously in the handbag there would be like mobile and so many other expensive things, right? So if it was a woman there, they would have been like, first we'll take the luggage also, then we'll run. By that time the plane would have exploded. Yes. So being lazy sometimes helps, but we were very jealous that he survived when we were in school because suddenly he was getting full attention. In the assembly, he had to go and talk. News channel and all, his interview was coming. In the local newspaper, his article was there. You're like, this guy, what attention he's getting suddenly. Okay, now when we meet, we still make fun of him, telling that, like, whoever died, no, in that air crash, each of their families, they got 80 lakhs. 40 lakhs from the airline company and 40 lakhs from the insurance which the airline company took on the passengers. So totally 80 lakh rupees. 40 lakhs was released within like 1 week. It was released to all the family members. Other 40 lakhs came after some 3-4 months it came. Okay, so they got 80 lakhs. So now we tell him, see, your family would have been rich. Okay, there also you didn't allow your family to be rich. You ran and made them poor. Okay, just for fun, just to pull his leg. But otherwise we are also happy he survived. Okay, let's continue. So don't be lazy in planes because road accident chances are higher than air accidents. I know in the last 1 year it has been high because of a lot of factors, but otherwise usually air travel is supposed to be very safe compared to all. Even water travel also it's risky. Anything can happen. There can be a sudden change in weather in the sea and anything can happen. Okay, now 15% compounded semi-annually. Now, here also there is a mistake which we have to correct. It's going to be 0.13 divided by 2, 0.13 again and 0.13. Why it is divided by 2? Because it is semi-annual, so divided by 2. And here it is first month out of 6 months, second month out of 6 months, third month out of 6 months. Clear? So this is going to be basically 0.13 divided by 2 plus 1. 1.065. Oh, or not, no. It will not be 1.065. You have to do the math. We'll have to do the math. How will you do the math? 0.13 divided by 2 plus 1. Okay, 1.065. So 1.065 square root 12 times. Took that square root 12 times. Now what will you do? Minus 1. Into 1 divided by 6, okay, plus 1, then 12 times into is equal to what? I think 1.0105, right? Yes, 1.0105, which I am writing it as 1.0106. Okay, and this side same circus again, 1.065. $1.0212. Is it 1.0212? Cross check these numbers. Third year, 1.065. $1.0319. 1.0319. Huh? Got these numbers? So now you have to just do 5000 divided by 1.0106. Okay, 1.0320. You can round it off. Yes. So you'll take your calculator. 5000 divided by 1.0106 m plus 5000 divided by 1.0212 m plus 5000 divided by 1.0320 m plus. So you're getting totally some random number. Yes, how much did you get? 14,689. Now present value of income. Luckily, present value of income, you don't have to do the calculation again. You already know it, 1.0106, and here it is 1.0212, and here it is 1.0320. Now take your calculator. 2000 divided by 1.0106 m plus 2000 divided by 1.0212 m plus 2000 divided by 1.0320 m plus 5875. Are you getting 5875? Yes. Now what will you do? Take your spot rate 10,000 minus the storage cost 14,689, and this is minus, sorry, my bad, 10,000 plus 14,689 and minus the income 5875. You should get 18,814. Are you getting 18,814? Clear? This, and now what will you do? 18,814. 18,814 into 3 by 6. So it will be 18,814 into 1.0320, 19,416. Don't do square again. 12 times. Already for 3 by 6 we have no number over here. Okay, so directly we can put 1.0320, but this time you are going to multiply, not divide, because you are taking the future value. Is this clear? Okay, this is what we did for when it is compounded semi-annually. 14,689. Yes, 14,689 is correct. Now, the last one which we have to discuss, if 15% is continuously compounded, 15% continuously compounded, again that same mistake is there which we have to correct. It will become good revision of calculation for you guys. Now, here what happens, spot rate is how much? 10,000. Then storage cost, 5,000 divided by 0.13 into 1 by 12, 0.13 into 2 by 12, 0.13 into 3 by 12. Clear? 0.13 into 1 by 12, 0.13 into 2 by 12, 0.13 into 3 by 12. Keep your values open and find out the values. Value sheet is here. Yes. So 0.0125. Wait. 0.13 divided by 12, you will get 0.01083. 0.01083. And here you will get 0.13 into 2 by 12, you will get 0.02167. 0.02167. And here you will get 0.13 into 3 by 12, you will get 0.0325. 0.0325. Is this clear? Now find the values. Interpolation in every single situation. You have to take interpolation in every single situation. First one, it is 0.01. 0.01 is 1.01005. Then 1.0202 minus 1.01005 divided by 0.01 into 0.00083. I think you should get 1.01089. Just check if you're getting this. 1.01089. Yes. Who did not get it, do it. You should get it in your calculator. Okay, then second one is 1.0202 m plus 1.03045 minus 1.0202 divided by 0.01 into, what is the value here? 1.00167. You should get 1.0219. 191 if you want to give one more decimal. And here it is 0.0325. So you will take 0.03 ka, it is 1.03045 m plus. Then 0.04 is 1.04081 minus 1.03045. Okay, divided by 0.01 into, what is the difference? You have to calculate 0.0025. That time you will get 1.033004. Just check if you got these numbers. Yes. Now you have to do the math. 5000 divided by 1.01089 m plus 5000 divided by 1.02191 m plus 5000 divided by 1.03304 m plus. So you'll get 14,679. 14,679. Then you have to do the same calculation for the income also. 1.01089. Here it is 1.02191. 191, and here it is 1.03304. So you'll get 2000 divided by 1.01089 m plus 2000 divided by 1.02191 m plus 2000 divided by 1.03304 m plus. You'll get 5872. 5872. Now 10,000 plus 14,679 minus 5872. You'll get 18,807. 18,807. Is this clear? Now, what will you do? 18,807. 18,807 into e to the power of 0.0325. That we already know it is 1.03304. So 18,807. 18,807 and 18,807. 18,807 into 1.03304, you will get 19,428. Done? Yes. This will be exactly like shares only. Only extra thing is storage cost will be added. Storage cost, either calculate present value of that and then take everything to future value, or take storage cost every year to the every month you take it to the future value, and there it will get added. Income also take the present value of that and minus it today only, or you can take the income also to the future value. Okay, convenience yield, whatever you get from your rate of interest minus the convenience yield, and then you calculate everything else. Is this clear? This is when we are talking about commodity futures. There is a 5% chance of them asking question even on commodity futures. Just remember, if you have done stock futures properly and revised the commodity future concept, you'll be able to do it. Okay, there is no extra fitting anything that is going to come over here. What was dividend yield over there will be having the same treatment over here in the form of convenience yield. Yes, that should be it with that particular thing. Let's go into the next topic. Here, everyone finished? Now, this is already discussed and corrected also. So don't worry, when I send the sheet to you, it will be corrected. Then this topic we have already seen. Meaning of convenience yield. You see, one who buys a commodity in spot also enjoys the convenience of consuming or using such commodity during the times of need. If somebody buys gold, they can wear it, they can sell it, they can use it in times of need. They can pledge it and take loan, all that is there. But this convenience is not enjoyed by future contract buyer. Hence, he'll deduct the convenience yield. Clear? We already saw that. Examination tip: if convenience yield is given in rupee terms instead of percentage terms, what you'll do? You'll go to your dividend methodology, what we used to follow, absolute terms. Absolute terms, that also take it present value or take it to future value and you calculate. Then formula changes to C minus C. It is not incorporated in the formula. In the rate of interest, it is directly minus C as an absolute term. Here C means present value of convenience yield. We know we have to take present value. We can take future value also. Doesn't matter at all. Okay, exponential table. We have already had it. Regularly kept it. Next, we'll go into the next part, which is stock lending and borrowing scheme. 1 or 2 questions are there in the material which we can expect in the exam also. Stock lending and borrowing scheme. Clear? It's not there. It's not there. It's not there over there. Now, just to explain the concept to you, stock lending and borrowing scheme, understand, there is a long-term investor. Long-term investor. Okay. He has invested in shares and he's like, for next 20 years, I will not take money at all. I will not sell that shares at all. Now, that fellow, instead of simply sitting with those shares, what he will do? He will lend. He will lend that share to a short seller. Who will lend that share to? A short seller. Okay. Now, this short seller, what he will do? He'll go to the stock exchange and he will short sale it. Basically, for the stock exchange, it's not short sale. It's just sale of shares. From where the shares came to this guy, that is irrelevant to the stock market. So now he will sell those shares, and after that, whatever reason for which he did this, when that time period is completed, then he will buy the share from the market. If you had futures, using the futures, you will buy the share from the market, and then you will return the share to the lender. Clear? This is the entire structure of stock lending and borrowing scheme. Clear? Now, they can ask you a question like this, where they tell you, compute the total earnings of the lender. Compute the total earnings of the lender. Now, think from lender's point of view. What he got? He will charge some lending charges or fees per share. He will tell 2 rupees per share I will charge, 5 rupees per share I will charge, whatever it is, depending on the share price. So, per share he will charge some fees. No, this fees was not considered when we are looking at arbitrage. Are you getting my point? This was ignored when we were doing the arbitrage point because they have not incorporated those concepts together, because it becomes extremely practical and extremely tricky also in the exam hall. So therefore here lending charges are there. Lending charges means per share they'll pay some amount. For the lender, that's an income, no? Then dividend received per share. Add that. Remember that fellow was paying dividend per share. So dividend received per share, add it. Total earnings per share. If they ask total earnings, multiply into the number of shares, you'll get the total earnings. Here, ICAI asks two types of questions. One, they will tell, how much is the earning through stock lending and borrowing scheme? If you write this answer, no, they will give wrong and they give you 0 and go ahead. How much is the earnings through? Understand the wordings. How much is the earnings through stock lending and borrowing scheme? This is the earnings through stock lending and borrowing scheme. Now you're like, sir, what about the dividend? Dividend, if you would not lend the share also, you would get it. No. Are you getting my point? If you would not lend the shares and keep the shares in his pocket also, he would get that dividend. So through stock lending and borrowing scheme, how much he made? Only this much. From the lending and borrowing scheme, what he made is only this much. Clear? Now, total earnings. If they ask total earnings of the lender, not through stock lending and borrowing scheme, total earnings of the lender, then you can tell like this. Now, ICAI sometimes goes ahead and asks one more type of question. What is the total earnings per share? Total earnings per share. What will you do? You can stop at this point only. This is already in per share value only. Okay. Now, the other way around. Now, two parties in the contract. You have to look at the other person also. Total profit or loss of the borrower. Borrower, what he has to do? That fellow was getting the lending fees. This fellow has to pay the lending fees. So, when he has to pay, it's an outflow for him. Outflow. And sometimes you know what happens. Now see, imagine you go to one person who is having, let's say 1 lakh shares of Infosys. And you tell, boss, you do one thing. You give your 50,000 shares. And you take his 50,000 shares. I think right now Infosys is at 1,300 something. That is basically 6.5 crores. You took 50,000 shares, 6.5 crores you took. And then you are like, okay, with these shares, what I'll do now? Now I will short sale in the market. I sold it. Market crashed. Market crash. Good. Good. You did short sale. Market improved. That time you are in a bad situation. So what you will do? You will just leave it. Okay. And you will run away. You will leave it and you will run away. Now your bank got frozen. Everything got frozen. Fine. You are a what is a defaulter over here. But what about this guy? What about this guy? That guy gone. No. Murnama for him. No. That fellow cannot do anything. No. Now. So usually in such cases, no, what that fellow will tell, he will tell this person, please open one bank guarantee. What is bank guarantee? That is, bank is giving guarantee on behalf of this guy that don't worry, this money will be paid. Now why bank is doing that? Obviously that is one of the facilities which bank gives, and they will charge their charges also. And they obviously know the track record of this bank guarantee. Bank will not give to random person, anybody. Okay, so now bank would have pledged some other thing for this bank guarantee. He would have pledged his house and gotten the bank guarantee over here. So if he doesn't pay, bank will take his house. But for this bank guarantee, bank will charge some charges. for the person who has borrowed the share. This is also an outflow only. So how will you calculate price per share on the 0th time? Today, when I borrow the shares, what is the price in the market? That price into number of shares. Okay, into number of shares into, okay, I think we are calculating per share. So no, don't multiply into number of shares, just the price per share on 0 times. So we are calculating every charge for per share only. Bank guarantee cost percentage. They'll add some, they'll tell you some percentage, 8%, 7%, whatever it is. Okay, into n divided by 12. Let's say the lending was happening only for 3 months, 3 divided by 12. Or if it is given in days, 60 days, then 60 days divided by 365. Don't please use the bond techniques over here. Here will be assumed as 365 days unless they tell you that it is assumed as 360 days. Clear? So this will be an outflow again. Then what can happen? Two things. He sold the share and he made a profit. Or he sold the share and he incurred a loss. So gain on short sale of shares, inflow. Loss on short sale of share, outflow. Gain on short sale of share, inflow, or loss on short sale of share, outflow. So basically what? He saw that the market is bad. He took bank guarantee, went to this guy, take the bank guarantee, give me your shares. Took the shares, sold it at 100 rupees. Sold it at 100 rupees. Now, next after 5 days, let's say after 5 days, the price in the market fell to 70 rupees. So what he'll do immediately? He sold the shares, no. He'll buy the shares at 70, return that guy, that fellow's money. So that gain which he made, no, that is inflow for him. Imagine after 5 days, this will have taken borrowed the shares only for 5 days. After 5 days, the share went up to 130 rupees. Now he has no other option. He has to buy at 130 and return the share. So he made a loss on short sale of shares. So only the loss or profit is the cash flow item. Only the loss or profit is the cash flow item. Don't take the entire sale value as a cash flow item because the sale value is not the cash flow. That will not come to his pocket. This is like in capital budgeting, we do incremental approach. So basically you're like, why sale value is not taken? Sale value inflow. Okay, sale value inflow. Purchasing outflow. Net only is the cash flow which remains in my pocket. So that is why only the gain or sale on, gain or loss on sale of shares is considered. Both cannot be there. One of them will be there. Now you will get total profit or loss per share. If I say ask total profit, then you multiply into shares and keep. If I say doesn't, ask also, do this much and keep. I'll tell you why. Because in the answer key, we don't know whether they have given the answer per share or in totality. So write both answers and keep irrespective of what ICAI is asking. Clear? If they tell per share also, you multiply, give this part. If it is per share what they want, they'll correct this. They'll ignore this. They'll not give minus marks for this. If they want total, they'll correct that also. Clear? Yes, that should be it with the stock lending. I'm just leaving it on the screen. Let me know if you have any doubt. Done. If they ask this, no, this is unique. If they ask this, it is unique because it's not that many questions are not there. People on the last day wouldn't have revised this. They would have seen how to calculate the fair price of the future, how to do arbitrage, how to do hedging, which is our next topic, how to value the options, all those things they would have seen. Clear? So do not skip any topic anywhere. Actually, this AFM is one subject which can actually change the entire 2 groups. In FR, people will do selective study. In audit also, people will do selective study. Tax also, they'll do selective study. GST also, they'll do selective study. The last paper will not even discuss about that. We don't know what to study only there. Okay, that's a different thing. Okay, so now, ultimately, in AFM at any cost, no, don't do selective study. Study 100 marks. Whatever concept is there, everything you study and go. If at all you manage to score 80, no, in AFM, it'll change everything. Then you just require 40, not 40, but you require 40s in the other papers. 40 into 5 papers, 200 plus 80, 280. So you need somewhere around 45, 44, 45. Like that, if you get also in that range also, no. If your selective study works over there, you'll still get 300. This can be the game changer. Okay, and in fact, last exam also was not difficult. It was easy only. We saw the questions of last exam in many of the chapters which we have done. It was not difficult by any means. If you have done selective study, it is difficult. Okay, now the next big topic, hedging. Next big topic is hedging. 4 situations we have in hedging. Hedging a stock. First we are talking about hedging a stock. I have a stock. I don't have portfolio under. I just have a stock. I want to hedge my stock. I feel that the price will go up after 3 months or it will fall down after 3 months. I want to hedge this situation. Hedge means what? Protect myself from the risk. Clear? I have a stock. Now this can be hedged with stock futures that I showed you on the screen. That which was the stock I showed you? HDFC, right? HDFC has a future already, but HDFC has, Reliance has, or other big companies have. Imagine XYZ Limited, new company. Do you think the futures will be created in the market? No, there is no future there. I mean, there is no futures contract. Future is there. There is no futures contract. Correct? So every company trading in the stock exchange will not have a futures contract on their share. Will not have, because it depends on the demand and supply that is there. If 1 or 2 people want to take a futures contract, they will not have it. That is what we told. It is not a customized contract. It is a regulated contract, futures. What they are offering, that we can take. Now, I have a share. Let's try to understand the outline. I have some 50 shares. Let's say 50 shares of HDFC Bank. Okay, HDFC Bank. Now 50 shares of HDFC Bank, I want to hedge it. So what I'll do? I can use the stock future which is there. How to hedge all that we will see. Okay, I can use the stock future to hedge it. Now imagine I have stocks of, let's say, boat. Boat didn't get listed yet, but I'm just giving example. Boat ka future is not there. Futures are not there for boat. So now what I can do? Can I tell, oh, boat futures are not there? Now I don't know how to protect myself from the risk. Now what I'll do? I'll use index futures. Are you getting my point? Do you understand this? How to do it, we'll see later. I'm just telling you the mode what we are going to use. If the stock has a future, then you use that future contract to do the hedging. How to do it, we'll see. If a stock doesn't have a future contract, then what you will do? You will use the index futures. Index futures are always there. So you will take that. 2 situations which we have to cover, I have already outlined. Third situation is when we have portfolio. When we have a portfolio of shares now. When we have a portfolio of shares, I have to hedge it. Again, I can hedge it with what? Index futures. I can hedge it with index futures. For portfolio, which stock the future you will take? It is difficult, right? So you'll hedge it with index futures. Then obviously you can have a situation, you can also have a situation where you want to hedge your commodities. Commodity futures are also there. Clear? Now, so one by one we have to cover all these concepts. Hedging a single stock. Hedging a single stock. Full focus on this. Okay. We have to finish this hedging. After hedging, what we have? Nothing. Once we finish hedging, we'll go. Whenever we finish it. Let me give you a disclaimer. It's only 9:30, right? 9:30 is our regular time. Yes. Clear? Hedging is a very common question. Arbitrage is a very common question. Okay. So you have to focus on that. By the way, I was telling that story, right? That guy who survived. And I told him that because he was lazy, he survived. No, you can also sometimes be dumb and survive. You know that. You can be dumb and you can survive it. How?
That was my first experience. I didn't know what was happening there. Then that I heard about the others. It came down to 6,000 feet just by block.
That is air turbulence, no?
I don't know. Everyone was shopping.
You didn't feel gulu in your stomach? You are weird then. Air turbulence is more scary than air crash, you know that? Air turbulence, you won't die. But you will feel you are going to die. Uh,
completely dropped.
it will drop, yeah.
It dropped. My dad's friend was in Boston. He was completely sweating, everything, everyone came out. The whole time,
That we don't know why.
this is probably a thing that I don't know how I feel. Oh, yeah.
No, that is not dumb. But actually, air turbulence is very scary. Like Mangalore to Chennai, whenever I travel for classes, no, when I take the flight from Mangalore to Chennai, limited demand for that air route. So they don't have that big plane. They have that small plane from Mangalore to Chennai, and that doesn't fly at a very big height. So every time there is air turbulence in that, it's like, oh, you will feel so scared about air turbulence. Actually, air turbulence cannot kill anyone itself unless you don't wear seatbelt. If you don't wear seatbelt, when it suddenly drops, you can jump and hit the ceiling and you can die. But otherwise, nothing can kill you there. And for air hostess and all, air turbulence is common thing. They'll be like chilled when that happens. No, this is not the reason I told. I told you that the plane actually left at 2 o'clock something in the night. 2 o'clock. There are a couple of people who missed the plane. They saw their air ticket 2 o'clock. Okay. And they saw the date. Now, for example, today what is the date? 19th. Huh? If my ticket shows 19th of April 200 plane timings, that means that plane has already gone. That plane has already gone. It left in the night itself. Okay, they follow 24-hour format. Some people saw this 19th, 2 o'clock. Okay, afternoon. So they went directly 19th at around 12 o'clock to check in. Okay, that time the people over there would have been like, this plane already went and it also crashed. Lucky you are here. So good, you are a dumb person. But because of being dumb, no, you have survived this air crash. And there are also situations like, it seems there was one guy who was supposed to, what do you say, he was 3 years he was working in Dubai, he was supposed to come back, okay, for vacation. After 3 years he's coming to see his family, but then he got leave, but last moment he had some financial issues. He's like, oh, I'm not able to arrange money. So his friends contributed and bought ticket for him and sent him. They sent him directly to Kailasa itself. Not to Bangalore, they sent him directly to Kailasa. So, I mean, imagine how they will be feeling for the rest of their lives. Okay. And there are other people who are coming to get married and other things, all those things were there. Obviously, the person who was coming to get married, no. If at all he was sitting near the wing also, he would not survive. Because he would have bought a lot of gifts, no. He would be searching for his bag. Ayo, if I run like this, what gift I'll give? Yes. Hedging, single stock. First we'll focus on single stock, complete focus on hedging. Now, hedge using stock futures. Hedge using stock futures. Then we'll read the theory of this later. When you see the numerical, it'll make complete sense and then you can understand the theory. Okay, now imagine there is one person here, has shares of Infosys at 1500. He has shares of Infosys at 1500. He expects the share to reduce by 10%. And he had kept this share, okay, and let's say 3 months later, he wanted to sell this share and buy a car. Or he wanted to sell this share and buy a house. So he had kept this share for a particular purpose. Now he is expecting that, looking at the market, he feels it will fall by 10%. If it is going to fall by 10%, he is scared now. If he keeps it 1500 into 10%, 150 rupees per share is going to lose. He doesn't want to, imagine he has some 10,000 shares or something, it's a huge amount. Now what you can do, you are expecting the share to fall. Now you enter into a future contract. You enter into a future contract for the opposite. For the opposite. You are expecting the share to fall. No. If the share is going to fall, then what is good for you? Selling futures. Now I am expecting share to fall by 10%. Now it's 1500. Okay, fair future price and all. When I don't consider this fall in the market or raise in the market. I add storage cost, interest, dividend, I subtract, all that I do. Now, based on that, there is some pricing in the market. So I saw in the market, the futures are trading at 1450. Now you are like, okay, if I don't, I will lose 150 rupees. But here I am losing 50 rupees. Now hedging doesn't mean that you will make profit. Hedging means that you will save yourself from the risk. Now in the process of saving yourself from the risk, you might still incur some loss, but you are protecting yourself from the bigger loss. Are you getting my point? Later at the end of this contract, you will feel, oh, they had a loss, but they are protecting themselves from the bigger loss. So now, if you expect market to go up, okay, then you should today enter into an agreement with somebody else to buy at a predetermined price. So I'll buy here, market is sitting over here. If you are expecting the market to fall, then today I have to enter into an agreement with somebody to sell the shares at a predetermined price. If it is falling, it is over here. Now you're like, sir, wait. You thought it is falling, so you entered. Why that fool agreed? Because those fools only are there in the market, no. Because of two fools only market is there, no. One person is expecting it to fall, other person is expecting it to rise. That's why we have a future contract here. That's why two people are agreeing to buy and sell at a future date. Are you getting this? So don't think that if it is going to fall, why that person is going to agree to, buy the shares from you. If it is going to fall, why is agreeing to buy the shares from you at a higher price? Because he expects the company to, share price to increase. He is not expecting it to fall. Now, if it is increasing, he'll buy from you, sell it in the market. He means stock exchange because you are talking about futures. And in stock exchange means you are not dealing with stock exchange. You are dealing with somebody else in the stock exchange. Stock exchange is just an interface which is acting like an intermediary. So if I bought future contract, that means there is somebody else who is selling future contract over there. Two people just connected by the stock exchange. Are you getting this? So now if you expect the share to fall, reduce, then enter into opposite action. Enter into opposite action in futures. That means sell futures at 1450. Sell futures at 1450. Clear? When you are selling futures at 1450, you feel loss is 1500 minus 1450, 50 rupees loss. But it is limited to 50 rupees loss. Are you getting this? Whatever happens in the market, your loss per share will only be 50 rupees. Only be 50 rupees. Now see, after 3 months, what is your obligation after 3 months? Your obligation is to sell. Sell at what price? 1450. You had the shares over here. Here you are not doing arbitrage. Hedging is when you have the shares already. You are not borrowing and buying the shares and entering into hedging. That is called as speculation. Hedging means you have the shares. There is an underlying asset already. So you will sell the shares at 1450. If spot price after 3 months is 1200, then good, no? 1200, okay, protected himself from a loss of 250. 1450 minus 1200. If you would have held the shares, no, sitting at 1500 in his books. If you would not do hedging, then after 3 months, he will be selling at 1200 because the market price after 3 months was 1200. So he would have incurred 300 rupees loss. He protected himself from 250 rupees loss. Hedging is never a situation that you are not going to have any loss. Hedging is a situation you protect yourself from the bigger loss. Now you are like, sir, this fellow was mad actually. He could have quietly gone and taken a future on 1500 rupees only. That time he would have no loss at all. But that 1500 rupees future should be available now in the market. What was available was on 1450 only. Are you getting my point? Now if this fellow is expecting it to fall by 50 rupees, he will not go for future. He is expecting it to fall by 50 rupees, he will not go for future. He is expecting it to fall by more than 50 rupees. That's why he went for the future. Is it clear till here? Okay, this is when you protect yourself from the risk by entering into opposite action in the stock futures. Clear till here? Any doubts? I'm just leaving it on the screen for like 1 minute. Now what if this fellow was expecting the share to rise by 10%? If he is expecting that the share price will go up by 10%. Now will he go opposite action in the futures? Now he is expecting that this will go up by 10%. Will he buy futures that time? Why? Why he has to buy futures? Hedging is for protecting from risk. Are you getting my point? Now he feels that it is going to, no, he will not hedge. Yes. If he feels that it will fall down, it will fall down, no. 150 rupees gone, no. So what he will do? He will enter into an agreement with somebody that I have to sell at this price. So he'll sell futures. If he is expecting that the share price will be 1650, now if he is buying futures, he has to buy future at 1450. That time his market is at 1650 also. He'll have to, buy the stock at 1450 only and sell it in the market at 1650. Are you getting my point? That becomes arbitrage. That becomes arbitrage or it becomes speculation. So we are talking about hedging. You have stock. You fear for the worse. If you are happy or expecting a good thing, then you don't go into hedging itself. Are you getting this? Did you understand this part? Yes. Now, imagine Infosys shares he doesn't have. He has some other company, XYZ Limited shares he has. And there is no share future at all. There is no future. So now what he can do, see this situation. 5,000 shares he has of some company called as Bamboo. Okay, and the price is 150 and expects the price to reduce. That time only risk comes into picture. He's holding the shares and expecting it to fall. Then the risk comes into picture. Now, can you have a risk other way around also? Other way around also is possible, but not when you're holding shares. What we saw, no, other way around also is possible, not when you are holding shares. You borrowed the shares under stock lending and borrowing scheme and you shorted the shares. And now if you are expecting, when you shorted the shares, you are expecting the share price to fall. Then you will be very happy, you can buy at lower rate. But if you are expecting now the share price to rise, now you will protect yourself from the risk. Are you getting my point? That is possible, but not in hedging, because if you have shorted, then you are not hedging. If you have shorted, you are thinking of speculation over there. Are you getting this? Okay, or arbitrage, one of them. Now, 5,000 shares he has, 150 rupees, expects the share to reduce, opposite action in futures. But which future? Index futures. So what he will do now? He will enter into contract 5,000 shares into 150. How much is it? 5,000 into 150. 7,50,000. He'll be like set life. 7,50,000. I will sell the futures. Which futures? Index futures. Future which is on the Sensex or Nifty. The Nifty points. On that I'll take the future. Okay, now market actually fell. Market actually fell by 10%. That time you are not actually hedged. You are not actually hedged. You are thinking you are hedged. No, but you are actually not hedged. You know why? Because if market falls by 10%, your share will fall by 15% because your beta is 1.5. What on earth was beta? Beta was your sensitivity with the market. Now exact amount if you go and hedge, no. Exact amount if you go and hedge, market will fall by 10%, but your share will fall by 15%. There is no hedge only. Are you getting this? So, sir, this concept was not there last time. This concept was not there last time because last time we were hedging with our own company shares. So there if the share price falls, there also impact is 10%, here also impact is 10% only. Clear? Did you understand? When you're hedging using index futures, you cannot just match the amount. You have to match the amount in such a way that it is imbalanced, but it will match. Clear? Now, amount in spot, 7,50,000. What is the amount that he has today? 7,50,000. He feels it will reduce. He feels it will reduce. So what he'll do? Imagine we go short on index future 7,50,000. Very good. 7,50,000 I have to hedge. 7,50,000 I am going to enter into a contract to sell. I am telling I'll sell 7,50,000 of index futures. Here I have 7,50,000 of this one. So I'll get the exact amount what I want. This is what we think. And this is what the mistake we can do in the exam. Here what happens if market goes down by 10%. Profit on index futures. There you agree to sell, no? So market went down by 10%. So 7,50,000 into 10%, you made 75,000 profit. Now here we are not with an intention to make profit. Here we are with an intention that profit should offset my loss. What is my intention over here? The profit whatever I make. Now here in the previous example also. Previous example what is going to happen? 1,450 is the price, no? If at all it goes to 1,200. I will sell at 1,450 and make 250 rupees profit. But I have the loss what is there? My share of 1,500 has gone and become 1,200. So there I have a loss. The profit which you have taken or which you are getting, that will offset the loss that is going to happen. So now if at all I saw that my stock value is 7,50,000 and I'm like, oh, it is 7,50,000. Let me hedge myself for 7,50,000 and it is going to fall. That means if it is going to fall, I have to enter into an agreement to sell at a predetermined price. So if I take 7,50,000 index futures, no, I am doomed. I am doomed. Why? On my stock, 10% I made. Sorry, on my futures, 10% it fell. So I have a profit of 75,000. But when futures or the market fell by 10%, no, my stock fell by 15%. How? Because beta was 1.5. 10% into 1.5, basically 15% fall in your stock price. So 15%, how much was your value? 7 lakh 50 into 15%, you will have a loss of 1,12,500. Where is the hedge? Where is the hedge? Did you understand this? Are you clear with this? So therefore, understand this. If your 7,50,000 is the amount that you want to hedge, 7,50,000 into 1.5 times, that will make it 7,50,000 into 1.5. 11,25,000 is what you are going to hedge. If you hedge 11,25,000, you are safe. Clear? Now see this. Amount to be hedged is 11,25,000. Okay. If market falls by 10%, 11,25,000 into 10%, you will make profit. But stock falls by 15%. So loss on the stock, 7,50,000 into 15%, 1,12,500. Can you see there is an exact hedge? You won't be under any risk. Are you getting this? I had 1 rupee stock. Now my market and stock sensitivity is 1.5. So when I'm going and taking opposite action over there, if I take for 1 rupee, this falls by 10%, but this will fall by 15%. So there will be no hedge at all. So now what I will do, I will take a hedge in such a way that I will take for 1.5 rupees. 1.5 rupees, if it falls 10%, it is 0.15. 100 rupees when it, 100 rupees, I'll take for 150 rupees. 150 rupees when I take 10% market falls, 15 rupees I'll incur a profit. And on my 100 rupees stock, it will fall by 15%. So I will incur 15 rupees loss, 15 will get hedged. Is this clear? Okay, this is a very important point which you have to understand. Beta, which we studied in portfolio management, coming and playing a role over here. Obviously, here the beta will be given. They will not ask you to compute the beta, because if they ask you to compute beta, you have to go into portfolio management. Clear? Now, understand this. Again, I'm explaining this. There was one guy with 5,000 shares of Bamboo at 150 rupees. He feels that market is going to fall. If he would feel that market is going to rise, he would not think of hedging word itself. Clear? Now he wants, okay, let me go and take a future of Bamboo Limited only, let me take. It is not available. It is not available. Does it mean he'll sit and simply ignore the risk over here? No. So he will go and take a future on what? Index. Index is available all the time. So he'll go and take. Now you're like, sir, wait. Instead of taking this future on index, no. Can he take future on HDFC Bank? You can take, but you're gambling. You can take, but it is not hedging, it is gambling. Because you have beta value with the market. Your beta value is not with HDFC Bank. If you have beta value with HDFC Bank, then you can take opposite action over there. But your beta is basically always sensitivity to the market, no? So therefore you cannot do that. So now here what happens if he hedges himself for 750? Market falls by 10%. This will fall by into 1.5 times of that is 15%. So therefore what he will do? He will not do 750. He will take 11,25,000. 11,25,000. Whatever you want to hedge into beta. Whatever you want to hedge into beta, that will be your value. So now if market falls by 10%, on the futures you will make a profit. 10% profit. On the stock you will incur 15% loss. Those two will offset each other. Clear? Now, like, sir, 7,50,000 I want to hedge. I go to index. In index, no, they have some different terminologies only. If you want to buy a future contract, it should be minimum this much in this lots. So now if they tell, if index futures are trading at 200 rupees and in a lot size of 500, lot size of 50. That means every lot has 200 units. You can't call it shares because it is index. Every lot has 200 units. So now 200 into 50. That means it is 10,000. Value of one contract is 10,000. Now I know how much I want to hedge. 11,25,000. So what I'll do, 11,25,000 divided by 10,000. I'll get 112.5 lots. 0.5 lots is not possible. Round off. 113 lots. What if I would get 112.2 lots? No, you will not make it 113. You will round off to 112 only. You will not round. You are thinking that if I round off to 112, then I will not be completely hedged. But if I round off to 113, I'll be overhedged. If I have overhedged, there also I have chance of incurring loss. Are you getting this? Instead of taking 112 contracts. Okay, let's take an example to make you understand this one. See, how much I want to get hedged? From morning it's also working, no? It's also tired. But people who tell that Apple products don't hang, show them this Apple pencil. 11,75,000, right? Or 11,25,000. 750 into 1.5. 11,25,000. 11,25,000. Clear? Huh? Now imagine 11,25,000. Let's say contract size is 2,000 contracts. 200. How much was that? 200 contracts. Okay, 200 shares or 200 units, and one lot is 50. In one lot there are 50. Today the price is 200 and one lot is 50. This is coming up to how much? 10,000. It's coming up to 10,000. Now let me change this to 40, because if it comes to 10,000, it's exactly 0.5. It will not, you can't display this situation that time. Okay, so 200 into 40, you are getting 8,000. 200 into 40, 8,000. Minimum lot size or lot price is 8,000. So minimum amount that you have to spend is 8,000 rupees. So divide by 8,000. So 11,25,000 divided by 8,000, you're getting 140.625. Ayo, it will not help us now. Let's make it 45. I want that number where you're rounding off to the previous number. Okay, so 200 into 45, you'll get 9,000. 11,25,000 divided by 9,000. Very bad. 48. No, we want a decimal less than 0.5. Huh? 48 will work. 200 into 48. That means 9,600 is the minimum amount. 9,600. So 11,25,000 divided by 9,600. 117.19 contracts. Now you had a feeling that time that we should round off to 118 contracts, because that time you will be fully, if you round off to 117 contracts, you feel that you are leaving little risk there. So now understand, if market falls by 10%, and I had taken how much? 118 contracts. So 118 contracts, and each contract has how much? What is the price of each contract? 9,600. You can take 200 into 48 also, or each contract was 9,600. Each lot was 9,600 into how much the market fell? 10%. So 118 into 9,600 into 10%. That means you made a profit of 1,13,280. Clear? Now you see what happens on your stock. Stock, what happened? It is 7,50,000. No. Into 15, you are making 112,500. 112,500. So therefore, now what happens? 113,280 minus 112,500, 780 rupees you got profit. 780 rupees you got profit. Now imagine you expected the market to fall, but market need not fall only. Imagine market went up by 10%. Market went up by 10%. So now what happens? 118 contracts into 9,600, okay, into 10%, 1,13,280 is your loss. Is your loss. Are you getting my point? And on the stock, 7,50,000 into 15%, 1,12,500 is your profit. So now you are having a situation 113,280 minus 112,500. You will have 780 rupees of loss. Are you getting this? No. He expected the market to fall, but in reality market went up. Okay, in reality market went up. So what they tell when you're doing hedging, no, if you over hedge and position goes ulta, you will be in loss. and additional loss which you didn't even think of if you overhedge. That is why what is prescribed is you take, say, if you take 117 contracts, we'll check with 117 contracts also so you understand. If it is 117 lots, so what you will do, 117 into 9,600 into 10%. So 117 into 9,600 into 10%, you are getting 112,320. This is your profit. Market went down by 10%. This is your profit. And 7,50,000 into 15%. That is not going to change, no. 112,500. This is your loss. So 112,320 minus 112,500. You are having a 180 rupees loss over here. But if at all market reverses, you will have only 180 rupees profit. Are you getting my point? But here what is there? You might get 780 rupees profit, but market reverses, you will be sitting in 780 rupees loss. That means you are not hedging. Hedging means what? You should protect yourself from the risk as much as possible. You are exposing yourself to a 780 loss where you could have borne 180 loss. Are you getting my point? Okay, this they won't ask in exam, but just understand why that rounding off is happening to the nearest number and not to the next number. When we study, no, we always feel next number means full will be hedged. But when market doesn't go according to plan, we are actually exposing ourselves to more loss than what we went to protect. Is this clear? This we are seeing with small number. Imagine this is in crores. That the number automatically will rise. So therefore, just remember one thing. Whenever you have a situation like this, round off normally. Normal, how you will round off any number, like that only. 0.5 or greater than 0.5, next number, 0.5 or less than 0.5, previous number. Now, if beta was 1.5 minus, what is minus 1.5 beta? That means if stock goes upwards, if index goes upwards, share will go downwards 15%. Clear? Till now beta what we saw, if market goes higher, share also will go higher but at a different rate because we have 1.5 beta over here. Now here if market goes higher, okay, share will fall. Share will fall. Now in such case, if you have a negative beta, just see what will happen. It means company will move in the opposite direction of the market. Company will move in what? Opposite direction of the market. Therefore, amount to be hedged will be 11,25,000 only. But beta is negative. If beta is negative, perform same action in future. Perform same action in future. What is that perform same action means? There what we were doing? Market is going to fall. So we are selling. We have stock already. That means on stock, we have gone long. On futures, we were going short. Now on stock, we have gone long. So on futures also, we will go long. Do you get this? Okay, long means you are going to hold. Now this I explained at the starting of, no, we will not hedge. No, we will hedge. We will hedge. Wait. No, we will not hedge. No, we will hedge. Wait. Okay, now see. These terms, it has to sit properly in our head, okay? If I'm talking about futures, I have gone long on futures. Means what? I have agreed to buy on a future date. I have gone short on futures. That means what? I have agreed to sell on a future date. I have gone long in spot. That means what? I have already bought the shares and I'm holding it. If I have gone short on spot, means what? I have sold the shares and I'm trying to square off in future. Is this clear? So if beta was 1.5, what we did on the shares, we have gone long. That means we already are holding the shares. On the future, what we did, or stock or future, what we did the opposite action. We went short on that. That means we agreed to sell. So this will get squared off. Now, if beta is negative, now what will you do? You're still exposed to risk, by the way. If beta is negative, it doesn't mean that you're not exposed to risk. You're still exposed to risk. Here, company, what they have to do, if they have gone long on stock, they will go long on future also. They'll go long on future also. Why? Because if at all, imagine, I'm holding the shares and I have gone long on the future. So now, if the market falls, what will happen? I will incur loss over here. If the market falls, if the market crashes, in futures I'll incur loss, but here I'll incur profit because my stock will go up. Are you getting my point? I have gone long on future. That means I have to go and buy. When I have to go and buy, if market has gone up, it's a loss for me. But if market has gone up, no. My stock, what has happened? It has gone down. Are you getting this? Now, amount to be hedged is same. That will not change. As beta is negative, same action is taken in futures. That means go long on futures on 11,25,000. So now if market goes down by 10%, if market goes down by 10%, what will happen to future? Future 10% gone. Now 10% if it goes, what will happen? 1,12,500 is loss. But when market went down by 10%, your stock went up by 15%. So now 1,12,500 is hedged. Is this clear? So we are hedging for a situation where whatever happens, we are protected. Whatever happens, if market goes down, market goes up, market doesn't move at all, still we will be protected. Clear? Any doubts with this? What you can do is change numbers, change directions, change percentages and check whether the hedge will happen or not. It will be hedged. Whatever happens, it will be hedged. Provided your beta was correct. That is also important, no? Provided your beta was correct. Imagine you did beta with wrong values, then sensitivity is not correct. So beta has to be correct. If beta is correct, then everything else will be perfect. Now, let's go and check the concept now. Now, concept 1, if stock futures contract on such stock exist. If there is a stock future, you will hedge with stock future only. Enter into opposite action. Opposite action means today if you are holding the shares, then you will sell the future. Today if you have sold the shares, then you will buy the future. Clear? If long in stock, go short in futures. If short in stock, then go long on futures. This we have already discussed. Now, concept 2, if futures contract on such stock doesn't exist. If it doesn't exist, what happens? Use index futures. Amount of index futures to be traded is equal to beta into rupee value of your spot position. Do you remember we did 7,50,000 into 1.5? Beta into what you want to hedge. That will be the total amount. Number of index futures to be traded will be what? Beta into rupee value of the spot position. That is what we have to hedge. Divided by value of one index future per contract. In our example, it was 10,000. Value of one index futures per contract. Note, if beta is positive, take opposite action. If beta is negative, take same action in futures. We saw that with the example as well. Now, next thing is hedging an entire portfolio. Hedging an entire portfolio. Clear? Here also you can have buying and selling in spot and also trading in index futures. Then last, which is not written here, but we still have to just have a look at hedging the commodities also. Let's go further. Okay. Now, imagine I have a portfolio like this. Hedging an entire portfolio. I have a portfolio like this. XYZ Limited is there. Infosys Limited is there. RIL is also there. And I have market price per share and number of shares and also beta is given. Now, beta, if they give you of individual stocks which are sitting in the portfolio, you know how to calculate the beta of the portfolio. Weighted average of the values, but values which you will take market values. So already market values I have put over here. So you got the beta 1.365. You can cross check that. 1.6 into 14 divided by 46. 0.7 into 20 divided by 46 and 2.2 into 12 divided by 46. Clear with this? This is your portfolio beta. What does it mean? What does portfolio beta mean? Your sensitivity of not XYZ, not Infosys, not RIL. Your entire portfolio sensitivity to the market. If market goes up by 10%, then your stock will go up by 13.65%. Clear? That is what it is. Now, when we are talking about portfolio, no, usually the questions aren't like, that also will go to, but usually, if you created a portfolio, you are ready to bear some risk. Correct? So, two types of questions can come. They will be like 1.365 is too much. We want to reduce this beta to 0.8. Okay, that is your desired beta. You want to reduce it to 0.8. Other question is they are like get your portfolio hedged. Then I am assuming that I want to reduce the beta to 0. If ICAI doesn't tell anything and they just tell portfolio needs to be hedged, then you are assuming that the beta of the portfolio should be 0. That means you want to hedge your complete portfolio with risk-free investments. Clear? To make any beta go down. Now I am hedging with what? Selling and buying stock? No. So if I want to make the beta go down, then what I have to do? What I have to do? What will I do now? By selling and buying stock. Okay, we are not talking about futures as of now. Imagine I want to reduce my risk. If I have to reduce my risk, what should I do? Sell the high beta stock and put the low beta stock. Now you're like, oh, I want to make it 0.8. Then we'll do one thing. We'll sell this fully. 1.6. Okay, and I'll keep only 0. Or why 1.6? This 2.21 will sell. That time my risk will go down. You can't do that. You can't do that. The reason why you made the portfolio was to have a diversified portfolio. If you had to keep everything of 0.7 only, I could have bought 3 stocks of 0.8 over. The reason of forming a portfolio is what? It is diversified. That we saw in portfolio management. When one stock is going down, others should compensate it. Okay, now we are protecting ourselves from risk. But if market is good, then we will be sitting in a very bad opportunity loss. Clear? So we cannot do trial and error elimination. That is, 2.2. We'll get rid of this one. That we can't do. Okay, so now if we want to reduce the beta to 0.8, we want to reduce the beta to what? 0.8. So when we are reducing, we should reduce in such a way that all the stocks are sold. Okay, all the stocks. That means my diversification remains same. Clear? Now, see this. I want to go from 0.8 to 1.365. So basically, 1.365 to 0.8 I want to reduce. So what I will do, desired beta. This is my desired beta. Okay, this is my existing beta divided by existing beta into 46 lakhs. Into 46 lakhs. What did you get? 19 lakh I have to reduce my portfolio. 19 lakh I have to reduce. Reduce means what? Now guess what? It's fun you see, okay? Sir, simple. 19 lakhs if I have to reduce, I'll remove 19 lakhs and I will remove proportionately from all three. I'll remove proportionately from all three. You know what will be my beta that time? 1.365. What will be my beta that time? 1.365. So, you didn't get it? I said that 19 lakh I have to reduce. No. And 19 lakh if I proportionately reduce from all three, which is the methodology, to remove proportionately only. But if you remove proportionately from all three, that time your weight will still be same, no? So your beta will still be 1.365 only. So therefore, whatever you proportionately remove, that you will add to your portfolio in the form of RF or in the form of cash. Now what happens in your portfolio? There is something sitting with 0 beta. That time when you take the weightage, overall the beta has come down to 0.8. Did you get this? Huh? How will you add cash? What you sold, you keep it in bank. My portfolio means what? Not only shares, no. My portfolio means the land that I have, the shares that I have, the gold that I have. Correct, no. So I'll sell the shares because I want to reduce the risk and keep it in cash balance. If you want to talk about only stock market, keep it in your demat account in cash balance. Are you getting this? Or you can just keep it in the bank account. That will give you some interest as well. So if you just remove the shares, your beta will still be 1.365 because imagine 3 people are there in the weightage of 2. Now if you remove 10 shares from them also each, then they'll still be in the ratio of 2 only. Are you getting this? So therefore, beta when you have to reduce, now you understood that 19,04,029. I have to remove this. Now the formula is made by ICAI. This is the methodology ICAI usually prefers. So what you are taking, what you want minus what you had divided by what you had. Clear? Remember this like this. What you want minus what you had divided by what you had into your portfolio value. Now when you do that, naturally you will get negative only over here. You will get negative. So that means sell. The formula is designed in such a way that if you get negative, sell. Clear? So 19,04,029 you have to sell. Amount to be sold and kept in RF or cash. If you just sell, you will not get this desired result. Okay, now you have to sell it and immediately keep it in RF or cash. Now, alternative you see, just for your understanding, because information can be given in multiple different ways. So I have presented the alternative methodology also. This is our general math. General math is what? 1.365 beta was when the portfolio was 46 lakhs. 46 lakhs of shares. Now, guess what? My portfolio is still going to be 46 lakhs only. But in that portfolio, cash will get added. So 1.365 is the beta when the shares portfolio was 46 lakhs. Clear? How much should be the shares portfolio for a 0.8 beta? 0.8 beta. So what you'll do, you'll cross multiply. You will get the answer as 26 lakhs 95,971. This is the required portfolio. What is the existing portfolio? 46 lakhs. Remove, you are getting the same 19,04029. This is an alternative way of finding. If you get confused with the formula anytime in the exam, just do cross multiplication, you will get your answer. But there is a problem which I've seen in students' papers. When they do cross multiplication, they get an answer. No, they'll tell that is the amount to be sold. No, that is the amount to be retained. Balance is to be sold. Are you getting this? In that formula, directly you will get what you have to sell, what you have to buy. Here, 1.365 beta for a 46 lakh share portfolio. 0.8 beta will be how much of share portfolio, not your total portfolio. So your share portfolio will be given. So remove the number, you will get 1905. That is the amount you have to remove. This is one alternative that you can use. Clear? One more. Remove from the stock portfolio and put it in RF. That we will, that in same proportion. In proportion of their weightage. In proportion of their weightage. How you remove will be in the proportion of the weightage only. Okay, we'll get to that. We'll get to that. But what you have to remove is this. How you remove that, we'll see that. It's there in this example. Okay, now you see next thing. Alternative. You can use this formula also. Weightage in stock in your portfolio is X. Therefore, weightage in RF or cash is 1 minus X. So your total beta should be 0.8. So 1.365 into X plus 0 into 1 minus X. This will become 0. So therefore, X is equal to 0.586. What is 0.586? 0.586 of the weightage. So take 45 lakhs into 0.586. You will get 26 lakh 95,600. That is the amount you have to keep. Remove the balance, you will get 19 lakh 4,400. This is giving you slightly different answer. 19 lakh 4,029. No, it was here you're getting 19 lakh 4,400. That's fine. Okay, that's because of the rounding offs which we are doing. That is fine, no issues. Amount to be divested. So all the three methodologies will give you the same answer. You can use the formula in exam because I say generally uses the formula. I can't tell everywhere, but most of the times. Okay, some places they also do cross multiplication only. Now, the question was that no, how to remove this in the same proportion? How to remove this in the same proportion? See, amount to be divested. 19 lakh into 14 by 46, 19 lakh into 20 by 46, 19 lakh into 12 by 46. What was this? My original weightage in the portfolio. So my diversification remains same and this will be removed. So now if you ask me, there is a portfolio of 26 lakh 95,000 something of shares and whatever got removed, that got filled with cash. So my total portfolio is still 46 lakhs. But when I calculate the beta, stock weightage into beta, stock weightage into beta, stock weightage into beta, then RF weightage into 0. That time the overall weightage came to 0.8. Is this clear now? The entire concept of hedging a portfolio. So what you will do when you are hedging the portfolio, right now what you did? You hedge the portfolio by selling the shares or buying the shares. So your share portfolio changed, but your overall portfolio remains same by putting RF. Clear? Now, if I ask you the other way around, we are crazy. We want to take risk. We are expecting market to go up. Remember, we studied in portfolio management. If the market is expected to be bullish, then we want to fill ourselves with high beta stocks. If the market is expected to be bearish, we want to fill ourselves with low beta stocks. Or other way around, if market is expected to be bullish, I want higher beta in my portfolio because when it reacts like this, I want it to react like this. Correct? When I expect the market to be bearish, then I want low beta stocks. If it is going to fall this much, I want to bear a fall of only this much. Clear? So here, imagine they're expecting it to be bullish. Then they want the beta to be 1.8. How much they want the beta to be? 1.8. So you have to increase now. Naturally, from this example to this example, when we are coming, we know that if we want it to be 1.8, we have to invest more money into the stock portfolio. I have to sell my shares and all sell my cash and all which I have, and I have to put money into the portfolio. Or normally, you'll borrow money and put into the portfolio. Are you getting my point? Now, you're like, sir. If you borrow money, what will happen, sir? There will be debt. Now see, earlier I told you, the portfolio looked like this. A, B, C, and beta, and there was weight. that I wanted to reduce. So into my portfolio, what I put RF. I put RF into my portfolio. When I put RF into my portfolio, RF came with a 0 beta, but it also has weight. It has weightage. So now weightage got reduced. So therefore my beta went to 0.8. Clear? Now to increase the beta, A, B, C, beta, 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 weightage, weightage, weightage. Now it will give me a desired beta. I want to increase this. Increase this if I just put it in the same proportion. If I put it in the same proportion, beta will still remain same only, no? So now what I have to come up with? I have to come up with debt. I am borrowing debt. Debt will have negative cash flow. Debt will be a negative figure in your portfolio, but debt will have a 0 risk. Are you getting this? So simple math, okay? Simple math. If you put something with 0 risk and positive number into your portfolio, beta goes down. If you put something into your portfolio with 0 risk but a negative number in your portfolio, like a liability into your portfolio, that time the beta goes up. That time the beta goes up. Didn't get it? Did you get it or no? No. Okay. Now, first we will solve how much we have to sell. Then I can show you the new portfolio and see how it is sitting. So for that, if you want, I will show you the old portfolio, this one. Okay. This example also I will put it in the notes and I will show it to you. See. What are the stocks that I have? The stocks that I have is XYZ, Infosys and Reliance. XYZ, Infosys and Reliance. Clear? And earlier how much I had in my portfolio? 14 lakhs. So now it will be 14 lakhs plus, and here I had 20 lakhs. So 20 lakhs plus, and here how much I had? 19 lakh. Sorry, 12 lakhs. 12 lakhs plus. Clear? 12 lakhs plus. Plus what I am going to divest. Sorry, what plus? Minus. Okay, minus what I am going to divest now. I am going to sell now. So I am going to sell how much? 579,487. 579,487. And here how much I am going to sell? 827,839. 827,839. And here 839. Here how much I am going to sell? 496,703. 496,703. Now see the values of your stock. 14 lakh minus 579,487. So you are having 820,513. Then you have 20 lakhs minus 827,839. You have 11 lakh 72,161. Clear? Then you have 12 lakhs minus 496,703. You are having 7 lakh 3,297. Clear? Total this plus 1172,161 plus 820,513. You are having 26 lakhs 95,971. That was what we told we want our desired portfolio to be. Now my portfolio is not this much. I have cash. How much cash? Whatever I sold there, 19 lakh 4,029. 19 lakh 4,029. This will be totally 46 lakhs. This will be 46 lakhs. Are you getting this? So now if you calculate beta, I am not going to display that. If you want, we'll display it also. Okay, what was the betas? We'll do that. We'll do that as well so that there is complete clarity. What was the beta? 1.6, correct? So you will do 1.6 into 820,513 divided by 46 lakhs. Keep punching it into the calculator. Plus next beta is 0.7. 0.7 into 1172,161 divided by 46 lakhs. Plus next beta is how much? 2.2. 2.2 into 703,297 divided by 46 lakhs. Plus 0 into 19,04,029 divided by 46 lakhs. The answer should be 0.8. 799 or something if you get. No, 8 only you get. 0.8. Clear? This was my goal. To get this desired beta was the goal. Clear? Now we'll see in the other way around. That time afterwards we'll make the redrafted portfolio and check. Okay, now if I go in the other way around, what will happen when I go into the other way around? I want to increase the beta. That means I want to take more risk. So therefore, see over here. Yeah. What if we want the beta to be 1.8? Redrafting the portfolio will do 1.8. Alternative, same formula. Desired beta minus existing beta divided by existing beta into 46 lakhs. Okay. You got 1465,934. This number will come positive only. So it will give you an indication in the exam that you have to buy. Okay. Amount to be invested by borrowing. Amount to be invested by borrowing. We are always bikari in AFM. We don't have money. If you want to invest, you have to borrow. Clear? Now, alternative. Alternative, you see, 1.365 is the portfolio for 46 lakhs is the portfolio and 1.365 is the beta. We want 1.8. How much should be the portfolio? 60, 65, 934. Portfolio should go up. Portfolio, what we are talking about? Shares. Portfolio of shares should go to 60, 65, 934. Therefore, remove the amount. That means 14 lakh 65, 934 I have to invest. That was your alternative 2 of calculating. Alternative 3 is what? 1.8 is equal to 1.365 into weightage of stock. Okay, that's it. That's it. So because 0 into weightage of debt or minus 0 into weightage of debt, still it will be same thing, no? So now you get 1.31868 and this is the weightage. 1.31868 and this is your weightage. Is this clear? So the stock weightage has to go to 1.31868. Right now, 46 lakhs into 1.31868, it will give you a new portfolio of 60 lakhs 65,928. You got the new portfolio, remove the old portfolio, this extra amount you have to invest. Is this clear? This extra amount you will have to invest. Now what we are going to do? Amount to be invested in each stock. Amount to be invested in each stock. You will take the amount that you have to invest and multiply into weightage. Amount into weightage. Amount into weightage. Amount into weightage. Is this clear? So you got the total amount that you have to invest. Now our question is, will the portfolio risk go to 1.8? That is the question, no? So what we will do in the notes, if you are taking this same situation, now what happens? 14 lakhs plus. Okay, 14 lakhs plus. Now you can see how it is going to work. 14 lakh plus 446 154. 446 154 I am going to put more. Correct? That makes it 18 lakh 46,154. Infosys, what I am going to put? I am going to put 637 363. 637 363. So it makes it 26 lakhs 37,363. Clear? Next, after that, you are having 382 417. So you will add 382 417. It becomes 15 lakh 82,417. Now, there is a debt sitting in your portfolio. The debt sitting in your portfolio is, how much did you invest? Amount to be invested was 1465 934. So 1465 934 is your debt, and in your portfolio debt will have a negative figure. So your overall portfolio is still sitting at 48 lakhs only. Is it 48 lakhs? Are you getting 48 lakhs? Oh, sorry, 46 lakhs. 46 lakhs it was. Overall portfolio sitting at 46 lakhs. So in portfolio hedging, we only modify beta rather than buying or selling futures. That we will see when we go to index futures. In stock, we are only buying or selling the stock. Now imagine you are like, I don't want to modify my portfolio. I want this to be like this only. Then your only way of hedging is to go for futures. This is an alternative. Next alternative is that only, going for index. Now 46 lakhs. Clear? Now 46 lakhs is there. Your beta will be, what was your beta? 1.6. 1.6 into 820, sorry, not 820, 1846, 1846, 154 divided by 46 lakhs plus 0.7 into 26, 37, 363 divided by 46 lakhs plus 2.2 into 1582 417 divided by 46 lakhs plus 0 into, sorry, not plus, minus 0 into 1465 934 divided by 46 lakhs. When you do this math with your memory function, you should get 1.8. You should get 1.8. Clear? So here how they are modifying the beta or how they are increasing or decreasing the risk. They are increasing the risk. They are increasing the risk by doing what? Increasing the risk by buying more stock and putting loan into your portfolio. They are decreasing the risk by selling the stock and putting RF or cash into the portfolio. Is this clear? Yes, that is it with that particular thing. Next thing is hedging by trading in index futures. I think we'll do it tomorrow. It's too much of concept for one day. So we'll finish this hedging in index futures. So till here, if you revise the next part, you will be able to cope up. Okay, spend at least like we had like 4 hours of class today, class hours. So I think roughly if you spend 1.5 hours, I think that's more than enough. You can revise everything. Okay, but when you're revising this sheet, no, keep your calculator. Calculate and see how it is coming, what is happening. Yes, that's it guys for today. See you tomorrow. Bye-bye. Yes, good morning. Welcome back. Better. Today better. Let's start. So it's been a gap of 2 days. So let's quickly revise whatever we have done from starting of derivatives and then we will continue. So we know that there are 3 types of derivatives: forwards, futures, options, and swaps also. But swaps are not covered in this particular chapter. Swaps will be covered in a later chapter. Forwards and futures, what is the difference? What is a forward contract? Entering into a contract today. Yeah, it is not standardized, it's just customized. Entering into a contract today to buy or sell share, commodity or anything at a particular price, which is predetermined today, but it is customized between 2 people. When you go into futures, there is an intermediary who is involved, so it is standardized. Then option is a contract where 2 parties have the right to buy or sell, and they have the option to buy or sell, and they can reject also. Forwards versus futures, you saw that one it is individually tailored, other one is standardized as per the stock exchange. Then 2 parties are involved here, 3 parties are involved. Credit risk, any party can default, but in futures there is no chance of default. Then margin money and all concept is not there in forwards. There is a concept of margin money in futures. Okay, bid rate, ask rate, we already know it's a buying rate and selling rate for the respective parties. Time value of money also, if it is simple time value of money, what is it going to be? It is going to be future is equal to spot into 1 plus R into N divided by 12. This is simple interest. Otherwise, it is F is equal to S into 1 plus R to the power of N. Otherwise, it is F is equal to S into E to the power of RT. All the 3 categories we have seen. Okay, then types of margin. Types of margin, there are 3 types of margin. One is initial margin. What is initial margin? It's like a security deposit. Okay, so what do you have to understand? If you are creating initial margin, it is mu plus 3 sigma or 3 standard deviations. Mu is what? Average daily change, and standard deviation, you know, risk of that particular thing of deviating. So 3 times of that will be taken and that will be kept aside as initial margin. Then what is mark to market margin? Every day the fluctuation, whatever is there, if you are positive, you will get the money. If you are negative, the money will be taken from you. That is mark to market margin. Maintenance margin is there when there is no mark to market margin. What happens in maintenance margin? Initial margin will be there, and any dip from the initial margin, okay, and it is going to breach this maintenance margin, then you are going to refill to the initial margin itself. Then additional margin is any time when there is volatility in the market, they can ask you for extra money. Time value of money, we have seen discrete compounding. Discrete compounding means what? On particular time periods, it gets compounded. And continuous compounding means every second it gets compounded, but ICAI considers even daily compounding as continuous compounding. Clear? Then we went into uses of derivatives. First one is hedging. What is hedging? Protecting yourself from future fluctuation. Your intention is not to make profit. You might make small loss, but you are protecting yourself from the bigger loss. Okay, I think in middle of hedging only we had stopped. One part of hedging was remaining. Speculation. Speculation is what? Just trade in it. Okay, try to make a profit. It's a one-sided transaction. You don't have anything to cover. You're just trying to make profit, thinking that your prediction is correct. Okay, then arbitrage. What is arbitrage? Arbitrage happens when it is not properly priced. You see the market, you know to value it, and when you value it, you found out that, oh, it is not properly valued in the market. That time arbitrage opportunity exists. Wherever you are going to learn about arbitrage, in future you are going to learn even in options, the concept of arbitrage. Whenever we talk of arbitrage, first thing you should know to calculate the fair future price or to calculate the correct value as of today. Once you calculate the fair future price, then you will know whether it is undervalued, overvalued, okay, or you have to just hold. What you have to do, that we will discuss. Then determination of fair future price. What are the types we have in determination of fair future price? What are the types we have? One we have stock, one we have commodities. In stock, what we have? Non-dividend paying stock we have, dividend paying stock we have. In dividend paying stock, the dividend is given in absolute terms we have, dividend is given as a percentage of yield. I mean, it's yield percentage. Then in commodities, we have investment commodity as well as consumption commodity. Now, no dividend is received. If no dividend is received, what you're going to do? Usually, what is our formula? Future is equal to spot plus interest plus storage cost minus income. And if it is this situation, no dividend is received, is equal to spot plus just interest. Clear? You're just going to add the interest. If it is normal, you will just add a simple interest. If it is compounding, what will you do? You will take the compounding formula. If it is e to the power of rt continuous, you know how to search these values. So I'm not going into that. If dividend is received in absolute terms, here actually there are two subcategories. One, dividend is received 3 months future, dividend is also received at the end of 3 months, or 3 months future, dividend is received somewhere in between. Now here, if it is 3 months future and they just tell dividend ₹5 is declared in these 3 months, in these 3 months can be any time or any day, but still we'll consider it as at the end of 3 months. So in this we have only two categories. What is that? Bring this ₹5 to present value, set it off, reduce the net amount to carry it to future value. See, we brought that ₹5 to present value and then everything was taken to future value. Otherwise, let the ₹5 be there only. Take the spot rate to the future value. There only you subtract it, you will get the value. Clear? Then the next situation is, see, the future is for 6 months, but dividend is to be received after 4 months. Now you have three categories over here, three things. Bring this dividend 4 months back to the present value, then reduce it and take the amount 6 months forward. Or second situation, take the amount 6 months forward, take the dividend 2 months forward and reduce it over there. Then alternative number 3, take the amount 4 months forward and subtract the dividend and then you will get the future value over there. Clear? I mean, take the remaining amount to 2 months forward to the 6th month. Then continuously compounded, we know everything is the same. After that, we went into if dividend is receivable at the end of 3 months. I think we have seen all these things. Yes. Dividend yield. The next thing that we have to see is dividend yield percentage. In dividend yield, what we have to know? Actually, the dividend yield word is very important. See, if I am telling interest rate is the yield only, no? That is the benefit only. So from the benefit, okay, I mean from the expense, if I remove the benefit, I'll get the net expense. Okay, so net present value or net compounding or net interest rate, so that gets added. So only when it is written as dividend yield, that time from the interest directly you can subtract the percentage and the net percentage you can apply. Clear? So if it is compounded semi-annually or whatever it is, see in the normal percentage also 12 minus 5 is happening over here. If it is compounded semi-annually also 12 minus 5 and then it is getting divided by 2. If it is continuously compounded also, it is e to the power of 12 minus 5%. Clear? And here also you can have the same situation, that it is dividend is compounded 2 months future and dividend yield is 3%. So same thing you have seen, if it is interest is compounded, quarterly, continuously compounded, all three situations are there. Now after that, what we learned two small concepts called as contango and backwardation. What is contango? Normal. Contango means normal. The future price is priced little higher than the spot price. Okay, what is backwardation? Backwardation means it is at a negative, it is trading. So therefore, if it is basis is positive, then basis is positive means spot price is lower than, what are we talking? Yeah, spot minus future. If future is negative, I mean that means it is in the backwardation, then obviously spot will be higher, you will get a positive number over here, it's called backwardation. If it is higher, which should be normal, you'll get a negative basis points, that is called as contango market. They can use these terminologies in the exam. Okay, arbitrage. Then we moved into arbitrage. Now, in arbitrage, what do we understand? First thing, they will tell you that there is a future. Okay, actual price of the future is given. Okay, they have given the RF, they have given the fair future, till here they have given fair future price you computed. Actual future price is 1550, fair future price is 1520. That means in the market, it is undervalued or overvalued? It is overvalued. Because it is overvalued, what you are going to do? You are going to sell the future. But selling the future will not give you any arbitrage. When you are selling the future today, that means you are entering into a contract that in future you will come and sell the shares to them. So therefore you should have the shares, enter into future agreement to sell the share at 1550, and after that when you enter into future contract, okay, this is institute assumes that there is no cash flow. Actually when you enter into future contract, there is margin money and all, that and all is ignored. Then immediately if you enter into future contract to sell, then you have to buy the spot today, and then there is cash flow here, because to buy you don't have money, so you obviously have to borrow money at whatever percentage that is given in the question. After 2 months, what will happen? The share which you purchased, you will go and deliver it because you are going to sell it, and the loan which you borrowed, you are going to repay with interest. That time you will get an arbitrage gain. Actually, this arbitrage gain is nothing but the difference between the fair future price and the actual future price. But you can't write the arbitrage gain directly over there. You have to show the plan of action. In the exam, you can't write. You got fair future price in the first step only. You can't write 30 rupees as profit over there itself. You have to display the mode of action, what you are going to do, how you are going to start. After 2 months, what is going to happen, then only you will be able to tell the answer. Clear? Now, if the other way around, if the actual future price is 1450, what was the fair future price? 1520. That means in the market it is at 1450. That means in the market it is undervalued. If it is undervalued, what will happen? You will buy futures. That means enter into a future agreement to go and buy shares in future. So today what you should do in the spot market, you should sell the shares. To sell the shares, you don't have money. So what you will do, you will borrow it under stock lending and borrowing scheme. Clear? Then after the time period, here also stock lending and borrowing scheme will have some commission to pay and all. That all is not considered here. Okay, after that what you are going to do, you are going to buy the share. Okay, after you buy the share, you will return the amount. But whatever you got at the time of selling the share, you will invest it and you will sell the investment, and that money is also yours. So balancing figure will be profit again. Clear? Now comparison between actual future price and theoretical future price. Actual is greater. Actual is greater. That means market is greater. That means it is overvalued. When it is overvalued, what you will do? You will short the future. That means sell the future and buy the spot or long the spot. Okay, for that you will have to borrow money. Cash and carry arbitrage it's called. Okay, if actual is less than theoretical, what does it mean? That means it is undervalued. You will buy or you will long the future. If you are long in the future, that means you will short the spot or you will sell at the spot. That is obviously under stock lending and borrowing scheme, and you will invest that money. This is called as reverse cash and carry arbitrage. Clear? Then we also saw this May 2007 exam, which has been replicated again in the RTP 2024. I don't think we need to go there now. Then we discussed settlement of futures. Normally, settlement of futures in the market, how it happens is price difference. Okay, they will not come and tell you deliver the shares to us or anything. They'll just see that day you have entered into agreement for 1500. That day spot market is selling 1550. Okay, so 50 rupees, the price difference will be adjusted. Either it will be given or it will be taken. Okay, pay or receive difference between future price agreed and the spot price on the due date. Otherwise, delivery. Delivery means what? Actually buy or sell shares at the originally agreed price. If ICAI question is silent, you are always going to follow delivery. Clear? Now, I think we have seen this example. Let's go into commodities. Commodities, one extra fitting is there. What is that extra fitting? Spot we know, plus storage cost we know, plus interest we know, minus income, minus convenience yield. What is this convenience yield? The opportunity of using this product is not there with someone who has entered into the future contract. So 3 months or 4 months, he cannot use this contract. He cannot take the benefit from this contract. So one convenience yield will be subtracted. Okay, other than that, rest of the things are same. So what you have to do is, if at all you have convenience yield, I think that mistake we had done the correction. If there is convenience yield, 15 minus 2, 13%, all discounting rates will be taken at the rate of 13% only. And same thing, semi-compounded or continuously compounded, doesn't matter to us. The calculation is same. So here, what and all you have to do, storage cost might be there every month. Either bring it back to present value or take everything to future value. Okay, income might be there every month. So bring it back to present value or take everything to the future value. Then interest. Interest, what you can do, directly you will apply it after you set it off After you add these things or set it off all these things, then you can apply the interest rate and carry the things forward. That should be it. Okay, then the next thing that we discussed was stock lending and borrowing scheme. Stock lending and borrowing scheme, how does it work? One person is there who is a long-term investor who wants to hold the shares. He lends the shares. He doesn't have any plan of selling the shares, so he lends the shares to one person. He'll go and sell it in the market and he'll buy it back from the market, then he'll return the share. Now, from the point of view of the lender, what and all is his earnings? Lending charges or fees per share which is going to charge, that is his earnings. Then dividend received per share, that is also his earnings. Total earnings per share is this. Number of shares, if you multiply, you'll get the total earnings. ICAI can ask two types of question. If question is on earnings through SLB scheme, then this should be written. If they tell total earnings, then this should be written. Clear? Now, computation of total profit or loss of borrower. For borrower, what is the situation? He has to pay the lending fees per share. Then whenever you lend shares, it's a huge contract. So usually what will be there? There will be a bank guarantee that you have to take. So bank guarantee, bank charges will be there. So price per share into bank guarantee percentage into n divided by 12, whatever the time period it is. Okay, that is also an outflow. Then gain, either you sell the shares on in the market and you gain, or you might have a loss. Now, if you're thinking how there can be a loss, because you have borrowed it for some time period only, that time the price fluctuation which you are expecting didn't happen. So you have to still sell those shares at a loss and return those shares. So anything can happen, and then total profit or loss per share. Again, multiply into number of shares, you'll get the total profit. They can ask from the borrower's point of view as well as the lender's point of view. Next, we moved into the very important part, that is hedging. Correct? Now, hedging, we have multiple things to think about. What are the things that we have in hedging? One, we have single stock. We are hedging a single stock. And the single stock we are hedging with the stock future only. Second thing, we are hedging with hedging a single stock but with the index future. Third thing, we are hedging the portfolio. I think till hedging the portfolio we finished. We finished hedging the portfolio, right? Okay. Now, hedging a single stock, hedge using stock futures. Now, let's try to understand. This fellow has shares of Infosys 1500. Expects the share to reduce by 10%. So, what he will do? Enter into opposite action. He is expecting the share to reduce. Enter into opposite action in futures. That means what? Sell the futures at 1450. He knows it is going to reduce over there. He knows it is going to fall over there. So secure yourself by telling that, okay, I will sell it at this price only. So it will be enter into opposite action or sell the future at 1450. Now what happens? There is a loss. What is the loss? 1500 is the spot price. 1450 is the agreed price. 50 rupees is his loss, and it's limited to 50 rupees, whatever happens in the market. After 3 months, what you will do is sell the share at 1450. If spot price after 3 months is 1200, he is protected from the 250 rupees extra loss that he could have incurred. Clear? Here we are not looking for profit. Now, what if after 3 months the price was 1800? No problem. He is not bothered about that. He wanted to ensure that he doesn't lose money. Okay. Next, hedge with index futures. Now we saw over here that he has 1500 shares, 1500 rupees ka share. Imagine I tell that 500 shares of 150 is there. So 500 into 150, is this the amount that we have to hedge? Yes, but when we go to market, we can't hedge this exact amount because the index will react in particular way and stock will react to that based on beta. So beta is 1.5. That means if market reduces by 10%, the stock will reduce by 15%. Clear? So expects the share price to reduce. Opposite action in future. Opposite action in future means what? It is going to fall. So you are going to enter into an agreement to sell. So amount in the spot market is 7,50,000. This I want to get hedged. I should ensure that the 7,50,000 doesn't go anywhere. So now imagine we go short on index futures for 7,50,000. What happens? Market goes down by 10%, 75,000 gone. Stock goes down by 15%, 1,12,500 gone. Clear? Next, amount to be hedged. You have to multiply the amount to be hedged into beta. That time only you will get the correct amount. If you do that, now see, future amount is 1,12,500, went down by 10%, 1,12,500 is the profit. But imagine loss on the stock, it went down by 15%, 1,12,500. It is perfectly hedged situation. Okay, if index futures are trading at 200 and lot size, if they tell you lot size, what you will do? total amount that you have to hedge, 11,25,000 divided by 10,000. That time you will get 112.5, and we have had this discussion also, round off to the nearest number. Okay, don't over round off, because that can create, if you do over hedging, that can create a loss. Yes, 113 lots. So hedging the portfolio using index future remaining. This is done, no? Hedging the portfolio, we are still hedging the stock only, no? This is hedging the stock rate. Hedging the portfolio with index future. We didn't reach till there. Wait. Correct, no? I remember explaining this nearest rounding off and all. Yes, if beta is minus 1.5. If beta is minus 1.5, that means what? If market goes in one direction, then stock will go in the opposite direction. So in that case, what you have to do? You have to maintain the same actions. So amount to be hedged, same thing, but if beta is negative, perform same action in futures. Go long on futures. Already stock you are going long. Okay, because stock you are going long. In earlier cases, future you are going short. Now you are going long on stock, you are going long on futures as well for 11,25,000. Now if market goes down by 10%, you see, there will be a loss on the futures, but profit on the stock, because stock will go in the opposite direction. Now, hedging an entire portfolio. Hedging an entire portfolio, you must have understood or remembered that entire thing we usually don't hedge. We try to either reduce the risk or increase the risk. It is, I should give you a disclaimer. ICAI sometimes doesn't give you information only. They are telling that they want to hedge the portfolio. If they tell they want to hedge the portfolio, which is practically unlikely in real life situation. Okay, because if you are telling you want to hedge the portfolio, that means you want to take zero risk. You want to take zero risk. Then there is no point of having portfolio only. Are you getting my point? But ICAI does ask such questions. They want to hedge the portfolio. If they tell they want to hedge the portfolio, you are going to take desired beta as 0. You are going to take desired beta as 0. Clear? Now we have a portfolio over here. Hedging by selling or buying stock. First option is what? Hedging by selling the stock or buying the stock. Now you have XYZ Limited, Infosys Limited, RIL. All these shares are there. Beta is there of the respective stocks. Now beta you know how to calculate in portfolio management. We have discussed portfolio beta. What you will do? Just take the average, weighted average of all those things. You will get the answer. If you want to reduce the beta to 0.8. If you want to reduce the beta, what is the plan of action? Tell me. There is a formula and all. That and only forget. What is the plan of action? Yeah, sell the shares, increase the RF in the portfolio, increase the RF. Okay, overall portfolio value should remain 46 only. But in that, the stock portfolio should reduce and RF should come and sit over there. So the formula what ICAI prescribes is desired beta minus existing beta divided by existing beta into whatever the portfolio value. Now when you do this, automatically if you get negative, that means you have to sell some shares. This is the amount that you are supposed to sell. What is the other alternative that we saw? Two other alternatives also we saw. If 1.365 is the beta for 46 lakhs, how much should be the portfolio when the beta has gone to 0.8 lakhs? That time you will get the required portfolio, subtract from the existing one, that time you will get the amount that has to be sold. Then one more thing is what? Just take weightage and see. Weightage what you will do? 1.365x is the portfolio of stock. 0 into 1 minus x is the portfolio of RF. That time you will get that stock portfolio has a weightage of 0.586. You will get the value. Differential amount has to be divested. Now how to divest this? In the same proportion what it was there in the existing portfolio. 14 by 46, 20 by 46, all this. And we have also constructed the new portfolio and we have seen that actually the beta will be 0.8. I'm not going to do that today. Okay, what if we want beta to be 1.8? That means we want to take more risk. If you want to take more risk, what is the option? Plan of action is what? Buy more shares, but your portfolio has to be 46 lakhs only. Buy more shares by borrowing loan. Loan will come into your portfolio as a negative investment. So therefore, it will have a zero risk and it will be negative investment. Your total portfolio will still be 46 lakhs itself. Clear? Again, the same formula, desired beta minus existing beta divided by existing beta into the portfolio value. You got what you have to do. You can do the cross multiplication technique or the weightage technique. Both you will get the same answer. How to calculate the amount to be invested in the same weightage. And but remember, when you create your new portfolio, I think that day we did that. Where is it? Yeah, so in your new portfolio, debt will come and sit as a negative figure. Yes, that should be it with that particular point. I think till there we had market went up by 10%, portfolio went up by 18%. Have we discussed that? No, I think. This is the index futures. Okay, index futures is one thing that we have not discussed in hedging. I think that is the only thing. And other than that, hedging the commodities also we have not discussed. So let's go further. I hope you had revised all this. This we have finished. Index futures. Oh, sorry, no, this is remaining. So number of index futures to be traded. Same thing what we had done for stock, similar it is. So beta 2 minus beta 1. What is beta 2? Desired beta minus existing beta divided by existing beta into current value of portfolio. That much you have to hedge. But now the index contracts don't come in values what you like. So divided by value of index, one index future per contract. That time we'll get to know how many contracts that you have to buy. Okay, note if the above result is positive, then long the index futures that we have already seen. If it is negative, then you are going to short the index futures. Now, if the above formulas result in fractional number of contracts, then round off to the nearest whole number. That we had a thorough discussion by putting numbers also. And if question says future contract is on index, but price is not given, use index futures into lot size to calculate the value of one index future per contract. If they just tell the futures contract is on index, but price is not given, what will you do? Future price you have no already, the future price, that only you multiply into the lot size, you will get to know what is the one index future per contract. Clear? Now we'll illustrate that and understand it. Now, hedging by trading in index futures. If index futures are 2000, same example we are going to take, same base example, but index future is 2000 rupees, one future, and the lot size is 50. If it is 50 lot size, then what you are going to do? 2000 into 50. 2000 into 50 is what? 1 lakh. 1 lakh is the minimum that you have to invest. That means minimum amount that has to be invested. Desired beta is 0.8. Same formula, 0.8 into 0.8 minus 1. One thing is missing. That's what I was thinking. There is some correction to be made. See over here, this formula. This formula will be totally illogical if at all you write it like this. This has to be multiplied into beta. This has to be multiplied into beta. Because if you do this, you are just hedging the portfolio, right? But index will react in a particular way, your portfolio will react in a different way. You have to multiply this into your existing portfolio beta. Okay. Wait, we'll see the example, you'll understand that. See. Outside 1.365 has to be there. Now imagine this is not there and you just hedge this much. Portfolio to be hedged will be 1904029. Okay, and you buy index for that value. If you buy index for that value, this was actually the stock also. When only portfolio was there, with portfolio with buying and selling also you were doing the same thing. Now if you buy index futures for this much and if the index goes down, your stock will go down by 13.65%. Because your beta was 1.365. So in that formula, you have to, if you're going with formula, you have to ensure that you write B1 in the outside. B1 in the outside. Done. Okay, now see. Now just take your calculator, 0.8 minus 1.365 divided by 1.365 into 46 lakhs. What are you getting? 19,04029. Okay, now into 1.365. When you do that, only you will get 25 lakh 98,998. Otherwise, you will be hedging only this amount and you will not be hedged. You will be in trouble. Okay, so when you multiply that into 1.365, that time you are getting 25 lakh 98,998. Always when portfolio or stock is going to be hedged with index, whatever amount you want to hedge, you have to multiply that with the beta so that your complete amount is hedged. Okay, divided by 1 lakh, you're getting 25.99. That means 26 contracts you have to go short. Why are you going short? Because you are going long on the portfolio. Now, if desired beta is 1.8, what will you do? Again, same thing, same formula, but outside just remember that you have to multiply into 1.365. That time you'll get 20 contracts. Okay, 20 contracts to go long. Why 20 contracts to go long? Because we want to increase the risk. Okay, we want to increase the risk. Now, if market went up by 10%, portfolio went up by 18%. Okay. How did we get to know that portfolio went up by 18%? Because the desired beta was 1.8. Portfolio went up by 18%. Now see, gain in the spot. In the spot market, what gain you had? 46 lakhs you had. 46 lakhs into 13.65% because your existing beta was 1.365. So you made 62, whatever this number is, you made that profit. Why? Because the market went up by 10%. Now gain, you made gain on index futures also. You made gain on index futures also. How did you make gain on index futures? 20 contracts into 50 rupees into 2000 rupees per contract into 10% because market went up by 10%. You made this amount. When you total this, no, that time you will get to know that the 18% is the desired beta. Desired beta or gain what you are expecting is 18%. Can you see? You cannot calculate directly. You cannot tell this went up, this went up. So the difference is the answer. In index futures, you cannot do that. What you will do if they tell you illustrate and show how the beta has gone to 1.8. If they ask you illustrate and show how the beta has gone to 1.8, then you are going to take the situation, random situation. If market goes up by 10%, when is market going up? On the future date. So on the future date, if market goes up by 10%, that time your portfolio also should go up by 18%. How will you illustrate that your portfolio went up by 18%? You are going to first calculate gain in the spot market. That means 46 lakhs into your existing beta. What is your existing beta? 1.365. So 10 into 1.365, the increase will be this value. Clear? Then you are going to tell, okay, market went up. It's not negative beta. No, market also went up. Portfolio also went up. So on the index futures, what profit are you going to make? Because you remember you went long on index futures. Correct? So there how much profit you are going to make? 20 contracts into 50 rupees into 2000 rupees into 10% because market went up by only 10%. So when you total this, you are getting a total gain of 8,27,900. Now out of your 46 lakh portfolio, this 8,27,900 is actually 18%. Clear? Sometimes, very rarely, ICAI will tell illustrate. Instead of just telling you to hedge, they'll tell illustrate how it actually got hedged. That time this is what you're going to do. Clear? In exam, they tell portfolio needs to be hedged. They don't mention desired beta. In such case, desired beta is going to be 0. We already had this discussion. Okay. Entire portfolio you're going to hedge. You're going to take desired beta 0, 0 minus that. That means entire amount has to be hedged by index futures or by selling or buying. Now, if index spot given, index future given, use index future price. That we had discussed already. If they give you index future price and index spot price, then you're going to take the index future price because that is what we want for the future. In case they don't give this index future price, then you don't have any other option in the exam. You'll rely on the spot price only and take. That means your assumption is what? On the maturity date, the spot rate and the index rate will be same. Future rate and index rate will be, future rate and the spot rate will be same because it will converge. It should converge, but there will be slight difference over there. That only creates the arbitrage opportunities. Clear? That should be it. And the last topic in futures, hedging commodities using commodity future. This is not there in the material because very rarely ICAI asks question on that. But still we have to understand and see. Now, this commodity future is what? Imagine you bought gold. Okay, on gold also in the stock exchange, there is future on gold. Gold futures, silver futures, copper futures, you can take on that as well. So, if commodity position is long, that means what? You are holding gold. Then you will create a short position on commodity futures. Short position means what? You are agreeing to sell. commodity position is short. That means what? You already sold and you're sitting to buy back. That time you'll create a long position on commodity future. Clear? Now, number of commodity futures to be sold or bought. Number of commodity futures to be bought. I think there is a grammatical error here. Bought or sold it should be. Now, total physical quantity in spot. Remember what we used to do for stock? Total value of my stock into, I used to multiply into what? Because I'm hedging with what? I'm hedging with commodity futures. I'm not hedging with commodity. In stock, what I used to do? I used to hedge stock with stock futures. Here I'm hedging commodity with commodity futures. That means it is traded in the market only. These commodity futures. Just like how there is beta for stock, there is something called as hedge ratio for commodities. Hedge ratio formula you see, correlation into standard deviation of spot divided by standard deviation of future. Do you recall this formula? What was the beta? One of the beta formula? Correlation into standard deviation of stock divided by standard deviation of market. Same formula will give you the hedge ratio. That means if the market goes in a particular direction, it will actually increase more or decrease more. Okay, therefore you will multiply it into hedge ratio. What we used to take it as beta for stock, we are going to use hedge ratio divided by future contract physical quantity size. Okay, now there also they may tell 20 contracts you have to take minimum, and one contract is 1000 rupees. So you will divide just like what you did for the portfolio and for the stock just now. You're going to do that. Clear? If hedge ratio is not given in the question, which can be a huge possibility, that means commodities, if you ask me, commodities will not react in a different way. Commodities also will be going in the same way. It's like basically telling silver and silver ETF. Both will be going in the same. If silver goes up by 10%, this also will go by 10%. But sometimes ETFs are what? It is just paper investments. So therefore, it might not react in the same way. So that is why that time you might have a hedge ratio. Clear? If they don't tell anything in the question, then obviously you are going to take hedge ratio as 1. 1 means what? It will react the same way as market. Okay. Now, they can ask you this question. I have not taken any example for that because it's the same formula that you're going to apply. Net cash received on maturity date after hedging. Net cash received on maturity date after hedging. First, amount received on sale of commodity on maturity. On maturity date, what will you do? You will sell the commodity. You will get the money. Total quantity into actual spot price on maturity date. You will sell it. Then plus or minus gain or loss on commodity futures. You will have gain or loss on commodity futures. How will you have gain? Total future contracts into future contract size into difference between future maturity date and initially agreed price. Imagine you have agreed to sell at 1500 and the price has gone to 1550. For you 50 rupees is loss because you have to still sell at 1500. Price difference will happen over here. Imagine you agreed to buy at 1500 and that day the price has gone to 1400. So for you 100 rupees is loss. You will still have to buy it at 1500 only. So on your commodity futures, if you have any profit or loss, that also will be taken. And this will be a net cash received after hedging. Clear? So what you're going to do? You have gold. You sold gold. You got money. But you are not sure about selling this gold at a particular price. Imagine you had 100 kgs of gold. Okay, 100 kgs of gold. Now when you had 100 kgs of gold, you thought, okay, this is a huge risk. Gold market is fluctuating. So you went short on the futures. You went short on the futures. So on that day, what you will do? You will take 100 kgs of gold. Okay, and you will sell it in the spot. You will not go and deliver it in the future market. You will sell it in the spot. And that day the rate was 12,000 rupees. Sorry, 1,20,000. What is the rate? Some amount. Whatever the rate that day is. Okay, you will take that rate and you will get the amount. Clear? Then you are still in a position that your future contract has to be settled. To settle, what you will do? You will do price difference. You will go and tell, okay, I had agreed to sell it at 12,000, but now the rate has gone to 12,500. So the price difference of 500 I will get, or I had agreed to sell it to you at 12,000. Okay, and the price has gone to 11,000. So now what will I lose? Sorry, what will I gain here? 1,000 rupees I will gain. Are you getting? When you are selling, if price goes up, it's a gain for you. Sorry, it's a loss for you. When you are selling, if price goes down, it's a gain for you. It's not like selling asset. It is selling futures because you already agreed to sell at a particular price. And if the price goes higher than that, that means you lost the opportunity. So there is a loss for you. If you agreed to sell at a particular price and if the price goes down, then it's good for you because the price difference will give you money. Clear? So whenever there is commodity futures, delivery won't happen. Only price difference settlement will happen. So delivery you have to do in the spot market and you have to settle your commodity futures by taking the price difference. Is this clear? Net cash received after hedging. Now, once again, I just want to illustrate this. Imagine you have 10 grams of gold. You have 10 grams of gold. And today the price is 12,000, which is irrelevant to you. You decided that you enter into a future contract in commodity futures, okay, to sell it at 12,500. You agreed to sell it at 12,500. After 2 months, the spot rate, after 2 months, let's take it as 1 gram of gold. Okay, after 2 months, the spot rate is 13,000. Spot rate is how much? 13,000. Now what will you do? Because it is 13,000, you will go and sell it in the market. Okay, sell gold at 13,000. Clear? Then you have to settle your future contract. Future contract, you have to settle future contract. But you have to settle the future contract at what price? 12,500. You have agreed to sell at 12,500. When you settle, what will happen? The price has gone up. That means you have a loss of 500 and your net cash received will be how much? 12,500. It comes down to exact future price which we had agreed on. Are you getting my point? Just that you have to present it this way because direct settlement won't happen. Price difference will happen and here you have to go and actually deliver in the market. Clear? If you see the other way around, you had 1 gram of gold. Today it is 12,000 and you have entered into future contract to sell at 12,500. So on the maturity date, what will happen? The spot price is 11,700. So what will you do? You will go and sell the gold at 11,700. Then you will settle your future contract. You had agreed to sell at what price? 12,500. Market is how much? 11,700. So automatically what will you get? 12,500 and 11,700. Difference is what? 800 rupees you will get gain. You come back to 12,500 itself. Net cash received. Clear? Yes. This is our discussion on futures. See, this is hedging. So whatever happens, you should be sitting in that position only. You cannot be making any kind of gain. I mean, you don't have opportunity to make any kind of gain because you have gone opposite. Here you're longing the stock. There you're shorting the future. Here you're shorting the stock. You're longing the future. So basically it will offset with each other and you are not in speculation or arbitrage. So your intention was just to ensure that you're getting the predetermined price. So if ICAI asks this question, this is how you're going to present it. Clear? Done. With that, we are done with derivatives ka one part. Now we have to go into derivatives ka another part. Options contract. Now, what is this options contract? Very, very important part. Very, very important part. Maybe one future day you will be making good money with this. Or losing all your money also with this. You never know, right? Yes. See, in futures, right? I entered into future. Okay. Telling that I will buy after 3 months. Now, after 3 months, I thought I will buy because the price was supposed to go up. Now the price is falling down like anything. 1500 is the price. I had already entered into future contract to buy it at 1800. Now I have reached that 3 months date with a very heavy heart. Now can I tell, get lost? I am not going to complete this contract at all. Is it possible? Is it possible? No, you are obliged to perform the contract because already your margin money and other things are sitting over there. You cannot tell no also. Everything is linked. Clear? So now imagine you are going just walking outside the Bombay Stock Exchange. You are walking outside the Bombay Stock Exchange and one person tells, boss, there is one ticket. Okay, there is one paper. Let's say there is one paper. I am selling this paper. This paper gives you an opportunity to go and buy share in the future. You're like, only paper? You're like, yes, only paper. This paper you take, that time you can buy shares of Reliance in the future. Then you're like, okay, give me that paper. Then he's like, but whatever happens, you have to buy the share. And today you have to give me margin money. Then you'll be like, take, I don't want this paper. Correct, no? Now, if somebody tells you outside the stock market, telling that, see, take this paper. Take this paper. Hold this paper with you. For holding this paper, nothing. Don't worry at all. On the future date, if price is good, okay, in this paper I am writing 1500. Okay, you have the option to buy it at 1500. This is one ticket I am giving you. And now on that day, if at all the price is more than 1500, you give this paper and take the share at 1500. If at all the price is something lower than 1500, you just tear this paper and throw it off. Clear? This is option contract. No obligation at all. You can just run away from the obligation any point of time. Now, tell me one thing. This paper, will it come for free? This paper, will it come for free? The price of the share is 1500. He is like, pay 30 rupees today and buy this ticket. This is basically like what, you know, buying lottery ticket. Buying lottery ticket. If you lose, 30. If you gain, you might gain any amount. Clear? Are you getting this? So basically in this, there are two parties. One who is buying this ticket, one more who is selling the ticket. So the person who is buying the ticket is option buyer. One who is selling the ticket is option seller. Are you getting this? Now the person who is selling the ticket, imagine you won 1 crore lottery. That time you go and present the ticket. Can he tell no? Can he tell no, I am not giving you this 1 crore? No, he is obliged. That means the person who is taking the ticket, for him it's an option. He can win or he cannot win also. But he might lose 30 rupees in that. Clear? So this is options contract, which is completely different from futures. Here you have an option to buy or sell. Clear? Now here we have two options. One is called as call option. One more is called as put option. Just understand like this. Never get confused between these two terms. Call option means I have the option of calling. Calling means what? Asking. Asking means what? Buying. Clear? Put option means I have the option of putting it. Putting it means what? Selling it. Is this clear? So call option means you have the option of buying and put option means you have the option of selling. Now types of options. First one, call option. Now see over here. Imagine the underlying asset is Infosys shares and lot size is 200. Obviously the ticket will not come for one share and all. Okay, one ticket means you can buy 200 shares. Okay, so lot size is 200 shares. Agreed price or exercise price or strike price. Any of these words can be used. Agreed price or exercise price is the most relevant word, exercise price. Okay, or strike price also they can tell. What does it mean? That means you have the option to buy at this particular price. You have the option to buy at this particular price. Sell we'll see later, input option. Okay, so therefore 1500. That means I can go and buy shares of Infosys at 1500 if it is favorable to me, or I will just ignore it. Now, premium to be paid by the option buyer. Who is going to pay premium? The option buyer will pay the premium and buy this ticket. Clear? X, buyer of call option, has acquired the right to buy. The buyer of call option has acquired what? Not the share. He has acquired the right to buy. In futures, what? You have acquired the share itself, but you will acquire it on a future date. Here you have just acquired the right to buy the share. Okay, so why? Seller of call option. Now, one thing I want to tell you, major difference which you have to understand. Imagine you have entered into a future contract that you will buy the share at 1500. Okay, that means you have to buy it at 1500. There is no other option. You have to buy it at 1500. Next day, the price has become 1550. Okay, imagine mark to market. Immediately 50 rupees will be taken from you. Mark to market situation, 50 rupees minus in your account. Correct? After that day, it became 1600. 1600. Immediately what will happen? Again 50 rupees will be taken from your account. This is future contract, how it's going to work. Because you have to deliver it. Okay, so the price difference or actual delivery, whatever happens, this mark to market will be happening every day. Now imagine 1500 ka option you have taken. And what option you have taken? Call option you have taken. Now if you have taken a call option, 1500, you're going to buy it at 1500. Now see what happens. If this is the situation, see what happens. And to take this call option, no, you paid 50 rupees premium. You paid what? 50 rupees premium. From your pocket, what went? Only 50 rupees. And your obligation fully is only 50 rupees, done, finished. Now tomorrow, if the price goes to 1550, actually, my bad. I put ulta no here. It should have been 1450 and 1400. If the price goes down, it's loss, no? For the person who is buying. He could have bought at a lower price. Now he has to pay 1500 and deliver. Are you getting this future contract? 1500. I have to buy at 1500 at any cost. Market price is 1450. That means 50 rupees gone. If market price is 1550, I would get 50 rupees. I mean, that also can happen, but that will not serve our purpose of the example. Okay, 1400 if it goes to, again, market price has gone down, but I'll still be buying at 1500 only. 50 rupees mark to market. Now here, 1500 call option, I paid 50 rupees premium. 50 rupees premium I paid. Now tell me one thing. Next day, the price has gone to 1450. Price has gone to 1450. What will happen? What will happen? Will they take any money from me? No. But my premium which is there, no. The premium, now that will be selling at 40 rupees premium. That option will be trading at 40 rupees premium. Why? When they can buy at 1450 in the market, why will somebody enter into call option for 1500 buying? They should buy at 1500 expecting that this will go higher. No, it has gone lower. So this will become a cheaper ticket. It will become what? A cheaper ticket for you now. Imagine it goes to 1300. Then this premium might be actually at around 15 rupees. Because somebody can buy the stock at 1300. If they are entering into call option to buy at 1500, that means that ticket should be extremely cheap. Are you getting this? So what you can lose is the premium amount that you paid. What you can lose is the premium amount that you paid. And if you go to the market and you check, what people are actually trading in is the premium amount. They're not trading in share. They're trading in the premium amount. You are buying a call option with the premium of 50. Tomorrow, you purchased at 50 rupees. Okay. Tomorrow, imagine the price went to 1600. That time, this call option will be trading at 60 or 70. 60 or 70. Now to illustrate option trading or options, how it works. Now recently, let's say one day, Sensex was at 76,000. Sensex was at 76,000. Okay, that day, when it was at 76,000, you could have entered into a call option. Call option is buying the index. You will not literally buy it, it's just delivery. Price difference. So call option on Sensex. Call option on Sensex, and this is a 1 week period. It was for 1 week. Call option on Sensex was available at 440 rupees. 440 rupees. That's the premium that you're going to pay. 440 rupees. Clear? Now, you can buy it at what price? 76,000. Call option. Now, Next day, market news was favorable, war was about to stop, and then this same Sensex was trading at 78,500 in one day. 2,500 points jump. No motivation to trade, but I'm just telling you, this 440 rupees call option which was there, no, this was trading at a premium of 800 to 1000%. It was trading at a premium of 800 to 1000% in one day. That means if you had invested 440 rupees, you would get 4,400, 10 times. If you had invested, you can't invest 440, that's just an example because it will be lots of something. So I think minimum lot size was somewhere around 13,000 something. If you had invested 13,000 rupees, in one day it would have become 1,30,000. It would have become 1,30,000. Clear? Same way, we have to show both sides, no, like that all add and all. You should show that one germ will be there that can cause pandemic also, we don't know. Okay, so now same way, there was a day when the Sensex was at 77,000. Okay, and there was a put option, let's say trading at around 400 rupees put option. Okay, that means you can sell at 77,000. Next day, Sensex was at 74,500, 2,500 rupees fall. So now same way your 400 rupees also gone, damar. 400 rupees also gone. So therefore there is downside risk also. There is upside opportunity. I am not telling you upside benefit and all, upside opportunity. Okay, and that happens only if you are Trump. Because he knows what he's going to tell. If you're Trump, no, you can make an announcement, buy the share, buy the options, make the announcement, then you can make profit. So don't get into that. And if this war and all is not there, that time this kind of 800%, 1000% and all you will not get. If war is not there, market will be going like this. Sideways. It will just be going sideways. Hardly any fluctuations will be there. So therefore, you cannot buy any call option. You cannot like 2%, 3%. You might be getting benefit. That means if you're sitting every second, you can capture this. You can capture this. You can capture this. You can capture this. That means full day you should sit and keep seeing the market. But to capture this, when it reaches here, you will feel that it will go here. So you will miss that opportunity and you will be somewhere over here. You might seize that opportunity. So therefore, option trading can be profitable. If you are going to sit from morning 9:30 till evening 3:30 in front of the computer, then you can make good money out of it on a day-to-day basis. If you are going to do any other work, and if you buy some call options and your principal gives you some work, when you go for the review meeting and come out, that month's stipend would have been empty. Okay, because of the market reaction. Yes. So now options contract, first thing is call option. Call option means what? You have the option to buy. You have the option to buy. So the option buyer he has just acquired what? No share, nothing. He has acquired the right to buy the share. And imagine Y is the seller of call option. Seller of the call option, what he has done? Seller of the call option has actually taken huge risk. He has given the right to buy to someone else, and that also at a small ticket price. Seller of the call option has sold the ticket and told that guarantee I'll give it to you at this price if you come. So the risk is on whose head? Seller of the call option. Clear? Hence has the obligation to sell if the option buyer chooses to buy the asset. Imagine that person comes and tells, boss, I want to buy the share. Now the seller of the call option can never deny. He can never deny. He has to give the share. Imagine this was at 1,500 and on that day the price has gone to 3,500. Okay, if it has gone to 3,500, then still he has to give the share at 1,500 only. That means that fellow poor guy has to buy at 3,500 and sell it to this guy at 1500. Clear? So understand this. If it is a call option buyer, if it's a call option buyer, he will buy the share. Okay, if it's the call option seller, he has to sell the share. He has to sell the share. But if I am telling you about put option, if it's a put option buyer, he has the opportunity to sell the share. And put option seller, when this guy is selling, that guy has to buy the share. Is this clear? So whatever the option buyer does, option seller is obliged to do the opposite. Option buyer is not obliged to do anything. Option buyer has the option to do it. Clear? Now see the put option ka example. Underlying asset is Infosys shares, lot size is 250 shares, agreed price, exercise price, strike price 1700. What does it mean? Agreed price, exercise price or strike price? That means you have the option to sell at this particular price. Now premium to be paid by the option buyer. Okay, every time the premium, whether it is call option or put option, premium has to be paid by whom? Option buyer only. X buyer of put option, not call option, buyer of put option has acquired the right to sell. And Y seller of, not call option again, seller of put option has given the right to buy to someone else. Make those corrections, please. Make those corrections. X buyer of put option it is has acquired the right to sell. Y seller of put option has given the right to buy. To someone else. And hence the obligation to buy if the option buyer chooses to buy the asset. Clear? So now what you have to understand, if it is a put option and if you're a put option buyer, you have purchased the ticket and you have the option to sell the shares. If you're a put option seller, then you have given the obligation to someone else and he has given the right to someone else to, oh this is correct I think. Yeah. Right to sell to someone else. Okay. And has the obligation to buy if the option buyer chooses to, here the mistake is, chooses to sell the asset. See the other terminologies. Buyer of an option is also called as option holder. Seller of an option is also called as option writer. The person who prepares that ticket is called as option writer. Otherwise, it's called as option holder. Done. Next, let's just quickly have a look at this. Option buyer, option seller or option writer. Option buyer, what does he do? He pays the premium of rupees 50. Okay, current market price is 500. He'll pay 50 rupees premium. And this fellow, what he will do? He will sell the option. For this guy, there is an option. There is no obligation. For this guy, there is no option. There is an obligation. Clear? If this option can be call option or put option. Call option means what? Option to buy. Put option means option to sell. Now before we go into this, we'll see some option terminologies and then we will see the other things. Okay, option terminologies. In the money, at the money, out of the money, intrinsic value, extrinsic value, all that we will see. First we will discuss if it is a call option. Now try to understand this. Exercise price is 960. Exercise price is what? 960. Current market price is 1000. Current market price is 1000. That means today only I can buy it at 960 and sell it at 1000. Correct? So intrinsic value is 40. What is intrinsic value? Today only there is a benefit of 40 sitting in this particular option. But you will not pay only 40, no. You will pay that extra charges also, premium. So that is your extrinsic value. The premium that you pay is your extrinsic value. So your total premium becomes 65. total premium becomes 65, because otherwise that fellow is fool over to give the option today and you will just go and make 40 rupees profit. Are you getting my point? So today exercise price is 960, option price is 1000. Sorry, exercise price is 960, market price is 1000. Now you are thinking, sir, today only sitting, I'll buy, sell, over, finished, 40 rupees profit I can make. You cannot make that profit. You can make profit only if the future fluctuation happens. So here, now he also knows, no, today you will get 40 rupees benefit, but I am giving you this option for 2 months or 3 months. So I will charge 25 rupees as extrinsic value, extra value. So total premium is for today's benefit plus the future fluctuation that can happen. 65 rupees is the premium. Is this clear till here? What, sorry? This is the total option premium. This is just to understand the concept of intrinsic value and extrinsic value. Yeah, total premium. For selling and buying, the premium is same. No? I am buying calculator also for 330 rupees, selling calculator also for 330 rupees. No? Extrinsic value is because there is still more time period. No? Today you saw the market, there is already 40 rupees ka gap. But the market can go even more different, right? Market can go, it's sitting at 1000, it can go to 1500 also when the time period of the option gets over. Yeah, whichever option it is. When you're buying the call option. What's the doubt? You have to pay 65 rupees if you want to buy this call option. The call option which has an exercise price of 960 as of today. Now, simple logic. You are the person who is selling the call option. Okay, and you are selling the call option. That means you are giving somebody else the right to buy the share from you. When you are selling the call option, you saw exercise price you have set at 960. And you saw what is the market today. This is for 2 months, okay? You saw what is the market today. Market is trading at 1000 rupees. Now, if you just sell it at 25 rupees premium, this fellow will buy it, sell it and make sitting 15 rupees profit. So, you know there is already a benefit of 40 today itself. You know there is already benefit of 40 today. So, that 40 you are going to charge him anyways. Plus, you are giving him for 2 months, not for today. If you are giving him for today, no, only 40 rupees would be the premium. You are giving him for 2 months. So, again 25 rupees you will add. 25 is an imaginary number. Extrinsic value 25, who decides it? That we only will decide when we go into fair pricing of option computation. When we have different methodologies to compute the value of the option, we will decide the value of that option. So now here 25 rupees is charging for what? For giving you that extra time. So now total premium you are going to pay 65 rupees because already the share is sitting at 1000. It can go upwards. If it is going upwards, that means he is going to benefit only because he is going to exercise it at 960 rupees. This kind of option where you have benefit at the moment itself is called as in the money. Remember in the heading there was in the money, at the money, out of the money. This kind of option is called as in the money option. Already there is benefit today. See the next situation. Imagine the call option is for 980 and today the market price is how much? 1000. That means today only you have a benefit already of 20. Today only you have a benefit of 20. But now the premium is 15. Why the premium reduced? The gap is less between the market price and the exercise price. So the premium has gone down to 15. Now total premium that you have to pay is 35. This is also called as in the money. Why is it called as in the money? Today only you are having a benefit. Today only there is benefit for you. Now 1000 rupees is the option. 1000 rupees is the price today. That means today you don't have any benefit, but it can happen. It can fluctuate in the future. So 0 is the intrinsic value, but 10 rupees is the extrinsic value. Total premium you pay is 10 rupees. Now can you tell that there is no gap in the pricing today, so you should give me this ticket for free? You can't ask them to give this option for free, no. So this is called as at the money. At the money. What is at the money? At the money means today whatever the price is there, the option is trading at the same price. That means you have the right to buy the share. I mean, you have the option to buy the share at today's price somewhere in the future. Clear? Now, imagine today the price is 1000, but the option is at 1020. Why will someone enter into this option? Because they feel today it is 1000, after 2 months it will be 1500. So I'm ready to buy it, I mean, ready to get into the option at 1020 today. Today I might not have any benefit. So can you see here it is 0, and such option will be trading at less premium, 7 rupees premium. Okay, this is called as out of the money. This is called as out of the money. And next one you see, 1040 is the exercise price. Today's call option is at 1000. That means 0 intrinsic value, 3 rupees. And this is also called as out of the money. This is also called as out of the money. Is this clear? Option seller? That fellow is the person who will expect it will not go up only, no? For him, premium is the money. He cannot back out. It's regularized. No, he cannot back out. It's regularized. Now, if you want to sell options on the market, your first one, your money will go. Didn't get it. Now, I'll illustrate to you guys. Now see, there is HDFC Bank. Okay, I'm just showing HDFC. I'm just seeing HDFC Bank. I mean, if I show on screen, it will not display properly. Okay, HDFC Bank. Right now, the call option. Okay, April 28th is the expiry date. Let me not take April 28th because April 28th is very close by, right? I'll change the date to 26th of May. Okay, 1 month call option. 1 month call option. Today's price is 815. Today's price is what? 815. So now, if you are going to buy it at 815, no call option, you will get it at 24 rupees premium. If you buy at 820, no, you will get it at 22 rupees premium. If you are going to buy at 825, you will get at 20 rupees premium. Going further, if you want to buy a call option at 850, no, you will get it at 11 rupees premium. If you want to buy it at 900 rupees, no call option, you will get it at 3 rupees premium. Why is that like that? Because today it is at 805. First of all, it has to reach till 900 for you. From after that, you will start making profit. Actually, if it reaches 903 only, you will start making profit because your premium also has to get covered. That is why it is trading at a very low price. Now, if you see the other way around, okay, today it is at 850. If you enter into put option, that means you have option to sell at today's price only. It is at 45. It is at 45. But as you go higher, you want to sell at 855. If you go higher for the put option, imagine you want to sell at 915. Today only it's not at 915. You have to pay 100 rupees premium. Can you see? Because it has, for the person who is selling the option, no. For him, he'll benefit only if it goes down. If it goes up, he'll be in complete losses. So therefore, put option, as the price goes higher, premium increases. Call option, as the price of the call option goes higher, premium decreases. Call option, not the spot rate, nothing. When you want to buy the call option, compared to today's price, if you are buying it at higher price, price decreases. Compared to today's price, if you are buying put option, as the price goes higher, the price increases. Because today only it's not at 845. You are ready to sell at 900. So the price increases. That is one thing. And another thing I wanted to display to you guys. Now see, today, there is a call option. Let's say there is a, where is today's price? Today's price is 815. So call option is there. Call option, if I want to buy, 24 rupees 90 paise it is. So if I click on buy, one lot they are telling it is 550 units. One lot is 550 units. So minimum amount, if I want to buy, no. So 550 into 24, minimum I have to spend 13,200. Clear? Now imagine if I tell I don't want to buy, I want to sell the call option. Okay, market is not open, so it's not giving me. But if the same thing, if I want to sell the call option, no, the price that I have to pay is around 1 lakh. Is around 1 lakh because they are going to take the entire amount. Now on the delivery date, you can't run away. They are going to take the entire amount. Now, in case on that day he doesn't execute, you will get that plus the premium amount that he has paid, entire amount comes to you. Okay, so did you understand? I mean, in future, there are graphs that I've drawn some graphs which will explain this. So, if you are talking about physical actual trading, you cannot run away because everything is done through the market itself, through the broker or through the stock exchange itself. So, you cannot run away from the situation. If it's between two people, they're telling that I have gold. If you want, you can buy it at this price. Then obviously they cannot oblige to the contract. Is this clear now? Whenever there is a current benefit, that is called as in the money. Whenever there is no current benefit, that is called as out of the money. Why will someone buy a call option at 1020? Because they feel today it is 1000, but after 3 months or 2 months, it will be not at 1000, it will be at 1100. That time I'll be making 80 rupees profit over here because I can buy at 1020 and sell at 1100. Is this clear? Now, going into the same thing for put option. 960 is the exercise price. Means what? I can sell the option, I can sell the share at 960 rupees. Clear? What is the current market price? 1000. That means today, do you have any benefit? You buy in the market at 1000, you will sell it at 960, no benefit today. So intrinsic value is 0. But some premium you have to pay, no. Extrinsic value is 12, total premium is 12. This is called as out of the money. This is called as out of the money. And here exercise price is 980 and current market price is 1000. Do you have any benefit today? Can you buy in the market today and sell it through the option and make profit? No. So intrinsic value is 0. Extrinsic value is 18. Extrinsic value is 18. This is also called as out of the money. Can you see as the price, exercise price increased over here, premium has decreased, and here as the exercise price increases, premium is increasing. Clear? If you ask me, no, what is this, sir? How this is decided? This is nothing but future value of today's difference or holding period yield. Or if you ask me, this is nothing but time value of money. I'm going to wait for 2 months time value of money. Okay, there are methods to calculate this, but if you ask me, it is nothing but time value of money that is going to be there. Now today it is 1000, market price also 1000. Do you have any benefit today? Exactly priced. So intrinsic value will be 0, extrinsic value will be 25. It went little higher. So this is basically at the money. This is called as at the money. Now 1020 exercise price. That means today only you can make profit. Today you can buy in the market at 1000 and sell it at 1020. So 20 rupees is intrinsic value. That would have been obviously calculated by the seller. And 23 rupees is charging premium. 43 rupees. This is called as in the money. And 1040 also today only you have profit, and this is also called as in the money. Clear? Now, obviously in MCQs they can ask you this question. They can give you all these details. They can tell you to calculate either intrinsic value, okay, or they can tell you whether it is in the money, out of the money, at the money, or none of the above. Okay, they can ask this in MCQs, which you need to know. I'm just keeping it open. Let me know if you have any doubt. I'll just fill water and come. Yes, any doubts with this? Clear? This is the basics of what it is. Clear? Now, let's go further. Extrinsic value represents time value of money component. That is what I was telling you. Intrinsic value is what? Today's benefit. Extrinsic value is what? For holding. For 2 months I have to wait. No. I don't know what fluctuations can happen. That is time value of money component. So basically, an option premium is what? Today's benefit plus future time value factor. If you add that, that is how the option premium is calculated. Clear? Note. Option status simply compares exercise price versus current market price. So what did we do when we calculated option status, in the money, out of the money and all? We didn't compare it with the premium. In the money, out of the money and all that we did. How did we compare it? Exercise price plus current market price. That's it. Okay, we are not going to tell that extra 25 rupees, 12 rupees we have to pay. That we are not considering. Okay, ignore premium amount paid or received while determining option status. Clear till here? Yes. Now, let's go and check the concepts a little. I think a little more we have to finish to reach there. Yeah. Style of the option. Now ICAI will just tell this is this option. This they will not tell you anything else. Okay, based on their exercisability. Now there are three types of option. One is called as American option. One is called as European option. Other one is Bermudan style option. American option means what? Now imagine today you enter into an option and this is the exercise date. On that day you can exercise or not exercise the option. Clear? So in this situation, okay, American option means any time over here you can go and exercise the option. Anytime. Okay, you entered into a call option telling that I am entering into option to buy the share. Anytime, immediately you saw price went up, you can go and exercise your option and sell it in the market. This is called as American option. If it's European option, let's say you entered into an option to buy the share at 1500. Today you saw the share has already touched 3000. You can't do anything. You can't do anything. You can't exercise your option. You have to wait till the exercise date. And let's say on exercise date it has dropped down and it has become 1200. Still you'll have to either buy it at 1500 or you'll go to market and buy it at 1200. So you lost this opportunity. Is this clear? But when it went from 1500 to 3000, your option which you had purchased, the premium amount went up. So there you will make a little profit. Now, Bermudan style option. It is basically like a mixture of American option as well as European option. What did American option tell, boss? You can exercise anytime. Anytime you come to me, you can exercise the option. What did European option tell? Boss, you can exercise only on the exercise date. Clear? You know what Bermudan option told? Bermudan option told Wednesday you can exercise. Okay, Wednesday you can exercise. Wednesday you didn't exercise. Thursday there was price hike. Don't come to me on Thursday. Next, I'll give you opportunity again on Friday. Friday if you want to exercise. The next date is Tuesday. Next week Tuesday. After that again Friday. Can you see what they have done? They are giving you opportunity to exercise during the exercise period, but not anytime. On broken dates. On what dates? Broken dates. Can be exercised in between some specific dates that can be exercised on broken dates. Clear? So if you want to remember, American option means A, that means anytime. European option E, that means only on expiry date. Bermudan option means B, that means on broken dates. Clear? So that should be it. And what we follow in India is European option. We follow European option. That means it can be exercised only on the exercise date. In between, you don't have option to exercise it. Now, first thing, we start with this speculation. Highly bullish, mild bearish, highly bearish. You make the American option will be priced little higher. The premium will be priced little higher because they are taking more risk. No. Now, for example, if I'm a seller of European option, what I have to predict exactly 2 months later, what will happen on that day? I have to do basically like valuation. I have to do for 2 months period. I don't have to do for all the dates of those 2 months. In middle, I might expect a rise, a fall, a rise, a fall, doesn't matter. Exactly 2 months later, what I'm expecting, that's enough. Premium? No, premium will be little higher for American option.
So basically, if you want to sell the option, then the intrinsic value of the put it in the premium. He wants to sell it. So in the American option, he'll exercise and the price difference. Both will be same. What was
The benefit? No. The benefit you're telling? No. Because here in American option, no. This guy has opportunity to exercise n number of times. So you see one spike over here, he'll exercise over here. But if it's European option, he missed this spike. He missed this. He can't do anything. He will have to exercise over here only. There is a smaller spike here.
option only is selling. No, no, no.
Option only he'll sell it. Who? Option buyer. Option buyer can't sell option, no. He can trade. He's trading only with the premium part, he can get benefit. You're telling like this, no. Now this fellow has paid 30 rupees. And if even it's European option, if it has touched here, this premium would have gone to 200 rupees. So he's getting 170 rupees profit. This is what you're telling. Now imagine the share was at 1500 and for this to become 200 rupees, share has gone to 3000. The benefit is not the same. Because now this guy, if he can exercise, no. If he can exercise, he can buy the share, at 1500 because that was the call option and he can go and sell. He'll make 1500 rupees profit per share. But in premium when you're trading, you will make only 170 rupees. No. That is on today. Only on every day it will not be included. That is today, like when the option is launched. They can't, check every day's situation when they are launching, right? So usually American option will be priced higher because you are giving more opportunity to that guy, and Bermudan option will be priced second highest because you are still giving more option, and European option will be given the least pricing because you are giving him opportunity only on the future date. But this is actually theoretically. But because in market people trade with this option itself, no, that's why the option price also keeps going up. Now it's basically demand and supply. Actually, there is no concept of trading in the option. I have an option to buy at 1500. Market went to 1700. So now there is more demand for buying the option at 1500. So therefore, my option which I had purchased at 1500, it increased in demand. So price went up. That is how the premium fluctuates in the market. Theoretically, we are not going to do speculation in premium. Theoretically, we are doing speculation in the share price only. In exam, we are not going to do speculation in premium. It's like, oh, I have an option at this price. Market has reached this price. I'll buy and sell the share and make profit. In stock market, because of demand and supply, this gets created. Now, we go into speculation. This part, whatever is written, we will illustrate it and understand. See the scenarios that we have. First scenario is heavily bullish. Okay, all this you have to understand it. They might not ask question like this, but in the question to understand the situation, right, you need to know what is the situation here. Heavily bullish means what? Heavily bullish means what? You are expecting the market to go up. That is why it's called as heavily bullish. Clear? And current market price is 50. And heavily bullish, no. So we are expecting it to touch 120. What should you do? You should buy the call option. You should buy the call option because it is heavily bullish, so you can make profit. And imagine you paid a premium of 10. Premium of 10. Now imagine the current market price is 80 and it is heavily bearish. Now if I have to illustrate over here, imagine you got the option at the money. Let's assume that you got the option at the money, 50 rupees only. So you paid 50 rupees and you will sell it at 120 rupees. Okay, you will buy it at you'll exercise your option, buy it at 50, sell it at 120, 70 rupees profit you will make, 10 rupees premium went, 60 rupees is your net profit. Clear? Now, if it is heavily bearish, you are expecting the market to fall. That time what option will you enter into? Put option. You will become a put option buyer. You will become a put option buyer. Now see, 80 rupees you have entered into option. It has touched 20 rupees. So you will get 60 rupees profit over here. Plus 10 rupees premium. So that means you will get only 50 rupees profit. Clear? Now, the situation is not about these two. Now the situation is, what if it is mildly bullish? Mildly bullish. You are expecting it to go little up. Now that little up situation, no, you can't be call option buyer also, put option buyer also. It is always better to become option seller in that situation. Option seller. See, if it is mildly bullish, you are expecting from 50 it will go to 58. That time if you buy call option, what will happen? You will make 8 rupees profit and you will lose 10 rupees. So you are sitting in -2. Okay, but if you are a put option seller means what? You have given the right to sell to somebody else. Boss, you can come and sell it to me. And for that I have charged 10 rupees. If he comes and sells it to me, then what I will do? I will have to give him the share at 50. I have to buy from the market at 58. 8 rupees loss, 10 rupees profit, 2 rupees gain. Are you getting this? So when there is mild bullish and mild bearish situations, the concept has to be absolutely clear. If it is heavily bullish and heavily bearish, we know. Oh, it's going to go shoot up like anything. I'll buy call option. It is going to fall down like anything. I'm going to buy put option. Now, see this. 10 rupees premium. See this situation. All the 4 situations I have illustrated over here for mildly bullish. Call option buyer. What will you do? Call option buyer. If you are a call option buyer and you had an option to buy at 50. Market has touched 58. What will you do? You will exercise, no. You have no other option. You will exercise because buying at 58 doesn't make sense to you. So you will exercise the option. Buy at 50, sell at 58. 8 rupees profit. 10 rupees premium gone, net loss of 2. You are like, sir, mad guy. If you would not exercise, 10 rupees gone. Mad guy is seeing that there is loss. If it does not exercise, 10 rupees gone. 10 rupees premium you already paid. So even though he sees that there is only 8 rupees profit over here, now if he exercises only, he will reduce that loss to 2 rupees. Clear? So if you are an option buyer, just remember this, okay? If you are option buyer, whenever price goes up by 1 rupee, 2 rupees also, you will exercise. You will exercise. That is the beneficial situation for you to avoid your losses or reduce your losses. So you will exercise the option, buy at 50, sell at 58. That means how much profit you are going to make? 8 rupees. 10 rupees premium is anyways going to be paid. It's paid at the starting of the contract only. 2 rupees is your loss. Now imagine you are a put option buyer. Put option buyer. If you are put option buyer, you are entered into the contract and you have an option to sell at 50. You are mad over to sell at 50. Market has touched how much? 58. What will you do? You will sell it at 58. But to sell it at 50, sorry. What am I talking? He has an option to sell at 50. He will just ignore. He will not exercise the option at all. But premium 10 rupees gone, 10 rupees loss. Is this clear? So if a call option buyer exercises, 100% a put option buyer will not exercise. If he exercises, he can exercise, but he will incur more loss. Imagine if put option buyer exercises, then he'll have to sell at 50, buy at 58, 8 rupees loss here, plus 10 rupees, he will make 18 rupees loss. Are you getting this? This is the best scenario I have written over here. You can go against this, but when you go against this, your loss will increase or your profit will decrease. If it's a profitable situation, profit will decrease, otherwise your loss will increase. Clear? Now imagine you're a call option writer. Call option writer means what? You have given somebody else opportunity to buy from you. That means if they are going to buy from you, you have to sell it to them and you are forced to sell it at 50. So you will sell at 50, but in the market you will buy it at 58. So you have a loss of 10. So premium you got 10 rupees. sorry, loss of 8, premium you got 10 rupees, you have net profit of 2. So can you see these two are sitting in opposite situations? When there are two parties, if one party is making profit, the other party has to make loss. Correct? Now, if you are a put option writer means what? You have given the option to sell to somebody. That means if you are a put option writer, somebody will sell. That time you have to buy. If you have to buy, they will not exercise because market price is 58 higher. They will not exercise. If they don't exercise, they don't come to you on the exercise date. What will happen? 10 rupees will put in your pocket. 10 rupees will just sit in your pocket. Is this clear? So, these scenarios doesn't make or not required when we are seeing heavily bullish or heavily bearish. Heavily bullish or heavily bearish, you don't have to think about the scenarios. But it's mildly bullish, mildly bearish, you have to see all four angles. Because ICAI can ask you a question, illustrate the situation of call option writer. Okay, that time you should know this. Just have a look at this. Let me know if you have any doubts. Clear with this? Now, we saw mildly bullish situation. Now, we'll go and see mildly bearish situation. Mildly bearish is current market price is 50 and it is expected to go to 42. If it goes to 42 and best option for you is to sell call option. Best option is what? You are expecting the price to go down. Okay, sell call option. Sell call option means what? Here what did you do? Here you sold put option. Why did you sell put option? See, put option writer made the highest profit. Put option why you sold? Because put option is basically telling you come and sell the share to me. I will buy the share from you. But if the market is going to go up, okay, if the market is going to go up, they will buy from market only. They will sell it in the market only. They will not sell it to you at 50 rupees. They're going to lose money. Same way, if the market is going to go down, okay, if the market is going to go down by little, not too much, little. So if you are a call option seller means what? I am telling boss, come and give the come to me. I will sell the shares to you. That means you can buy the shares from me. Call option seller gives the right to somebody else to buy the share from them. So if the market is going to go down, they will not come to you only. They'll buy it from the market. Are you getting this? Buy shares, sell call option. Yes. Now, understand this situation. 50, from 50 it is going to 42. If you are a call option buyer, you have the option to buy the share at 50, but you can see market is sitting at 42. You will not exercise the option at all. Okay, but you have to pay the premium, so 10 rupees gone. If you are a put option buyer, you saw that market has gone to 42. You have the option to sell at 50. So you will exercise. If you don't exercise, you will incur more loss. You will exercise and you will make 8 rupees profit. Sell at 50, buy at 42, you will make 8 rupees profit. But you pay 10 rupees premium, so 2 rupees loss. Imagine this fellow doesn't exercise, he'll make 10 rupees loss. If he doesn't exercise, he'll make 10 rupees loss. If he exercises, he'll make 8 rupees profit, 10 rupees loss, net loss of 2 rupees. Clear till here? If you are a call option writer means what? You are giving somebody else the right to buy. If you are giving somebody else right to buy, that means you should sell. So now what will they do? They will not buy because 50 rupees is the price. Market is sitting at 42. They will not buy. If they don't buy, very good. 10 rupees full into your pocket. Premium is your profit. Okay, put option writer. Put option writer means what? You are giving somebody else the right to sell. You are giving somebody else right to sell. If somebody else has right to sell, that means I have to buy it. And they will exercise because they can sell at 50, whereas market price is 42. So therefore, you will incur a loss of 8, but you got premium of 10, so 2 rupees profit. So basically the moral of the story is, okay, no, this should have been 2. This should have been 10 and that should have been 2. So basically the moral of the story is, if it is mildly bullish or mildly bearish, you cannot make profit if you are a call option or a put option buyer. You can only make profit if you are a call option or put option seller. That is what I told you at the starting of this chapter. The market is going like this, sideways. That time you cannot make profit if you are a call option buyer or seller. You can make profit, call option buyer or put option buyer. You can make profit only if you are a call option seller or put option seller. What you will do? You will sell one call option, you will sell one put option in this bandwidth. The share is not touching that bandwidth only. So that time you are obviously going to make profit. You are risking a lot of money, but you are going to make profit for sure. What is the profit you are going to make? The premium amount that they are going to pay. Is this clear? So now imagine share is trading like this. Okay. If it breaches this, then they will exercise their call option. If it goes below this, they will exercise their put option. Okay, so therefore, if it is going between this, it didn't touch this exercise price also, it didn't touch this exercise price also, that time they will not exercise at all. It is between that itself. So they will be trading in market and you will be making profit by being the option seller. Clear? But if at all it's a volatile market and it falls, then you're gone. Yes, that should be it with that particular situation. Now, let's go further. Arbitrage. Ultimately, the chapters come down to arbitrage only over here. Okay, now, let's not look at the points written over there. In arbitrage, first what I should do? First I should calculate the price. Then I'll compare the price. Then I'll tell whether there is arbitrage or not. So the starting point is always calculation of fair option price. Like how we calculated fair future price, we are going to calculate fair option price. And here, if fair option price is not equal to actual option price, then obviously arbitrage opportunities exist. Clear? Now, can somebody tell me what is option price? Premium. For calculating the share price, we have a different chapter only. So obviously here we are not calculating share price. We are calculating the option price. Option is an instrument which gives the person right to buy or sell. So that instrument ka pricing we have to do. And that is calculating fair option price. Imagine that price is little higher in the market, overvalued. It is lower in the market, undervalued. Clear? Now, fair value of an option. Fair value, fair option price. Fair option premium. Any of these words they can use. Let's not worry about this. But here there are two situations. One is valuation of an option before expiry. Now you only think before expiry, if I am doing the calculation, no, I have lot of work. Because there is still more time period to complete. Intrinsic as well as extrinsic, both will be into consideration. But if I am doing valuation on expiry date, then option premium amount comprises only of intrinsic value. If you are doing before expiry date, you have to calculate intrinsic value. That is very easy because you are just seeing today's spot price and exercise price. Extrinsic value also you have to calculate. Now, if you are calculating before expiry, that is when the problem is in the exam. If you are calculating on expiry, there is no problem at all. On expiry date, today only is the expiry date. No more time period to go further. Market price, exercise price, difference. Clear? So if you are going to calculate option before expiry, we can't do that like logically. So we have to meet people. Multiple people will come into our picture. Put call parity theorem is one method. Binomial method is one more method. Risk neutral method is one more method. Then establishing a perfectly hedged position is one of them. And Black-Scholes method is one more method that we have to see. Few methods only. Actually, there are only three methods. That is put call parity theorem, binomial method and Black-Scholes method. But in binomial method, you have risk neutral method and also establishing a perfectly hedged portfolio. So methods are only 3, but binomial method gives you a couple of varieties over there. Now, that should be it. Now we can start. Value of an option on expiry. Tomorrow we should start solving problems at any cost from derivatives. Okay, few problems only are there. I think study material has some 30 questions or something. Then we have to see RTPs and P by Ps. Yes, computation of fair option price. Now, full focus. From here, full focus you should have. Okay, because it is important. Okay, ICAI can ask option also, they can ask future also. Now, option they can ask only over here. Future they can ask in this chapter as well as some other future chapters as well. Okay, even in Forex, futures comes into picture. IRRM also has little bit of futures and all that. Okay, computation of fair option price. Understand this. Value of an option we have to find. Value of an option means we should find the value of premium. We have to find the value of premium. Clear? When we are finding the value of premium, you can be on 2 dates only. You can be on 2 dates. 2 dates are, one is before expiry you are sitting and trying to calculate, or on expiry you are trying to calculate. If you are calculating before expiry, you have to calculate the intrinsic value as well as extrinsic value. If you are calculating on expiry date, and by the way, what is intrinsic value? Difference between spot price on that day and exercise price. And what is extrinsic value? Time value of money, premium charge. Correct? So, if you are on expiry date, there is no time value of money. So, it's only intrinsic value that you are going to calculate. So, now, value of call option will be maximum of S1 minus E, 0. Value of call option is what? Maximum of S1 minus E, 0. What does it mean? S1 is spot price on maturity date. E is the exercise price. Imagine I have an exercise price of 150. Exercise price is 150 for call option. I have exercise price of 150. Market price is 165. Market price is 165. What is the option now? Best no for you. You can buy and sell at 165. So for you, value of call option will be 15 rupees or 0, whichever is higher. Obviously 15 rupees is higher. So value of call option will be 15. Clear? Now see the value of put option. Maximum of E minus S, 0. Because for put option, you want the price to go down. For call option, you want the price to go up. If the price goes up, you can buy at this predetermined price. If price goes down, you can sell at this predetermined price. So if it's put option, imagine you have the option to sell at 150 and the spot price has reached 130. So maximum of E minus S, 0. That means maximum of 150 minus 130, 0. That means 20 rupees is going to be your value of the put option. Clear? Sir, same circus we can't do here. Same thing. So easy it is. Comparing spot price, exercise price, you got to know the value of the option. Can't we do that over here? We can't, because there is a future period involved. That is why we have methods over there. That is why this formula is actually made by ICAI. Actually, you don't need formula only for this. ICAI is just formalized it, but actually you don't need formula. You're like, okay, I have exercise price 150, market 170. I'll buy at 150, sell at 170, 20 rupees profit. I have exercise price of 150, market has fallen to 120. I will sell it at 150, but I'll buy it in the market at 120. So I'll get a profit over there. That is a logic. But that logic alone cannot apply over here, because you have today's situation also. You have future situation also. Is this clear? Now, let's see some examples. On expiry date, only on expiry. Okay, I have not gone only to that before expiry. Before expiry, when we have to go, we have to learn methods. On expiry date, call option, market price is 120, exercise price is 115. First you tell me, will you exercise? Market price is 120, exercise price is 115. Will you exercise? Will you exercise? Yes or no? Yes. Why? Because you will buy it at 115 and sell at 120. It is a call option. If this was written as put option, would you have exercised that time? No. So call option, what is the value of call option? Maximum of S1 minus E comma 0. Spot is 120, exercise price 115, 5 rupees is the value of call option. 5 rupees is the true value of call option. If the call option is traded at 3, undervalued. Clear? Now, you would have heard, like, if you have any friends who are doing this option trading, no. There are some people who will tell you, I do option trading only on the expiry date. You would have heard that there will be some people who will tell that I do option trading only on expiry date, because expiry date there is huge fluctuation. Because of that huge fluctuation, no, it will not be properly valued. Another reason is, before expiry date, they also don't know to value the option. Are you getting my point? On the expiry date, I can see, oh, exercise price is this, market went to this, I can make a profit immediately. Before expiry date, they also don't know to value the option. That is why they trade only on expiry dates. Because that day the market will be highly volatile. There will be huge volume of buying and selling of options. Now, let's see over here. Option is traded at 3. That means what should you do? If it is undervalued, what should you do? Whether you're in options, futures, stock, anywhere, bonds, anywhere, it is traded undervalued. What should you do? Buy. If it is undervalued, you should always buy. Now see what happens to call option buyer. Call option buyer. He will buy the call option. That means he has to pay the premium. He'll pay 3 rupees premium. If he has bought the call option, that means he has to buy the share now. He will buy the share at 115. He'll exercise and he'll buy the share at, now like, sir, what if he doesn't exercise? If he doesn't exercise, he will not buy the call option only, today. Option buyer, now he saw arbitrage opportunity, so he has to exercise the option. The option of not exercising is not there over here. Are you getting my point? The option of not exercising is not there here because you are talking about arbitrage. Arbitrage can happen only if you exercise the option, then you can have arbitrage. If you don't exercise the option, what is there? You are paying premium, over, outflow, finished, no. Are you getting this? So when you're talking about arbitrage, when you saw that the fair price of the option is not equal to the option price in the market, that time arbitrage opportunity exists. So you have to execute the entire contract to exercise and you should get the money. Clear? Now, let's try to understand this. Call option is traded at 3, so it's undervalued. Undervalued means what? Think of option buyer. Option buyer. What option buyer has to do? Option buyer has to buy. Option buyer has to buy. So if he has to buy, first thing he has to pay is 3 rupees premium. If he pays 3 rupees premium, next what he will do? He will exercise the option. If he exercises the option, he will buy the share at 115. So again 115 is outflow for him. Outflow. After that what he'll do? He'll straight away walk into the market and sell it at 120. He'll sell it at 120. He got 120 rupees. 2 rupees is arbitrage gain. 2 rupees is arbitrage gain. It might not be 2 rupees in the market. It might be like some decimals ka difference will be there. But you play in volume, that time you will make huge amount of profit over there. Clear? Now imagine if you are a call option seller. Now you're like, sir, when this fellow is seeing like this, why is he entering into call option? Why the call option seller is there? People are with different mindset only, in the market. Even though they are seeing something, they're like, no, next moment it will fall. People are with different mindset in the market. Otherwise, there is no market itself. Call option seller. What will he do? Call option seller. Think what will happen. I sold the call option. First, what I'll get? Premium. I got 3 rupees. I got 3 rupees. That fellow will execute. When he's executing, what will happen now? He'll buy the share. So I have to sell the share. When I'm selling the share, I'll get 115 rupees. Now, what will I do with this share? I'll go and sell it in the market. Sorry. I'll buy it in the market. 120 rupees gone. So next 2 rupees loss. Obviously, these two should be opposite to each other. Again, understand this. If you are a call option buyer, first thing for you, you'll pay the premium. When you pay the premium, 3 rupees gone. After that, you'll exercise the option. If you exercise the option, you will pay 115 rupees because that is the exercise price. You'll pay 115 rupees and buy the share. When you buy the share, 115 rupees gone. After that, this purchased share, what you'll do? You'll go to market and sell it off at 120 rupees inflow. So net you're getting 2 rupees profit. If you're talking about call option seller, what he will get? First he'll get the premium. So 3 rupees came in. Then what will happen? When he got the premium, that fellow will exercise. If he's exercising, he's going to buy the share from you. He is going to buy the share from you. That means you have to sell the share to him. If you sell the share, you will get money. And you got 115 rupees. After getting this, what will you do next? You sold the share, but you have to square off. How will you square off? You will buy the share back in market, or basically you will buy at 120 and sell it at 115. Okay, 2 rupees will be your loss. Clear till here? Just have a look. Done. Next, if call option is traded at 8, here it was traded at what? It was traded at 3. Call option was traded at 3. If call option is traded at 8, what does it mean? It is overvalued. Whenever you see the word overvalued in any particular chapter, what you should do? Sell. Now here what you are selling? You are selling what? Share or option? Call option. You are selling option only. Selling of share, buying of share, we are not discussing in this chapter. Okay, you are selling the option. Okay, if you are selling the option, now you are a call option seller. You are a call option seller. What will you get immediately? You will get the premium 88 rupees. Then because you are a call option seller, you are obliged to give the share. When he is asking, you are obliged to give the share. He is coming and buying the share. You have to give the share. When you are giving the share, you will give it at the exercise price of 115. You will give it at the exercise price of 115. So 8 rupees premium you got, and you got 115 rupees cash. Now you will have to buy the share from market at what price? 120 rupees you are going to buy the share from market. So net you are going to make 3 rupees profit. So if you are a call option seller, okay, understand this. If you are a call option seller, 3 rupees comes to you. Sorry, 8 rupees here. 8 rupees comes to you. And that fellow will come and ask for the share. When he is asking for the share, you have to sell the share. When you sell the share, 115 rupees also comes to you. Then what you have to do? To sell the share to him, you have to buy it from market. Market it is at 120. That money goes away from you. So net if you see 123 and 123 rupees, you are going to make arbitrage gain. This is possible only if it is not properly valued. If it is properly valued, how you can make profit? Imagine it was properly valued. Value of the call option, how much we got? 5 rupees. If it was 5 rupees, I got 5 rupees. I will sell it to you at 115 and market is 120. Net will be 0. For the other guy also, he will pay 5 rupees. He will buy it at 115, sell it at 120, net it will be 0. So it is possible, arbitrage is possible only if these two are not equal. Clear? So whenever you see arbitrage, the first situation is to calculate the fair option price. Next. Now call option buyer. What will call option buyer do? Call option buyer will go and buy the option. When buying the option, 8 rupees gone. Then he will exercise the option. When he exercises the option, 115 rupees gone. Then that share which he purchased for 115, he'll sell it in the market at 120. So 3 rupees is his loss. Clear till here? Online, offline, if you have any doubts, then we'll go into put option. And here what we are doing? We are doing the arbitrage situation, or we are checking the arbitrage situation only on the exercise date. We are only calculating on the exercise date. We have not gone into any other previous dates. Next, we go into put option. Put option, market price is 120. What is the market price in put option? 120. Exercise price is 125. Let's calculate the true option price or fair option price. What is the formula? Maximum of E minus S comma 0. Correct? Or basically, if you have option to exercise at 125, you can sell at 125 and market price is 120. You will sell at 125. So 5 rupees is your value of the put option. 5 rupees is the value of your put option. Now, let's try to understand. If put option is traded at 3, 5 rupees is the value. It is traded at 3. What is it called? Undervalued. Whenever it is undervalued, what you should do? Buy. It is undervalued, therefore you will buy the put option. If you are going to buy the put option. Now let's try to illustrate. If you are a buyer of put option, first what you will do? You will pay the premium. How much premium you will pay? 3. Money gone. Next what you will do? You will sell the share. You will sell the share for how much? Exercise price of 125. So you got 125. But to sell the share at 125, you have to buy it from the market at 120. So 120 gone. So 3, 125 and 120. So basically how much profit you are going to make? 2. That 2 is nothing but difference between 5 and 3 only. 2 is nothing but difference between 5 and 3. But you have to illustrate it to ICAI. Okay, now if you are a put option seller, what will you get? What will you get if you are a put option seller? You will get premium. How much premium you will get? 3 rupees. Now what is your obligation if you are a put option seller? You have to sell the share. If you're a put option seller, somebody will sell the share. You have to buy the share. If you have to buy the share, that time what will happen? You will have to buy it at 125, money gone. And this you will sell it in the market at 120. So basically 2 rupees is going to be your loss. Clear? This is the situation. Put option buyer, put option seller. Online guys, are you there? Any doubts? Understood? Okay, next. What if the put option is traded at 8? Put option is traded at 8 rupees. Now what happens? Overvalued or undervalued? Overvalued. Whenever you see overvalued, what will you do? Sell. Overvalued, sell. So now you will become a put option seller. If you are a put option seller, what will you get first thing? You will get 8 rupees premium. If you are a put option seller, you have agreed that you can sell it to me, I will buy it from you. If you are going to buy, you will buy it at the exercise price. What is exercise price? 125. So you will buy it at 125, 125 gone. Correct? Then you are going to do what? You are going to sell it in the, you bought it from this guy, you will sell it in the market. At what price? 120. So you will make 3 rupees profit. You will make 3 rupees profit. What about put option buyer? If there is a put option seller, there has to be a put option buyer. Even though there is loss for that guy, put option buyer will be there. Put option buyer will pay 8 rupees premium. Then he will sell the share at 120. But he'll buy the share in the market at 125. Am I interchanging the numbers? Yes, put option seller will pay the premium. He will sell the share at 125. He'll buy it in the market at 120. So therefore, he will incur 3 rupees loss. He'll incur 3 rupees loss. This is the situation with put option when it is overvalued. Yes, welcome back. Let's continue. Now, all this value of call option on expiry, formulas, all this we have seen. We have discussed that. Arbitrage prospects on maturity date, call option undervalued, then buy it. Action on stock also, buy it. Call option overvalued, sell it. Option on stock, what will you do? Sell it. Obviously, you'll buy and sell it only. Okay, then option type, put option, status undervalued, buy it, buy the option. Okay, sell the stock. Put option undervalued, sell it, and stock obviously will buy and sell ultimately. So that table is not required. You will see logically you'll be able to tell. Next thing that we have to understand is payoff graphs. Payoff graph. Okay, we'll get to this table after we see the payoff graph. Then we have to go into before maturity date. Till now we are discussing only the maturity date situation. Now, simple point it is payoff graph. Let's say on expiry date. When we are talking about payoff graph, it's always on expiry date only, because before expiry date, there can be multiple fluctuations that can happen on expiry date. If you are a call option buyer, think from whose angle now? only from call option buyer's angle. Bangalore is getting hot. You should not have this. Huh? You're sitting there, no? What? Here we are suffering with heat, you are suffering with cold. What is this? Okay, so payoff graph on expiry date. Whose angle are you going to think of? Call option buyer. Imagine exercise price is 50. Exercise price is 50. Premium is 5 rupees. You can have multiple different situations on the expiry date. There can be different spot prices. Correct? Now, let's try to understand every single one of them. Imagine market price on expiry date is 0. That is just for theoretical purpose. It can never be 0. Market price is 0. Expiry price is what? 50. So now if I'm talking about gross payoff. Gross payoff means what benefit did you get? You see, gross payoff is 0 for you. Why 0? You will buy at 50 and you will sell at 0. Okay. So gross payoff is 0. You will start getting payoff or you will start getting benefit only when the price goes more than the exercise price. Are you getting it? You are a person who has told that I will buy at 50. So now gross payoff is, see, the formula is that only maximum of S minus E, comma 0. Maximum of S is 0, 0 minus 50, comma 0. Will you exercise over here? Will you exercise? You will not exercise only. So your gross payoff is 0, but premium is 5. So your net payoff is minus 5. So from your pocket, what happened? Minus 5 went. Now imagine if it is 10 rupees. Still it is 0, but premium went minus 5. Till it is 20, 30, 40, 50. Till it reaches 50, your situation will be like this only. Now imagine it becomes 60. If it becomes 60, that time what is the formula? Maximum of S minus E, comma 0. That time it becomes maximum of 60 minus 50, comma 0. That means 10 rupees. What is your payoff? 10 rupees. Premium is how much? 5 rupees. So net payoff is how much? 5 rupees. Clear? 5 rupees benefit you got. And moment it starts increasing from there, 70, 80, 90, 100, then you will start getting net payoff. Net payoff means what? Net benefit. Gross payoff means what? Gross benefit. Gross benefit means we are seeing only the difference between market price and the exercise price. When you add the premium, when you take the premium component, you get the net benefit over there. So you are getting 45. So with this, what did you understand? With this, what is your conclusion? From this table, I want you to tell the conclusion. What is the conclusion from this table? Obviously, ICAI is not going to ask this, no. What is the conclusion?
On the expiry day, if price fluctuation also premium amount is same.
Premium amount is always same. It will be 5 only. From this, the conclusion is for a call option, yeah. Yes, that is the conclusion. The conclusion is your loss is always limited to 5 rupees and your profit is unlimited. Profit is unlimited. This can become 5,000 also. Correct? Profit is unlimited. So see this graph. Okay, it should not have been like diagonal like this. It should have been a straight line, but just for your understanding. So can you see for a call option buyer, maximum profit is unlimited and maximum loss is limited. So if I have to conclude for a call option buyer, maximum loss is limited to the premium amount on the option. Clear? Is this clear till here? That is what the payoff table tells us. Now ICAI, what they do, they'll give you expected market price on the exercise date. 1, 1, 2, 3, 4, 5, 6, some 7, 8 they'll give you and they'll tell prepare payoff table. Prepare payoff table. This graph is not required. They'll tell you to prepare the payoff table. That is net payoff, gross payoff, everything you have to write. Yes. Is this clear till here? Now, let's go into the next situation. Imagine you are a call option seller. Call option seller. So, payoff table. 0 is the market price. Expiry rate or exercise rate is how much? 50. Now tell me one thing. Will somebody come and exercise their option with you? Market rate is 0. Will they come and exercise? They will not exercise. gross payoff is 0. 5 rupees premium you'll get. You'll put it into your pocket and be happy about it. Till it touches 50, okay, the situation is same. Till it touches 50, what will happen? Nobody will come and exercise the option because market price is the same thing or lesser thing, so they will not exercise the option. But after it crosses 50, at 60, what will happen? They'll come and exercise the option. If they come and exercise the option, that time you are getting minus 10 loss over here because they'll come and exercise the option and buy it from you at 50 rupees. You can buy it from you at 50 rupees. Now you'll have to, buy it from you, you have to give it to them at 50. So you'll have to buy at 60 and give it to them at 50 rupees. So if you want formula for this also you can put a formula. You know what is the formula for this fellow? The payoff is, okay, only if you want to formalize it, payoff is minimum of E minus S, comma 0. If you want to formalize it, otherwise logically you can think minimum of E minus S. Now see over here, what is E? 50. Okay, 50 minus S 0 or 0 minimum. No, which is minimum? 0. So all these places you saw 0, 0, 0, 0, 0. Are you getting this? So here what happened? Minimum of E minus S. What is E over here? 50. 50 minus, what is the spot price? 60. 60, 0. There is no formula by ICAI. Okay, I'm just telling you, if you want to formalize it, you can formalize that also. So what is the minimum amount over here? Minus 10. Clear? Minus 10. Because there when you told for the call option buyer, the profit is unlimited. For this guy, the loss also should be unlimited only, no? So now, if the price is 60, in the market, somebody will come and exercise their call option and tell, give me the share at 50. So you have to buy at 60 and give it to them at 50. So therefore, you will have a 10 rupees loss. Premium is your gain. So minus 5 is your net payoff. Clear? As the price goes higher, your loss increases, but premium will be a standard income for you. So your loss keeps increasing. So the moral of the story here, the maximum profit a call option seller can make is the premium amount. And maximum loss a call option seller can make is unlimited. Maximum loss is what? Unlimited. So see this graph. Maximum profit is this only. But maximum loss can go to any level. It can go to any level. 15 minutes over. Yeah. You are watching the video on 2x. Yes, let's go further now. Put option buyer. Who are you now? Put option buyer. Payoff table. Let's revise that formula. What is the formula? Maximum of E minus S, 0. What is the derivation of this formula or logic of this formula? If excise price is higher, okay, and spot price is lower, you will sell at this price and make profit. If excise price is lower and spot price is higher, you will not exercise only. Clear? So now if it is 0, market price is 0. If market price is 0 and excise price is 50, what will you do? Quietly you'll go and sell it at 50 rupees and be very happy. Full 50 rupees is profit for you because you have to buy in the market at 0. Just illustration. Buy in the market at 0 and sell it at 50 rupees. So you got 50 rupees, but you have to pay premium. So net payoff will be 45. And as the price increases, okay, till it reaches your exercise price. You are always going to make profit. Imagine your exercise price and spot price is same. That time you don't have any profit because you are going to sell it at 50, buy it at 50, for you no profit. And premium is an outflow, you will start making losses. Then as the market price goes higher and higher, then what will happen? You will not exercise your option only. Why will you exercise? You have to sell at 50 here. You can sell in the market only. So it will go higher and higher. You will stop making profit over here. So the formula is again maximum of E minus S, 0. And here moral of the story is the maximum loss a put option buyer can incur is the premium amount. For option buyer, the maximum loss is always the premium amount only. So maximum loss for the put option buyer is premium amount. maximum profit. Maximum profit is not unlimited. Can you see exercise price minus market price? So maximum profit is exercise price. Maximum profit is exercise price. In call option, you told no, maximum profit is unlimited. Why? Because you can buy it at 50. It can go in the market to 1 lakh also. Correct? Maximum profit is unlimited for you. But for put option, you can sell it at 50. It can go to 0. So maximum profit you can make is your exercise price. Is this clear? So see this. Maximum profit is capped. Maximum profit is capped for a put option buyer. Clear? But maximum loss is always only the premium amount. Clear? Whenever you have option to exercise or not exercise, no, your loss will be capped. But here, why the profit is also capped? Because the price can fall only to 0. No, price cannot go below 0. Why there the profit is not capped in call option? Because price can go to any level. Next, put option seller. Tell me one thing. Put option seller, if you want to write the formula for this, it will become minimum of S minus E, comma 0. Minimum of S minus E, comma 0. That means put option seller means you have to buy the share. They are going to sell it, you have to buy the share. Imagine market price is 0. What they will do? They will come and sell it to you at 50. So you will buy at 50, 50 rupees gone for you. Premium you will get, so net payoff will be 45. As the price goes higher and higher, till it is 40, till it is lower than the exercise price, they will come and sell it to you. They will exercise the option. That time you will incur 10 rupees loss and you will have 5 rupees premium. Net payoff will be minus 5. Moment the exercise price and the spot price are matching. If they are matching, if they exercise or don't exercise, doesn't make any difference to you. But what will you get? 5 rupees premium is pakka profit for you. After that, as the price goes higher, they will not exercise the option because they can exercise it in the market only. They can sell it in the market only. Therefore, the premium will be profit for you. So the moral of this story will be for the put option seller, maximum profit is what? Premium amount. Maximum profit is what? Premium amount. Maximum loss is what? Exercise price. Clear? See, maximum loss is capped. Maximum profit is always the premium amount. Is this clear till here? Yes. Now we'll go and read what is there in that material. Net payoff of an option buyer, gross payoff minus premium paid. Gross payoff is price difference between exchange between option buyer and seller on due date. We know the formula already. ICAI has given. Net payoff is gross payoff adjusted with premium amount. So this amount, this thing we already know. Now, for a call option, just try to understand this table. Call option, maximum loss is limited to premium paid. Maximum gain is unlimited. We saw it in the graph. For a seller of the call option, maximum loss is unlimited. It has to be opposite to each other. And maximum gain is limited to the amount of premium received. Now, if it is a put option, maximum loss for the put option buyer is limited to the premium amount. Maximum loss is only premium amount. Maximum gain is limited to exercise price minus premium paid. Exercise price will be your maximum gain, but 5 rupees premium and net amount will be your maximum gain. For seller, maximum loss will be, what is profit for this guy will be loss for this guy. Seller, what will be the maximum loss? Maximum loss is what? Exercise price. From exercise price, remove the premium. That time you will get the complete loss. Limited up to the amount of premium received. Maximum gain. Is it clear? Now, done. What did we finish? What did we finish? What were we doing? Valuing the call option and put option on the expiry date. On the expiry date. Now we have to value the call option and put option before the expiry date. That time there will be intrinsic value also, extrinsic value also. For that we don't know any logic method. We have to follow methods which are prescribed by 3 people. First we will go into put call parity theorem. First one is arbitrage prospect before maturity date. First one we are going to see is put call parity theorem. Now let's try to understand what it means. Okay, first thing, put call parity theorem. Don't see that formula. Let's try to understand. The person whoever thought of this put call parity theorem, they always told parity. Parity means what? There is a connection. They said that usually call option and put option have parity between each other. Parity means what? If premium of call option goes up, then premium of put option will go down. Didn't understand. Premium of call option goes up, premium of put option will go down. For example, if I tell you there is a share today at 1500 is the exercise price. 1500 is what? Exercise price. So now, if at all the share price goes to 1000 call option, for call option it goes to 1600. 1600. That time there will be more demand for this call option over here. So the premium will go up, but there will be less demand for the put option over here. So premium will go down. Are you getting this? Understanding this is very important. I mean, you can literally buy out this formula, but ICAI can play anywhere. So don't go into by-hearting formulas because there are so many formulas. Later in the exam, you should not get confused with the by-hearted formula. If you know the logic, you will get to know it. So understand this. If I tell you that a share is at 1500 and exercise price of 1500, I have purchased one option. What is the exercise price? 1500. Now imagine this exercise price is 1500 and the market price has gone to 1600. If the market price is sitting at 1600 and I am a call option person, there will be more demand for this call option of 1500. There will be more people wanting to buy at 1500. So the premium will shoot up. It will go up. But at the same time, if the market price reaches 1600 for this put option, there will be less demand because they can sell it in the market at 1600. So the put option premium which is there, that will go down. This is the parity that they are discussing. This is the parity on which they relied on. This is the parity on which they relied on and made this model. Clear? So now come to this formula. They are telling value of spot. S is spot. Value of spot plus value of put will always be equal to value of call plus present value of exercise price. What does it mean? What does the put call parity theorem tell us? They are telling that today's spot price, whatever the spot price is there, plus the premium that you are going to pay on put option should be equal to the premium that you are going to pay on call option plus present value of exercise price, because you are calculating everything today, no? So bring that exercise price to today and present value of exercise price. So if you see the logic here, this is present value of today. This is present value. So stock ka present value is matched. Then the premium of put and premium of call will match each other. That is the theorem that they have tried to form. So now what we have to understand, there is one nuance in this formula. The nuance is what? I should know at least one of these. This will be known, today's spot price. This will be known because you are entering into a contract. But value of put or value of call should be known. So if you don't know both, then this method will not work only. Are you getting my point? Then it will be like we had relative, we had the relative valuation and all. No, like that it will be like if I don't know both, I have to calculate one of them using some other method and come to this one. Are you getting this? So therefore, if it is put call parity theorem, they are only talking about put and call. And in this, they will either give you the value of put and then tell you to calculate the value of call, or they'll tell you the value of call and tell you to calculate the value of put. Is this clear? So the drawback in this is one of this should be known. Now we're like, sir, for this one, can I take the market price of put? No. Then it doesn't serve the purpose now. You can't take market price of any of these options. You have to find the fair price of the option. So fair price of one of them should be given and you can find the other one. Is this clear till here? Now, let's take an example. If I tell value of the stock on 1/1/2023 is 100 rupees and value of 3 months put, value, not market price, value of 3 months put is 8 rupees. That means correct value of 3 months put is 8 rupees. Exercise price is 80. Exercise price is 80. What is the value of call? Discounting rate is 15%. When they just tell 15% for fun like that, what we take it as? Normal compounding. Normal compounding means compounded annually. Correct? So now value of stock today is 100 rupees. Clear? Value of stock is 100 rupees plus value of put is given. 100 plus 8 is equal to value of call, I don't know, plus what I should find out? I should find the exercise price ka present value. What is the exercise price? 80. How to find the present value? 80 divided by 1 plus, what is the rate? 15% into how many months ka call we are trying to find out? 3 months. 3 divided by 12. So 0.15 into 3 divided by 12 plus 1, 80 divided by MRC minus 108. How much are you getting? Are you getting 30.89? 30.89 is the value of the call option as per put call parity theory. 30.89. Clear? Now see, when there are so many people giving methods to value, right? Okay, that is why market runs. So many people are there with different valuation techniques, right? So one person will do valuation as per one technique and he will see the market price. He'll find it overvalued. Other person will do it under other technique. He'll find it undervalued. These both will trade. These both will trade. If there is only one methodology, then there would be no market. Everybody follows that method. Everybody wants to buy. Nobody wants to sell. Okay. So whenever you see, there is arbitrage and you think that, oh, arbitrage opportunity is there. That means I can make profit. That means somebody else is thinking on the opposite lines. That is why you can make profit. He is thinking he can make profit. Clear? So is this clear till here now? 30.89. Now, if discounting rate is 15% compounded semi-annually, what will you do? You know this already, but I just still gave it as example. So here it will be 0.15 divided by 2 because it is semi-annual. But we want for how many months? 3 out of the 6 months. One period is 6 months. So you can take it as half period or you can take it as 3 by 6. From there, you know the calculation, you will get 30.84. Very close enough. Why very close enough? I have explained this before. I want you to tell now. Why very close it is? It's almost equal. Yes. 6 months haven't come yet. The opportunity to compound hasn't happened. So here also it is not compounded yet. Here also it is not compounded yet. This will get compounded at the end of 1 year and we are calculating for 3 months. This will get compounded at the end of 6 months and we are calculating for 3 months. So still the compounding has not happened. That's why the answer is almost equal. If you take full decimals, you might get the same amount also. Almost decimal to decimal, you might get same amount. Clear? Value of call option is 30.84. I mean, that's just for your understanding. Okay. If discounting rate is 15% continuously compounded, I'm not going into the calculation part of it. We already know it. When we solve problems, we'll be doing it again and again anyways. So if it is continuously compounded, what I'll do? E to the power of 0.15 into 3 divided by 12. Correct? That will give me 0.0375. Now you know, you take for 0.03 and that 75 difference you do interpolation and you get the answer. So here you are getting 30.95. 30.95. This will be higher, no? Because it is continuously compounded. So it will be higher, 30.95. Clear? Now valuation, we are not going into that. We have spent enough time in futures. How to find this rates and all those things. Now the thing is, if this is 30.95, if option is traded at 32, if the call option is traded at, what did we find? We found the value of the call option. If the call option is traded at 32, what is it? It is overvalued. If it is overvalued, what I should do? If it is overvalued, what should I do? Sell. If it is overvalued, what I should do? Sell. So therefore, overvalued, sell call option. Sell call option. Call option is traded at 28. That means what? Undervalued. If it is undervalued, what will you do? Buy call option. Is this clear? Okay, this overvalued, undervalued can come in multiple chapters. You should know what to do. Okay, if the call option is available at 32, overvalued, no. Sell the call option, no. Now, see how to make arbitrage gain. Now, simple, okay. Actually, it's a complicated methodology that is created. Call option is traded at 32, no. Okay, and what was the price we saw last? 30.95. 32 minus 30.95, 1.05 profit. That is as simple as that, 1.05 profit. But whenever we talk about arbitrage, we have to illustrate. We have to illustrate how we are going to get it. Now tell me one thing. You are buying the call option, correct? Sorry. For this I didn't frame the example. I framed for this one. You are selling the call option. So if you're selling the call option, see over here, call option will be sold. Present value of exercise price also will be sold, sell. That means these two have to be buy. That means what? If you're selling call option, okay, if you're selling a call option, spot you will buy, put option you will buy, and this you will sell, and this you will sell. Clear? So therefore, 100 rupees is outflow because you bought the stock today. 8 rupees is outflow because you bought the put option today. Opposite actions. Okay, and then you are selling the call option, so you got 32 rupees inflow, and present value of exercise price. Present value of exercise price, whatever exercise price is there, 77.05 is your inflow. Okay, so you'll get 1.05. Now tell me one thing, how did this become inflow? How this 77.05 became inflow? Because you're buying put option over here. If you're buying put option over here, you have the option to sell. You're buying call option over here. Sorry, you're selling call option over here. If you sell call option, that means you are forced to, sell. Are you getting my point? You're forced to sell. See, call option seller is giving somebody else opportunity to buy. So therefore, we have to sell. Put option buyer is taking the opportunity to sell. So therefore, anyways, he has to sell. Is this clear? So if you think of logic, that is a logic. But otherwise, if you think from examination point of view, you got the answer over here. No, you have to sell call option. Where is call option sitting? This side. Clear? For both of this, consider it as sell, and both of this will be buy. And both of this will be inflow, and both of this will be outflow. When you do that, you're getting 1.05. And for you in the exam, once you illustrate this, please go and check what was the difference. If it is 1.05, it is 1.05 here also. But you have to illustrate the plan of action. That is why it is sitting like this. Is this clear? Are you following this? That is it with put call parity theorem. But it has huge nuance. You know what is the nuance? First thing is, put call parity theorem is taking one exercise price over here. Present value of exercise price. Which one exercise price this is? Call options exercise price or put options exercise price? Is it telling me the call options exercise price or put options exercise price? They can have different exercise price, no? One of the features of put call parity theorem is they are assuming that exercise price for both are same. Exercise price for both are same. Okay, sir, exercise price is same. Now, but when I calculate present value, imagine call option is for 2 months, sir. Put option is for 3 months. How can I calculate present value that time? Second assumption of put call parity theorem is both are for the same period. Are you getting this? Obviously, you can see the drawback there. That is why more methods came into picture. Now, let's go into the material. Value of stock plus value of put is equal to value of call plus value of present value of exercise price. All these things we have discussed. Okay, assumptions before applying put call parity. Both call option and put option must have same exercise price. Both call option and put option must have same maturity period. Clear till here? This is the end of put call parity theorem. So you just have to remember the formula. What is the formula? Value of spot plus value of put is equal to value of call plus present value of exercise price. Then you have to understand one of them you will have to calculate. One of them means it can be calculation of put or calculation of call. If you find calculation of put, whatever the value you get. Now present, if at all the existing market price is higher, that means it's overvalued. If it's overvalued, what will you do? You will sell the put. When you are selling the put, that stock also you will sell in the side. Side by side, that will be sold. The other two will be there buy. That means these two will be inflow, those two will be outflow. If you are selling the call option, then present value also will be, inflow. This side both you have to buy. That time it will be outflow. Is this clear? This is how you are going to demonstrate for the examination purpose. But otherwise, if you want to know what is your arbitrage gain, just check what was the fair value you calculated, check what is the market price, the difference is your arbitrage gain. But just writing the difference, you will not get the marks. You will have to illustrate it. Clear? Now, next method is binomial method. In that we have risk neutral method. Arbitrage prospects before maturity date, binomial method are also called as risk neutral method. Now, You know what is the logic behind binomial method? They are telling on exercise date, no, or on any date, it is possible that only two share prices can be possible on a date. Saw the drawback, one more drawback there. That fellow did a method, put call parity theorem, with an assumption that exercise price for call option and put option will be same, and time period for call option and put option will be same. Now, binomial method, what is the assumption? You know, it assumes that on any given date for a share, there can be only two opportunities. It can be having only two prices, either it is upwards or it is downwards. Upwards there can be multiple, that they have not considered. Downwards there can be multiple situations that they have not considered. So this is a two period binomial model, okay, or two side effects binomial model. So now if it's a call option, try to understand this. Okay, try to understand this. What is happening is stock is sitting at 200. Stock is sitting at 200. The stock can increase by 20% or it can decrease by 5%. Either this will be given in the question or we have to calculate that increase or decrease. So either they'll tell you stock can increase by 20% or decrease by 5%. That time you got your 240 and 190 values. Or they can tell the stock can be at 240 or stock can be at 190. That time you got your increase percentage and decrease percentage. Is this clear? So now exercise price is how much? 195. Exercise price is sitting at 195. So now first what we will do is compute the probabilities. This is going to 20%. No, this is going to 5%. So we need to know what is the probability of this increasing, probability of this decreasing. Clear? So now what we will do, understand this. 3 months call option, RF is 15%. RF is 15%. So 0.15 into 3 divided by 12 gives you 0.0375. This interest rate, whatever interest rate is there over here, this should be equivalent to the gain or loss. Are you getting my point? So 0.3, see, remember once upon a time we learned, no, spot plus interest. Spot plus interest. So from when it went from here to here and it went from here to here, whatever happens, the net situation, the benefit should be the interest only. The benefit is only interest. There is no storage cost, there is no yield, nothing over here. So from spot, if it is going upwards or downwards, the benefit should be only yield. Okay, so now compute the probabilities. How will you compute? 0.0375 is the interest. Okay, is equal to increase percentage is how much? 20. So 0.2p. P is the probability of increase. And decrease percentage is how much? 5%. So minus 0.05 into 1 minus p. Into 1 minus p. When you do that, when you simplify this, can you see p is equal to 0.35? P is equal to 0.35 means what? Probability of rise in price. That means 65% is the probability of fall in price. Now you're like, sir, why did we calculate this? You know why we calculated? Because I have two situations over here. If I had one situation, no, I could calculate the difference between this and tell 40 rupees is my payoff. And I could calculate this and tell, I could tell that 45 rupees is my payoff. And here I could tell I will not exercise the option itself. Correct? I have two situations. Because I have two situations, I have to calculate probability. Then probability, when I apply, no, I'll get E of X. Are you getting my point? So now, did you understand how to calculate this, computing the probabilities? First, you will take the interest rate, 0.0375. Why did I take 0.0375? 15% is the rate, 100% true. But it's 15% for the entire year. We want to calculate the call option price for only 3 months. So 3 months you take the interest rate. What is the probability of percentage of increase? 0.2. 0.2 into P. What is the percentage of decrease? 5%. 0.05 into 1 minus P. That time you got P as 35%. That means probability of increase is 35%. And you got 1 minus P as 65%. That means probability of decrease is 65%. Clear? Now what we'll calculate? We'll calculate the expected payoff. If the stock is 240, my payoff is how much? 45. Now like, sir, wait 1 second. What about that premium? Like, sir, for 240 and 190, no. Sorry, 195 was the exercise price, no. So you just wrote 240 minus 195. 45 rupees is payoff. What about the premium? That is what we are calculating. That is what we are trying to calculate. So there is no premium. We are trying to find the true premium. It might be 8 rupees premium in the market. Ignore. In the question, they might tell that the call option is actually traded at 8 rupees. Let it be at 8. You calculate. You got 4 overvalued. That is what we are trying to do. Clear? So 240 and payoff is 45. But what is the chance of getting 45? The chance of getting 45 is only 35%. So you are getting 15.75. What is if the stock is 190, what is the payoff? 0. Why? Maximum of S minus E, comma 0. If it is 190, I have exercise price of, exercise price is 195. I'll buy in the market only at 190. I'm not mad to buy it at 190, 195. So therefore payoff will be 0. Therefore here anyways, you don't have to calculate 0 into 65%. If you want, you can try in the calculator. You'll get 0. Okay. After that, what is my net payoff now? 15.75. What is my net payoff? 15.75. This expected payoff 15.75 will happen. It is sitting in the future because I calculated on this date what will happen, on this date what will happen. So I have to bring this to today's value. So the last step is value of call option, discount it. That means find the present value 15.18. Is this clear till here? Are you following this? You have to spend 2 hours today at home and revise everything, because tomorrow when we solve problems, we can't keep coming back to the sheet. You have to spend 2 hours, assuming that already futures you have revised. Okay, otherwise you have to start from there. Futures, options, swaps, where we wrote no first today. From there. Is this clear till here? So now, let's just go and check the theoretical part of it. See, step 1, calculate probabilities. Probabilities e to the power of RT minus 1 or RF is equal to percentage upside on stock into probability of rise plus percentage downside of stock into 1 minus probability of rise. Okay, so you don't have to buy out this formula. Just one thing only I want to illustrate over here. For RF, they just wrote RF. But for e to the power of RT, they wrote e to the power of RT minus 1. If RF is given 15%, you will directly write 0.15. But e to the power of RT, why they wrote e to the power of RT minus 1? Because in that 1 is already added. E value will be given 1.0202. We don't want this 1. We want only the interest rate. So you will take 0.0202. Is this clear? That is one thing you have to remember. Exam tip that we will see later after we see even put option ka situation. One more example we will take. Current spot price is 500. Exercise price of 4 months call option is 480. Exercise price of which one? 4 months call option is 480. Now if it is 4 months call option, if it is 480, now RF is given 12% CC. What is CC? Continuously compounded. So therefore e to the power of 0.12 into 4 divided by 12. That means e to the power of 0.04. For e to the power of 0.04, I think the rate is 1.0481. 1.04081. This is the rate that we require. Clear? So therefore, first what we will calculate. Can you see the difference between this question and previous question? In the previous question, they only had told you what was the percentage of increase. They only had told you what is the percentage of decrease. They told expected spot price on exercise date 550 or 425. Expected spot price. So now we have to calculate what is the percentage of increase and what is the percentage of decrease. So right now what is the spot price? 500. 500 minus 550 divided by 500. That means 10% is the chance of increase. And 425 minus 500 divided by 500. 15% is the chance of decrease. Once you get this, then what you are supposed to do? Calculate the probabilities. Now, you know, some questions will be there. They will give the probability also. You are going to ignore that. You know, there will be some questions. They will be telling you probability of this happening and probability of that happening is given. That is the probability as per market. Not the true value. That is the market fluctuation which they are expecting. True value, we only have to calculate the probability. Clear? Now, tell me what the equation should look like without even looking here. 1.04081 is equal to, what is the chance of increase? Chance of increase is 10%. So 0.1p plus, what is the chance of decrease? 15%. So minus 0.15 into 1 minus p. Do you agree with this equation? Clear? So now you can see it over here. This is the equation. And when you solve for that, you got p as 76.32% and 1 minus p as 23.68%. Clear? So now what will you do? if at all the price is 550, if at all the price is 550 and exercise price is how much? 480. Will you exercise your option? Price is 550. Your option, call option is at 480 exercise. Will you exercise the option? So 550 minus 480, that means 70 rupees is your benefit. But the chance of that happening is only 76.32%. If it is 425, will you exercise the option? 425, will you go and buy at 480? That time you will not exercise. So therefore zero payoff over there. So your payoff table, you can see 70 into 76.32, you got 53.42. All this calculation happened on the exercise date. We are not in the exercise date, we are today. So what will you do? You will calculate present value of that, you will get 51.32. Now in the market, if they tell you that it is overvalued, undervalued, you will apply it. Clear? Is this clear till here? Yes. That was your binomial method. Now we'll just have a look at this quickly. In step 1, we calculate fair probabilities here. Hence in the exam, if RF is given, probability is not given, apply step 1 to calculate fair probabilities. Okay. What is that? What is this fair probability? They might give probability in the question. That is the probability of market. We are trying to find the fair option price. So fair probability we have to calculate at any point. If they have given RF and they have not given probability, you will fit the RF and you will do into P and 1 minus P and you will get the probabilities. Imagine they have not given RF, they have given the probability, fair probability they have given. Apply step 1 to calculate RF. Are you getting it? If they give you RF, don't give you fair probability, then you will apply step 1 and find the fair probabilities. If they give you fair probabilities, don't give you RF. You're like, sir, why do we want RF? Later to find the present value, we need RF. No. If they don't give you that, then you will apply still step 1 and you'll find that as the balancing figure. Clear? If both are given, ignore given probability and apply step 1 to calculate fair probability for option valuation. Are you getting this? This is assumptions that you have to take in the exam. If I have this and I don't have this, then no problem, no confusion only. I'll apply the formula, get the probabilities. But if I have this one and it is not, this one is not there, then you are forced to assume that this is the fair probability which is given in the question. If both are given, ignore the probability and apply step 1 and find the fair probabilities. Is this clear? Okay, once you have to refer this table whenever you learn this method, because ICAI will play with this only in the exam. One question they'll give you RF, they'll not give you probability. They'll make it simple. That question will be the most easy question. Why? Because you will go in stepwise and you will solve it. One more question, they'll not give you RF, they'll give you probabilities. Now you will get confusion in the exam. Oh, this probability is market probability or fair probability? Because you have no other option. You are assuming this is fair probability only. Now one more question, both are given. Now you'll be like, both are given. Why to do step 1? Directly we'll go to step 2, expected payoff table. No, that probability you are going to ignore and you're going to calculate as per step 1. Is this clear? Yes. Step 2, expected payoff on maturity date. Okay, all this formula and all not required. See, value of call option upwards into probability, value of call option downwards into 1 minus probability. That we already saw. Value of call option downwards will always be 0 only. Okay, step 3, present value of call option. Take the present value of that, you'll get the answer. 2 assumptions in risk neutral method. An investor is neutral between RF investment and investment in stock market as far as risk is concerned. So we are taking RF over here. That means we are telling that from stock market also I am expecting RF only. Are you getting my point? That is one of the assumptions that they have done. Because if it is RF, then why I am going into stock market? So one of the assumptions that they have taken in this method is investor is neutral between RF investment and stock market. That means he is fine with RF also. Basically they're trying to tell at least RF this should derive. Clear? 2. A stock might assume only 2 possibility prices on maturity date. This is the second option, that is on maturity date there can be only 2. Now, because it has so many problems, we go into multiple period situations. Here what we saw, one period from here to there either increase or decrease, correct? Follow decision tree for multiple period situations. What will you follow? Decision tree for multiple period situations. For this, obviously there is no theory. Refer classroom discussion only. Now we will discuss that. Okay. How to establish a perfect hedged situation and all, we'll see later. We'll not go to that. I mean, we might not even reach there today. Now, before I go to decision tree, I want to complete one thing. For this entire process, what we followed, no? First, finding the probability. Then, based on the probability, calculating expected payoff. Then, that expected payoff, bringing it to today. For that, there is actually one formula also under binomial method. There is one formula. If you want to do it under formula, you have to, if they tell binomial method like this, you have to do like this only. If they tell risk neutralization method, see, I told you that time, no, we are actually having only 3 methods. What are the 3 methods? The 3 methods are put call parity, binomial, and Black-Scholes. If they only tell binomial and they tell risk, if they tell risk neutral method, no, you will calculate probability and you will go step 2, step 3, you will get the answer. If they tell binomial method, then you will apply the formula. Now, applying the formula, understand this formula. Value of call option. VCU is what? Value of call option when the price goes upwards. VCD is what? Value of call option, value of the option when price goes downwards. Clear? Then this into I minus D divided by U minus D into U minus I divided by U minus D. What on all formulas they are following. Now I is what I is 1 plus RF. I is 1 plus RF. If you understand this formula, actually it's going to take you lesser time than that 3-step methodology. Okay, I is 1 plus RF. U is, what is U? S1D divided by S0. What is S1D? Wait 1 second. Did I write S1D for both? Sorry, it should have been S1U divided by S0. That means what is the spot price when it goes upwards divided by S0. When it goes upwards, it is 550 divided by 500. When it goes downwards, it is 425 divided by 500. You got some 2 numbers, U and D you got. Upwards chances and downwards chances. And VCU, what is VCU? Value of call option when it goes upwards, that you already calculated. You told that time 550 minus 480. So you told 70 rupees is the payoff. And value of call option downwards will be 0 only because you are not going to exercise it. Okay, that's it. Now how to remember this, I'll tell you. S1 is the spot price on the maturity date when it go, if it is upwards. S1 is the spot price on the maturity date if it goes downwards. On maturity date, we have 2 spot prices, no, upwards and downwards. S0 is always spot price of today. Okay, now the formula, and obviously the entire thing you have to divide by I because you have to find the present value. Now understand this formula. Value of call upwards, value of call downwards. Both what you were doing in that expected payoff table, you are adding. Now how to remember this, I'll tell you. Imagine at home, okay, you are staying in PG, or you are staying with some siblings, or you are staying with your husband or wife. Okay, situation at home. Okay, people who are staying in PG, I have to address all the situations. People who are staying in PG, 2-3 people are there in the room. People who are staying at home, okay, unmarried, there are siblings at home. People who are married, there are your husband and wife at home. How do you know this, man? Actually, this I had told in the previous class. How do you know this? Before I started only, how did you get to know it? Crazy. I saw that video, sir. Okay. Now, there is, actually, we created in the class last time. Because there was no other methodology. I didn't think of any methodology to remember this, but then in class it just happened. So when all these situations are there, no, you will have a fight. There will be some chores you have to do. Okay, there will be fight. Like you will be like, I do it or you do it. Okay, but if you interrupt, then you only do it. Crazy, right? Now, either I do it or you do it. But when I am doing it, if you interrupt, then you leave and go, then you only do it. Clear? That is how you are going to remember this. I minus D divided by U minus D, and there it is U minus I divided by U minus D. Now the formula got simplified, but problem is what, with this formula, one of my student went and applied this in the exam. Full I do it, you do it, everything she did properly, forgot to divide this by I. Bring it to present value. Everything is in future. This thing has to be done. Okay, for this I don't have any technique. This divided by I you have to know, because we are calculating everything today. We are calculating before maturity date. This entire technique system is before maturity date. So you have to calculate the present value. Clear? Now tell me the formula. Value of call upwards into I minus D divided by U minus D plus value of call downwards into U minus I divided by U minus D. The whole thing divided by I. Clear? There is no other way, man. We have to see, sometimes we have to go into foundation mode to remember some formulas of CA Final. Okay, so this is the formula, and actually it is, if you remember this formula, no, it's actually easier. Now, let's see if I'm sitting over here. Okay, what was the first example that I took? This was the first example, no? Yeah, with the increase percentage, we had a example. So tell me one thing, if I have to draft this formula over here, what is the value of the call? Value of the call, okay, not the share price, value of the call upwards. What is the value of the call upwards? 240 minus 195, that means 45 rupees. 45 rupees, clear? Into, now what we should do? I minus D. What is I? The rate of interest. Rate of interest I already know, it is 0.0375. 15%, no, it was 0.0375 minus D. What is D? Downside situation. Downside situation is basically 190 divided by 200. 190 divided by 200 is 0.95. 0.95 divided by what? U minus D. What is U? Upward situation, 240 divided by 200. That is 1.2. 1.2 minus 0.95. Are you getting this? If I have to revise again, see over here. The D is what? SID 425 divided by 500. Here it was 550 divided by 500. Clear? Upwards, downwards. Next. Plus what? Plus. Downwards, it's going to be 0 only. Value of call downwards is going to be 0. So you don't have to put that also. Put the effort of putting it. But in the exam, when you write the formula, first time you write the formula. Next, you can just write 0 because it's not going to be anything there. Divided by, okay, divided by, what is the value? 0.0375. Okay, just check if you're getting the answer. 1.2 minus 0.95 m plus 0.0375 minus 0.95 divided by into 45. Something we missed, I think, in the formula. Oh, 1.0375. Sorry, my bad. No, down nothing is it. Here, down also. 1.0375. Yes, now we'll get the answer. So 1.2 minus 0.95, put it in m plus. Then 1.0375 minus 0.95 divided by MRC into 45 divided by 1.0375, you'll get 15.18. What we were getting that time? 15.18. Can you see this? So if you are required to apply the formula in the exam, also you should get the same answer. Okay, that is one thing. Married people, I think you can relate to that formula, right? Whenever there is work at home. PG people, actually you can't relate to that because both will not do it. Okay, PG you will not relate, especially boys PG, you will not relate to that. It will be lying there only. I also won't do it, you also don't do it. Yes. When I was staying in PG, right, I wash clothes only when I know that for tomorrow I don't have clothes. But that day the washing will be like one heavy task. When I was staying in PG, when I was attending final classes over here, I was staying in PG. There is no washing machine and all in that PG. So you have to physically wash clothes. Like everyday washing clothes, if you make it a habit, it's actually good. No, like 15 minutes you'll finish, but you will not do it. When you know that tomorrow you don't have anything to wear, that day you will put everything, you'll soak it. Then one half day work only, that is washing. Yes. So now in this one also, this example also we can see with binomial method, you can get the answer. It was 550 divided by 500, 1.1, 425 divided by 500, 0.85. Clear? So now if you solve this, what is the value of call upwards in this? Okay, I will put it over here. What is the value of call upwards? Not finding place. Okay. 70. 70 was the value of call upwards into I minus D. I is what in this case? I was 1.04081. Clear? Minus D. Take your calculator and calculate the D. What is the price downwards? 425. 425 divided by 500 will be 0.85. Okay, divided by U minus D. What is the U here? 550 divided by 500, 1.1 minus 0.85 plus 0. But still for our remembering purpose, let's tell the formula that side also. U minus I divided by U minus D. Okay, the whole thing divided by 1.04081. First you take the denominator in the numerator and put it into m plus 1.1 minus 0.85 m plus 1.04081 minus 0.85. Okay, into, sorry, divided by MRC into 70. The whole thing divided by 1.04081. Are you getting 51.33? It was 51.32 there. Okay, so close enough. That should be good enough. Clear? That's your binomial method. If they ask, okay, with binomial method, if they tell risk neutralization, you will just do it as per the step 1, step 2, step 3. But otherwise, you have to do it in this particular methodology only. There is no other methodology to calculate. Okay, with that, we are done with all the things. We have only a couple of things remaining. That is 2 things. I think maybe like max to max, like 20 minutes will take in the morning. Put option also same, yes. Usually they all focus on call option only. Put option also, but the thing is same. You'll just do the same thing. Expected payoff, and then you'll divide it. Yes. Now, 2 things are remaining for tomorrow morning. How to establish perfectly hedged position. Okay. Then after that, one small model called as Black-Scholes model. For this, I don't have any technique to remember. You'll have to remember it. Okay. This ICAI has not asked for a very long time. Black-Scholes model. But first question or second question, I think in the study material only is Black-Scholes model. It's not asked for a very long time in the exam. I think maybe once or twice it would have been asked, but still you have to remember this. That's it. We'll spend 20 minutes in the morning and then we'll start solving problems. Wait. We still have decision tree also. Ayo, ho, ho, ho. Decision tree is there. Decision tree is there because I wrote over there, no, refer class notes for decision tree. What was decision tree? Now we saw only two stage situations, that it can either increase or it can decrease on the maturity date. But there can also be a situation. Imagine it's a 6 months call option. After 3 months, price can increase or decrease. From there again, price can increase or decrease. Are you getting this? I don't think we have time for that. Okay, it's already 9:27. So let's stop here. So we'll require around 40 minutes then tomorrow. 40 minutes at the starting of the day to finish decision tree, Black-Scholes and perfectly hedged situation. With that, all the concepts will be done. Then we solve questions of derivatives. Trust me, derivatives is easy. Okay, it's easy compared to some other chapters which we are going to see. No, it's easy only. Yes, yeah, decision tree we have to do. We'll do it today, tomorrow. That's it for the day, guys. Palaniyappan, you're sitting online. That also after half class you joined. After half class you joined. Starting you was not there. Bye bye. See you. Yes, good morning. Let's begin. So let's continue from where we stopped. There is too much. If we start revising from starting, there is a lot. We have revised it yesterday also. So only thing that was remaining is decision tree, binomial model and all we have finished. Okay, maybe we can revise from options. Futures I'm not touching. We can revise from options and quickly discuss whatever we have seen in options. So there are two types of options. What are the two types of options? One is call option, one is put option. Call option gives the option buyer the option to buy the share. Put option gives the option buyer the option to sell the share. And option writer will always be doing the opposite thing. Clear? And option buyer has the option and he does not have the obligation, but option seller has the obligation, he does not have the option. So if this guy exercises the option, that guy has to give the share or that guy has to buy the share. So scenarios we have seen, if it is heavily bullish, what is the best option? To buy the call option. If it is heavily bearish, it is always better to buy the put option. But if it is mildly bullish, you will not make money with call option. You should sell the put option. And we have seen the examples. And if it is mildly bearish with put option, even if it is going to fall down, you will not make any money, but you can make money by selling the call option. Clear? That we had discussed and we had seen the scenarios. Computation of fair option price. Fair option price, two time periods are there. In the option, by the way, we had seen that there are two things in options that we have to understand. That is intrinsic value and extrinsic value. Intrinsic value means what? The difference between the price and the exercise price today. Okay, when the option is being issued. And extrinsic value is what? The time value of money factor. Total amount is called as premium. And today only if there is a benefit, that is called as in the money. If there is no benefit, it's called at the money. And if there is, if it is negative, it's called as out of the money. Yes. After that, we saw that there are three types of option: American, European, and Bermudan style option. American option means you can exercise anytime. European option means you can exercise only at the end of the time period. Bermudan option means you can execute on broken dates. Speculation, that and all we have seen. Arbitrage. Whenever we are talking about arbitrage, the first thing what we have to worry about, we have to first ensure that we calculate the fair option price. Then only we will be knowing whether we can have any opportunities of arbitrage or not. Now in this fair option price, as I was discussing, there are two things: on expiry date or before expiry date. If it is on expiry date, what will be there? Intrinsic value only or extrinsic value only? Intrinsic value only, because extrinsic value is time value of money. There is no time left. So therefore, if it's a call option, what will be the call options value? Maximum of S minus E, 0. S is the spot price on that day, E is the exercise price on that day. Simple logic. If you don't want to remember the formula, simple logic. Exercise price is something. If it is higher than that only, you will exercise the option because you will get benefit over here. If it is put option, exercise price is something. If it is lower that only, you will exercise the option. So there, here the formula they made is E minus S, 0. Clear? And then on expiry date, call option buyer, call option seller. We have illustrated that and seen how they will be in a situation. Then straight away we'll go into payoff graph. What is this payoff graph? Just to tell you that if it's a call option buyer, for call option buyer, his profit is unlimited, but his loss is limited to the premium. If it's a call option seller, obviously opposite, his profit is limited, the premium amount, loss is unlimited. But if it's a put option buyer, the profit is not unlimited, profit is limited to the exercise price. It can go to 0, that's it. It cannot go to negative. So profit is limited to the exercise price and maximum loss is the premium amount. When you are the option buyer, always for you maximum loss is premium amount only. Put option seller, maximum profit is premium and maximum loss is till the exercise price becomes 0. Now we saw the arbitrage prospects before maturity date. First method which we learned was put call parity theorem. Put call parity theorem. Basically, what is the logic behind this put call parity theorem? They are telling that the value of call and value of put will be always going side by side, because if the price goes up, then the value for the call will be high. If the price goes up, that time value for put will be low. So it will just be fluctuating in the same manner, or they have a parity between the fluctuations. But the nuance over here is what? You have to remember that it is telling us only for two options exercising on the same day. That means same periodic options. And also they are telling for two options which have the same exercise price. Same exercise price. See, exercise price is same, time period, present value factor also we take same thing. So what is the point there? Value of stock, value of spot plus value of call is equal to value of put plus present value of exercise price. Sorry, value of spot plus value of put is equal to value of call plus present value of exercise price. Clear? Usually call option and put option have parity, premium on call increases, premium on put decreases. And then what we had to discuss is whenever you are doing arbitrage, imagine you have to buy the call option is sitting on the right hand side. So if you are buying the call option is, buy the call option. If you are buying the call option, what will you do? I think, sorry, I'm taking this example for this one, no? That is why it's looking ulta. This is the one, sell the call option. So if it is sell the call option, what will you do? Call option will be sold, this also will be sold. That means these two will be inflow, these two will be outflow. You have to create opposite opportunities, opposite actions, then only you will be making profit. Arbitrage prospects before maturity date, the next method which we saw is binomial method. In that it is called as risk neutral method also. In risk neutral method, what is the first step? First step, we will calculate the probability of increase and probability of decrease. How will we calculate probability of increase or decrease? Take the rate for the time period and that is your left hand side. That should be equal to whatever increase ka probability plus decrease ka probability. That time you will get the probability of increase and decrease. What probabilities are these? These are called as fair probabilities. There might be probability given in the question, and if you don't see, there can be interest given in the question, probability not given in the question. Then using the interest, you will calculate the probability. There might be no interest given in the question, but probability is given in the question. Now you are forced to assume that this is fair probability. If interest and probability both are given in the question, then you are still going to calculate probability because that is the market probability. We want the fair probability. Clear? Now, once you get the probability of increase and probability of decrease, what will you do? You will calculate for both these prices. You will calculate the payoff. Payoff means what is the value of the option? 240 minus exercise price, 190 minus exercise price. Obviously, if it decreases, the option will not get exercised only. So you got the payoffs and you calculate the probability. Multiply into probability, you will get the expected payoff. Expected payoff is on what date? It is on maturity date. So therefore, bring it to present value. You will get the value of the call option today. This was the method. One more formula for binomial method is you can use this formula. I'll suggest you, if you use this formula only when there is two time periods. Two time periods means there is time 1, time 2. That's it. If there is time 1, time 2 and time 3, then don't use this formula. It becomes extremely complicated because you have to calculate it in two phases. That time we will go into the method called as decision tree. Actually, what we are doing here, this is also decision tree only, but for a two time period. Time 0, time 1, that's it. Okay, so use this formula only when there is two time periods. Okay, if you're comfortable with the decision tree, you can go with decision tree also even for that. Now, this formula, value of call option is equal to value of call upwards. That means what is the call option value when it goes upwards? In this example, it was 45 something we saw just now. 45, value of call. Okay, that into I minus D divided by U minus D plus value of call downwards into U minus I divided by U minus D. The whole thing divided by I. Don't forget this formula. Okay, simple. If I do it or you do it. If you interrupt, then you only do it. Clear? But whole thing divided by I. Now, what is this I? I is the interest rate. Okay, if it is for 3 months, take it for 3 months only. What is this D? D is the downward situation. That means stock when it goes down divided by the spot of the stock. What is this U? Stock when it goes up divided by the spot of the stock. So that time you will get to these values 1.1, 0.85. Actually, what the probability method was doing, that only it is doing in this formula also. So ultimately the answer will be same. I think only decision tree was pending and then perfectly hedged portfolio and black skulls. Yes, we'll go into decision tree now. Same thing, but there is multiple time periods. See this example. Value of 6 months call option we want. 6 months call option. Spot is 300, exercise price is 310, RF is 16% per annum. Now every 3 months, price is going either increasing by 20% or decreasing by 10%. Now earlier what was the situation? Earlier the situation was, we told today this is the situation, on maturity date it can increase or decrease. But before maturity date also it can increase or decrease. And before maturity date, if it increases or decreases, from there again it can increase or decrease on the maturity date. So here they said every 3 months the price can go upwards or downwards. If it goes upwards, it will go up by 20%. If it goes downwards, it will go down by 10%. So now today what is the price of the share? 300. So you have 300 over here. Okay, if it goes upwards, this is your 3 months time period. This is your 3 months time period, 6 months time period. So basically here is the maturity date sitting. So if it goes upwards by 20% from 300, it becomes 360. Look at only the ones which are written in black, because that red is the probability that we haven't calculated yet. If it goes downwards from 300, it will go to 270. Now it is sitting at 3 months. We want at 6 months. So from 360, again it can go upwards by 20%. It will become 432. It can go downwards by 10%. It will become 324. Clear? From 270, again it can go upwards by 20%. It will become 324. And it can go downwards by 10%. It can become 243. That means now usually what we used to have on maturity date, we used to have 2 prices. Now on maturity date, we have 4 prices. On maturity date, it can be 432, 324, 324 or 243. Tell me for a call option, how to calculate the value of the call option on the maturity date. Before maturity date, other people are coming into the life. That is put call parity, risk neutralization method, lax calls and all. On the maturity date, there is nothing, only one method. Maximum of S minus E comma 0. Correct? On the maturity date, this is the spot price, 432. Will you exercise the option? Your exercise price was 310. Will you exercise the option? Will you exercise the option? Yes. 432 minus 310. That means you'll get 122 as the payoff. If at all this is the price. If at all this is the price. If it is 324, will you exercise the option? Yes. 14 rupees payoff. If it is 324, will you exercise the option? Yes. 14 rupees payoff. But if it is 243, will you exercise the option? No. So here it is 0. Now our only thing that we have to calculate is probability. I think somewhere we had done in portfolio management chapter one question where we had to do joint probability. Now we have to calculate joint probability. First what I will do, I will calculate for the 3 months period. That same thing will be there for the 6 months period also, because every 3 months the increase decrease is same. Okay, now 0.04. How did I get 0.04? 16% per annum. That means it is 0.04, 4% for the quarter, for 3 months. So 0.04 is equal to, increase is how much? 0.2, 20% increase. So 0.2p. Decrease is how much? 10%. So plus minus 0.1 into 1 minus p. Clear? When you simplify that, you'll get probability of increase is 47%. Probability of decrease is 53%. Now for the next 3 months time period, if I calculate also, it will be 47% and 53% only. Because same increase percentage, same decrease percentage, same interest rate. So now what happens? Here I am putting 47, here I am putting 53, here 47, here 53, here 47, here 53. Now I have to calculate joint probability. What will I do? 47 into 47. I'll get this probability rate. 47 into 53. I'll get this probability rate. 53 into 47. I'll get this probability rate. And 53 into 53. I'll get this probability rate. These are the probabilities. Always when you do this joint probability, ensure to verify and check whether it is totaling up to 1. Clear? Once we have done that, nothing. Multiply payoffs. Multiply. You will get 33.84. Value of the call option is 33.84. Now you are like, sir, don't we have to bring it to today? It's already on maturity date only. Okay, 33.84 already interest factor is all considered when we are calculating probability. 33.84 is the value of the call option. Same thing what we did in this thing. What is that? Our 2-time decision tree also was doing the same thing, but this was not there. Only twice it used to go up and down. Clear with this? Now, this is simple actually. What can be complicated? They can tell you for first 3 months, the price can go upwards by 20% or 10%, but the next 3 months, it can go up by 15% or 10%. that time you have to calculate probabilities again. One time doing this work will not be enough. Okay, so we'll see one more example. Spot price is 200. Exchange expected change is 3 months. And RF is 20% increase, 20%, 10%. Expected change 6 months. Increase 30%, 5%. So first what happens? After 3 months, the price can go up, price can go down. After the 3-month period, in the next 6 months, price can go up, price can go down. Compute the value of call option for 9 months option. So you have two time periods. One is a 3-month time frame. Other one is a 6 months time frame. And exercise price is how much? 230. So now tell me one thing. From 200, it will go upwards, downwards. And from here, again, it will go upwards, downwards, upwards, downwards. Okay, but here the increase is how much? 20% and 10%. But whereas here the increase is 30%, 5%, 30% and 5%. Is this clear? Now, when you're calculating, see 200, 20% increase becomes 240. 200, 10% decrease becomes 180. From there, it is going to increase 30% and 5%. So 240, 30% increase from 240 becomes 312. From 240, 5% decrease will go to 228. Same way from 180, if it increases, it will reach this number. Decreases, it will reach this number. You got all the numbers that are required, or basically you have 4 situations on the maturity date. Now, tell me what was the exercise price? 230. If the exercise price is 230 and the spot price is 312, will you exercise the option? Yes, you will buy it at 230. That means 82 rupees will be your payoff value of the call option. If it is 228, will you exercise? No. If it is 234, will you exercise? Yes, because it is 230 over here. 4 rupees is the payoff. If it is 171, will you exercise? No. So therefore, now only thing that is remaining is fitting the probabilities. Once you fit the probabilities, you will get the value of the call option. But fitting the probabilities, you can't do it directly. What you have to do, you have to do it for 2 time periods. Now, when you're doing it for 2 time periods, you have to understand one thing. What is the interest rate? Interest rate was 20%. So that means for the first time period, I'm going to take 0.05 is equal to, what is the increase? Increase is 20%. What is the increase? 20%, right? Increase is 20%. 0.2p. What is the decrease? Decrease is 10%. So minus 0.1 plus 0.1p. This will be the equation. So now what will happen? 0.15 is equal to 0.30p. Therefore, p will be equal to 50%. Are you getting this equation? If p is equal to 50%, both are 50-50. Both are 50-50. Clear? See, that is the equation which is written over here. Now, for the next time period, it is 6 months. So therefore, the rate of interest is 20%. So you are going to take 0.10 is equal to, what is the percentage of increase? 30%. So you will take 0.30p plus or minus, you can take directly minus 0.05 plus 0.05p. When simplified, this becomes 0.15 is equal to 0.35p. So p is equal to 0.15 divided by 0.35. Are you getting 43%? Just check. 42.8. Okay. So 43% here and 57% here. Now you got that. After that, you will just calculate joint probabilities. You will get the value of the call option. Okay. 18.49. Okay. I'm just keeping it open for some time. Just have a look at it. Done, guys? Yes, that should be it with the decision tree. The only thing that we have now, next we have to go into how to establish a perfectly hedged position. Now this perfectly hedged position is there, no? This is also under binomial method only. This is also under binomial method only. So under binomial method, I told you there are actually only three methods. First method is put call parity, binomial method, and Black-Scholes. So under binomial method, we have couple of varieties, that is risk neutral method and establishing a perfectly hedged position. Black-Scholes is the third one. Okay, now binomial method, perfectly hedged position, you will solve only if in the question you see the word hedge ratio. Only if you see the word hedge ratio. But because otherwise what we were doing? We were calculating arbitrage, not hedging. So if you see the word hedge ratio, compute under hedge ratio of binomial method, all that, then you will use this particular methodology. Clear? Yes. Yes. Let's go into the next one. That is how to establish a perfectly hedged position. Okay, how to establish a perfectly hedged position. Only if they ask for hedge ratio in the question, you're going to use this methodology. Otherwise, normal formula method or the decision tree method you will do and you will solve the question. Now, let's take this example. Let's say we purchased one share. RF is 16% at 300. Clear? 6 months call option. Exercise price is 320. Now, expected share price after 6 months, it can go to 360 or it can go to 270. It can go to 360 or 270. If it goes to 360, don't calculate probabilities and all. Okay, that would be the normal binomial method. If it goes to 360, will you exercise the option? Yes. So 40 rupees is your value of the call option. If it goes to 270, will you exercise the option? No, that means value of the call option is 0. That means first step over here, see the method. First step, change in the option price divided by change in the stock price, not option price, then it will be one only. Change in option price divided by change in option price. Change in the option price divided by change in the stock price. Clear? So now this is called as the hedge ratio. This is called as the hedge ratio. Now what is happening over here? See, the difference that can happen in the stock is 90 rupees. But the difference in the value of the call option is only 40 rupees. So if I go for the call option and if I try to cover this stock ka risk, the spread is how much? 40 rupees. That means I cannot buy one share and buy one call. If I buy one share and buy one call, I am actually not even hedging. Are you getting my point? I already have share, I am buying call. That means I am entering into contract that I can buy one more share. So if I buy a call option, if I buy a share, then my option is what? To hedge myself. I have to do the opposite. So I have to sell a call option. How does this work? Now, see over here. Imagine the share price is 100. Okay, share price is 100 and exercise price is 120. And if it becomes 150, now tell me one thing. If you have a share and you are going to reach a price of 150, you will sell the share at 150. But to hedge yourself, you thought it can fall down also. To hedge yourself, what you did, you sold a call option. You sold what? Call option. Call option, if you sell, exercise price is 120, okay, and the market price has reached 150. Will they come and exercise the option with you that time? Market, they can buy it at 150. Here, they can buy it from you at 120. Will they come and exercise with you? Yes, they'll come and exercise with you. So here you will have a loss, but in your share you will have a profit. That means you're hedged. Correct? You're not trying to make profit. Don't think that you're losing the profit opportunity. You're hedged. So therefore, what I'm trying to tell you is, when you're doing this, you cannot buy one share and you cannot sell one call option because the difference between these two is not the same. The price difference between share and price difference between the value of the option. Value of the option is what the premium that you're going to pay. The price difference is not the same. So if you buy one share and if you buy one call, you sell one call option, you will not be hedged. You will not be hedged, you will be actually losing money. So therefore, they said first you calculate the hedge ratio. Hedge ratio is spread in the options. How much is the spread in the options? 40 rupees. How much is the spread in the stock price? 90 rupees. So therefore, 40 divided by 90, you will get a hedge ratio of 0.4444. That means for 0.4444 share is the hedge ratio. What does this 0.4444 mean? For every 0.4444 share purchased, you need to sell one call option. Now you're like, sir, how can we purchase 0.4444? Imaginary. If you don't like that number, think that for every 444 shares, you have to buy 1000, you have to sell 1000 call options. Clear? But for every 0.4444 share that you purchase, you have to sell one call option. If you do this, you will be perfectly hedged. There is no way you are going to have extra loss if you do this. Clear? Now, step 2 and step 3, I have done it together. Step 2, they said create perfectly hedged position. Step 3, calculate maturity proceeds of the guaranteed outcome. So, hedging means what? Hedging means what? Protecting yourself from risk. That means you are guaranteeing that this much I should get or this much I will pay. Nothing more, nothing less. Correct? You are fixing today only that on the maturity date I have no tension. I don't have to look also at anything. I will be getting this amount. Clear? So, see the step 2 and step 3. Create perfect hedge and create guaranteed outcome. Sorry, guaranteed income. If price is 360, we told no, there are two possibilities. Price can be 360 or 270. If price is 360, what will you do? You had a share. You'll go and sell the share. How much share you had? You didn't have one share. You had 0.4444 just for imaginary purpose. 360 into 0.4444. You got 160 rupees. But if the price has reached 360, when your exercise price was how much? 320. Exercise price was 320. You sold the call option. No. You sold the call option means you gave the option to somebody else that you can come and buy the share. If they come and buy the share, now you have to give the share. Okay, if they come and buy at 320, that time what you will do? You will buy at 360 in the market and give it to him at 320. So you will incur a 40 rupees loss. That means your inflow is how much? 120. How much is your inflow? 120. Now, if I calculate and see when the price is 270 also, my inflow should be 120 only. That is called as hedging. Are you getting my point? So if the price reaches 270 also, I should have a inflow of 120 itself. So if the price reaches 270, tell me what will happen. Will you sell the share? Yes. 270 into 0.4444. How much you will get? 120 rupees. 270 into 0.4444, you will get 120 rupees. But if the price reaches 270, will that guy come and exercise the option with you? No. So therefore, can you see here also it is 120 only. This is called as guaranteed income. That is why it's called as hedging. Now you're like, sir, this fellow actually purchased the share at 300. Now the problem is what, he purchased the share at 300, yes, but he feels that it can fall down, it can go up. At all costs, he wants 120 rupees guaranteed outcome. Guarantee this much will come into his pocket. That is why it's called as hedging. Now don't worry about profit loss situation in hedging. In hedging, we are just ensuring that we don't lose everything. Clear? So now if you see, if it reaches 360 also, he'll get 120 rupees in his pocket. If it reaches 270 also, he'll get 120 rupees in his pocket. Clear? Now.
In hedging, the separate value of the premium amount is for.
No, we have still not found the premium amount actually. We'll get to that. No, value of the call we didn't put as 40 rupees. That means 40 rupees outflow for this guy on the exercise date. Yeah, it can be 40 or it can be 0. Yeah, it's just a spread. It can be 40 or it can be 0. Now you see like that, if you see decision tree, Value of the call payoff can be 82, 0, 4, 0, all that. No, then we found out that actually it is 18.49 in all the possible, when you consider all the possibilities. If it is only one price, then value of the call is 82. Clear? So now we understood that 120 rupees is the guaranteed income what we want. Now fair value, present value of that maturity proceeds. 120 when we are getting, 120 we are getting in the future. So we want to know what is the present value of this 111 point. So present value of that is 111.11. We know how to do that. 16% was the rate, I think, right? 16%, and we are talking about 6 months call option. So we divided by 1.08. Is this the value of the call option? No. This is not the value of the call option. This is what I'm getting today. Now see how to calculate the value of the call option. Action today. What will you do? You will buy one share. And how much share you are buying? 300 into 0.4444. How much did you spend? 133.33. How much did you spend? 133.33. And you know, in future, how much will you get? 111.11. You are getting less. You should get less. It is hedge. You should get less. It is hedge. Protecting yourself from a bigger risk. So in future, how much you are getting? 111.11, which we saw. Clear? If you are going to get 111.11, but you are paying 133.33, that means the difference from where it should come? It should come by selling the call option. If you sell the call option, you will get 22.22. This will be the same answer in risk neutral method also. Are you getting this? It's just a different approach or different thinking. Did you understand the situation? The situation is today what I should do? I should buy a share, sell a call. Buy a share is outflow of money, sell a call is inflow of money. The outflow and inflow cause net situation should be what? 111.11, because in future whatever I am getting, the present value of that is 111.11. Clear? Now if at all, just for your understanding, if you solve the same thing under risk neutral method, okay, I just want to show you the answer cannot differ. What is the share price now? 300, right? Share price is 300. It can become 360. It can become 270. Okay, if it becomes 360, 270. What is the payoff here? Payoff is not compared with 300. Payoff is compared with excise price. Excise price was 320. So 40 rupees and 0. Clear? Now what we will do? How much is the increase here? Increase is 20%. So I'll write 16% is my RF. RF is 16%. We are calculating for how much? 6 months. So I'll write 0.08 is equal to 0.08 is equal to how much increase? What is the increase here? 20%. So I'll write 0.2p plus how much is the decrease here? 10%. So I'll write minus 0.1 into 1 minus p. So therefore 0.08 is equal to 0.2p minus 0.1 minus plus 0.1p. So that becomes 0.18 is equal to 0.30p. So p is equal to 0.18 divided by 0.3, 60%. That means 60% is the probability of increase. That means 1 minus p is equal to 40% probability of decrease. So what I will do, I'll write 60% over here. I'll write 40% over here. That means 40 into 60% probability. That makes it 24. 24 and here 40%, but payoff is 0, so it is 0. 24 is a value here. So now what will you do? 24 divided by present value. 24 divided by 1.08. You're getting 1.08. You're getting 22.22. 22.22, and what you got over there? There also you got 22.22 only. Is that correct? Yes. So in perfectly hedged position also, if you are calculating, the value of the call option cannot change at all. Okay, the logic is the same. Okay, thinking is different. That's all. The angle from which they are thinking is different. Yes. Again, if you have to go through, what is the step 1 here? First, you will calculate the hedge ratio. Hedge ratio is what? Spread in the value of the call option divided by spread in the value of the share. Value of the share on what day? On maturity date. So now you will get a ratio. That is basically, what does it mean? For every 0.4444 share that you are going to purchase, you have to sell one call option. You have to do the opposite. You have to sell one call option. Then you create the perfect hedge. How will you create the perfect hedge? Under both the prices check. 360 if at all it reaches. You will sell the share at 360, you will get 160 rupees. And you will buy, the call option will get exercised. So you lose 40 rupees. So net what you're going to get is 120. On maturity date, you will get 120 in your pocket. If price reaches 270, that time what happens? Still you will sell the share because to hedge you have to do both the things. Okay, 120 you will get. And here call option won't be exercised, so nil. So 120 in both cases. 120 when you are getting, on maturity date you are getting. So calculate the present value of that 120. Present value of that 120 is coming to 111.11. Present value of that is 111.11. So when you reach 111.11, now you check the action of the today. What you are going to do? You are going to buy the share. How much share you are going to buy? 0.4444 only. So 300 into 0.4444, you are getting 133.33. You are having, not getting, this is an outflow. This outflow and some inflow should give you 111.11. That means your outflow should be equal to inflow because it is hedge. Outflow should be equal to inflow. So what you are spending, okay, and what you are getting should be equal to what you are getting. So the missing figure, what is it over here? 22.22. That is the fair value of the call option. So that means you will charge 22.22 premium and sell one call option. Is this clear till here? Any doubts with this? Yes, with that we are done with the perfectly hedged position also. The last method that we have is Black-Scholes method. Now, this is Black-Scholes method. So, but what we are doing is we are not going to go into that now. It's a purely formula based method. We can't go into the derivation of this in the fast track batch. So what we have to understand is simple. This is the formula. We have to buy at and go. No other option. Okay. S0 means spot price today. ND1 means Z values. So what I'm going to do is I'm not going to touch this method only right now, because Z values and all you will be able to understand only after you study one small chapter called as risk management. What I can brief you is, there is a natural graph like this, and this point is always considered as 0.5. Okay, here we calculate Z values. Okay, using this graph we calculate Z values. So what we will do once we finish derivatives completely, except for 2-3 questions of Black-Scholes method, next we'll go into risk management, finish it. It's a very small chapter. It was in our module 1, the first part of the book. We'll finish it and then we'll come and finish Black-Scholes and then we'll go into Forex. Okay, so 2 to 3 questions I think we'll have to keep pending, because right now if I explain, it's just going to be step based. So if you understand Z values over there, then it will make sense. Z values is actually nothing but probability only. Okay, when you go there, you'll understand it's actually nothing but probability, but in a more accurate manner. Okay, so with that, we are done with the complete concepts of derivatives.